morning, everybody. We are about to begin the program for today. So, first we'll start with Dr. Bridal Sagar's opening remarks. Sir, may I invite you on stage for your opening remarks and set the context for...
Here later. Do you want to invite the guests here?
We'll invite the lunch, I think.
Okay. Welcome you all here on behalf of the Indian Institute of Management, Kozhikode. It's my privilege to welcome you. And we are actually having this inaugural conference of Urupika, which is the Center of Excellence for Macroeconomics, Banking and Finance at the Institute of Indian Institute of Management, Kozhikode. Now, I would particularly want to thank Mr. Anant Nageshwaran for readily agreeing to come to this conference. And despite his very busy schedule and multiple engagements today, he has lived up to his promise of words. The same SBI chairman, Mr. Dinesh Khara, I mean, he was juggling with his calendar and he still created a space to be here. So that's the sort of commitment we had, and we have no words to thank Mr. Ashish Chauhan because he so promptly agreed to host it at NSI, his institution, and lent us not just the space but practically all the support we need. So it's sort of a partnership of IMK and NSC which has made this conference come to fruition. About Urupika, let me say it's rooted in numismatic history. So Urupika were the coins in ancient India in the Smoothry kingdom of Calicut. So out of which the modern rupee has emerged. It was called Urupika and the rupee came out of that. So there's a lot of significance of what we have named the center about, but we are very keen that this center actually, taking from the history, promotes the modern Indian economy. So we would be actually working very intensively on a range of issues, working with stakeholders and those who are here today at the conference. If they want to engage with the center, we'll find out ways. We will have an advisory board. We will have other things set up. Please, one objective is I want to bridge the geographical distances in India. Having done 3 decades of central banking, it's my ambition before I lay down my boots to give this social product from the south of India to the entire India, and in fact, to the entire globe, if possible, yeah. So let me just say that the conference thought, the theme which we have today, financial stability amid global spillovers, is a very, very significantly thought out theme, because if our ambition is to grow fast, I think stability is the most important contributor to it. So there are, it's basically a flat word now, so spillovers occur very fast, and we would, in this conference, debate and go deep into the issue of spillovers, especially as the nature of finance is changing, and we are seeing the digital spread coming into the finance. But the nature of spillovers will change, but the spillovers can become faster also. So that's what we really is all about. I'll request Mr. Ashish Chauhan to come to the floor and give his welcome remarks.
Respected Shri V. Anant Nageshwaran, respected Shri Dinesh Kharaji, Professor Bridal Sagar, I am Kozhikode faculty members, esteemed speakers, ladies and gentlemen, it's an honor. I welcome each and every one of you to NSE for the IIM Kozhikode's inaugural annual conference on macroeconomics, banking and finance, securing financial sustainability amid global spillovers. At the outset, I would like to congratulate IIM Kozhikode on behalf of NSE for putting together an excellent program that reflects the dynamic nature of contemporary finance discourse. Secondly, I would also congratulate them for the inauguration of Urupika, the Center for Excellence in Macroeconomics, Banking and Finance. We are truly privileged to host the unveiling ceremony of the center at NSE that will take place later in the evening today. I sincerely wish from the bottom of my heart that the center goes on to become a beacon of excellence and contributes immensely to the advancement of knowledge and practice in the realms of banking and finance. Today, India stands as the 5th largest economy globally, with annual output of around 3.5 trillion US dollars, or probably 3.8 trillion US dollars, based on which numbers we are talking about, because the GDP numbers are what I call slow frequency numbers, or extreme slow frequency compared to what we deal with every microseconds. Incidentally, India is now the 4th largest capital markets in the world after US, China and Japan, with a market capitalization of 4.6 trillion US dollars. That's 3.8 crore, that is 14 zeros after 3.84. And comparatively, scheduled commercial banks have a credit outstanding of 160 crore, 1.6 crore, which is almost less than half of India's market capitalization. So effectively, the markets have taken over the wealth creation, but it is also, there is a second side to the coin I'm sure we will discuss today. The banking sector and capital markets have been the pillars of India's growth story, playing a crucial role in keeping the domestic economy largely unaffected by the extant global environment of rising rates and high level of debt. Last 3 years, the number of investors in India has gone up from 2.5 crore, that is 25 million, to now around 8.75 crore, or 87.5 million. By most logic, by most numbers, because we have unique PAN numbers, 8.75 crore investors, they are almost competing with the number of farmers in India. That is, again, it's one of the largest cohorts of any type in India. So these are some of the newer parameters, newer things that are happening in India, and I'm sure some of us would touch upon today those issues on today's discussion. As India marches towards becoming the 3rd largest economy in the world in near future, it can count on 2 sectors to provide sustainable, inclusive, and long-term growth. The agenda for today's conference is rich and diverse, delving into pertinent themes that shape the very foundation of our financial systems. We shall engage in panel discussions and lectures that promise to be intellectually stimulating and insightful. From the efficacy of global financial regulatory reforms to the transformative potential of digital finance, each topic in today's program encapsulates critical and topical issues that demand our attention and expertise. We are privileged to have amongst us highly esteemed and knowledgeable speakers who will help us understand and navigate the intricate landscapes of global finance. The deliberations will revolve around critical questions such as the effectiveness of regulatory reforms in fortifying our financial systems against spillovers, the role of sound regulations in mitigating cross-border ramifications of digital finance, and the strategies for managing spillovers in emerging market economies. We'll also look into the macroeconomic and financial market implications of India's inclusion in the bond index, a development of profound significance in our nation's economic trajectory. We'll close with an interesting fireside chat on the evolving landscape of digital finance, exploring its potential to reshape our financial system. Lastly, I extend my heartfelt gratitude to the organizers, participants, and collaborators for their invaluable contributions in making this conference a reality. Once again, I welcome all of you to this conference and thank you very much for participation. May our deliberations be fruitful, our interactions enriching, and our aspirations transformative. Thank you very much.
Thank you, sir. We would now have the lamp lighting ceremony by our esteemed guest. I am honored to invite Dr. V. Ananth Nageshwaran, Chief Economic Advisor to Government of India, Mr. Dinesh Khara, Chairman of SBI, Mr. Ashish Chauhan, and Dr. Mridul Sagar and Dr. Tirthankar Patnaik for the lamp lighting ceremony. May I request everybody to be seated on the stage? Thank you. May I request Mr. Dinesh Khara to speak a few words on this occasion?
Thank you very much. Very good morning to all of you. My special thanks to Professor Sagar, Head of Center of Macroeconomic Banking and Finance. I am Kozhikode, for inviting me and sharing and giving me an opportunity to share my thoughts on a very important subject. The global economy today is facing multiple challenges. The prospects of slowing growth, large public debt, increasing economic fragmentation, and prolonged geo-economic conflicts. Financial market sentiments have been fluctuating, with changing views about an early pivot by central banks in advanced economies. The likelihood of interest rate cuts has spurred the rallies in equity markets. Although uncertainty about the timing of interest rate reduction is reflected in the bidirectional movement in the US dollar and sovereign bond yields. Likewise, in the emerging market economies also, there are some challenges relating to the currency fluctuations amidst the volatile capital flows. Among all these uncertainties, the Indian economy and the domestic financial system has demonstrated a significant resilience, which is essentially supported by the strong macroeconomic fundamentals, healthy balance sheet of the financial institutions, moderating inflation and improving external sector position, and continuing fiscal consolidation as outlined in the budget. Domestic economic activity is strengthening. As per the first advanced estimates released by the NSO, the GDP is expected to grow at 7.3% on a year-on-year basis in 23-24, which actually reflects a strong investment activity on ground. The CRAR and the CET1 ratios of the commercial banks stands at a very strong levels of 16.8 and 13.7% respectively as on September 23. The GNPA ratio and the NNPA ratio of the system is also quite low, which is a reflection of a very sound economic system as of now, banking system as far as the country is concerned. When the world is in the grip of uncertainty, the Indian domestic situation exhibits a positive growth outlook and a robust banking system. The policy initiatives have been able to absorb external shocks quite well, and accordingly corporates and households, and therefore as an extension the financial balance sheets have proved to be quite resilient. So on the face of it, everything looks perfectly fine. And the subject matter of today's discussion are the new challenges to the banking stability. I'll begin by saying that the banking system is currently stable, and the last 2 financial years have been quite healthy for the banking system in the country. Evolving environment still poses some challenges which the system needs to navigate well in the days to come. Recent developments in the banking system in some advanced economies drive home the importance of ensuring the prudent asset liability management and the robust risk management, and also ensuring the sustainable growth in the liabilities and assets. Undertaking the periodical stress test and building up the capital buffers probably holds the key for ensuring the system remains resilient in the days to come. Early identification and remediation of the risk factors by identifying the root cause of the vulnerabilities and triggering timely intervention before such factors culminate into distress is becoming increasingly important. To my mind, there are going to be 4 tectonic shifts which will shape the future of the financial sector. Let me talk about those 4 factors which will probably prove to be the tectonic shifts. First and foremost is the changes in the domestic and the global economy induced by technology, climate action, geopolitics, and new business model. The domestic and the global economy are undergoing deep structural transformation. Some of the systems of this phenomena include the relocation of the supply chain, demographic aging in the advanced economies such as Europe, US, China, and Japan, and COVID-19 impacted the future longevity in the higher age bracket, and also the premature loss of lives in higher age bracket. This has eventually reflected in the erosion of demand in many of these economies. Many economies across the globe are saddled with high level of public debt and rising dollar interest rates. To control the runaway inflation after Russia-Ukraine conflict is actually putting many of the sovereign countries under various challenges. With global growth projected to slow down further in 2024, the debt servicing might prove to be a further challenge. Additionally, the global multilateralism is giving way to the bilateral arrangement. We are not sure where and how the new equilibrium will be achieved. In the banking system, the structural transformation include growing regulatory oversight to accommodate new business conditions. Basel III and IFRS are getting more stringent. Digitization of the banking services is creating new hyper-customized channel of services, and also exposing the system to some of the cyber risk also. The prevalence of the legacy technology, such as mainframe-based platform that supports a bank's backup operations, also is one of the area which needs to be addressed, and perhaps the legacy systems needs to be replaced at a faster pace. Nevertheless, even as the banks are updating their legacy systems, the shortage of skills that are required to operate and maintain these core systems may act as a constraint. The NIMs which we are seeing today, there could be a challenge depending upon the ability of the system to raise the liabilities at the kind of price which they have been successful in raising, particularly during the COVID period, when actually the system saw a significantly higher CASA ratios. Let me now talk about the climate action. Climate changes and the mitigation is now on the top priority of India and abroad. With banks expected to contribute towards the transition to net zero, there will be a pressure for adoption of the green technology across the economy. Climate stress test conducted for India by RBI in this report suggests that banks are more prone to the climate risk because they are serving a larger economy, and when the larger economy has to navigate the climate changes, then perhaps it will have an impact on the banking system too. But fortunately, this realization has come in good time, and there is a concerted effort on the part of the system and also on the part of the economy to navigate this particular challenge well. SEBI has also mandated the listed companies that they are required to report in Scope 3 emission going forward. This is being made mandatory by 2025. Scope 3 emissions accounting is still at an initial stage in banks, and to my mind, because the way we are moving towards the climate finance Scope 1, 2, 3, there is a need for a very elaborate accounting mechanism, almost parallel to the accounting system which we have in the financial sector. So on the similar lines as the accounting system is there, perhaps the green accounting is also one of the necessity. Geopolitics has emerged as key factor that may impact all businesses, including banks. There is an ongoing war between Russia and Ukraine, Israel and Hamas. The risk across the Red Sea have significantly increased. These risks have implications for normal economic activity. As of now, it may not be directly impacting us as in India, but the way the global trade happens, the way it starts impacting the psychology, that is something which we cannot ignore. Geopolitical tensions could lead to financial instability through two key channels. The first is directly through a financial channel triggered by the restriction placed on capital flows and payments, or indirectly through an increase in uncertainty and the investors' risk aversion to the future restrictions as there is an escalation of conflict. Rising geopolitical risk also entails that defense spending may go up in the next 5 years. The risk of high-intensity conflict in the next 5 years cannot be ruled out. This will have an obvious implication for the development. Lastly, the emergence of the new business model has altered the risk profile of the businesses. The inherent credit risk in new age startup is very different from the traditional SME. Since forecasting technology is more difficult than forecasting macro aggregates, infusing technology and business change risk profile in a way that is not fully understood is equally important to really appreciate. When we talk about the information availability, there is a whole lot of differences in the availability of information and also the formal structure of the information availability. That is something which we need to address. That is why we see vast divergence between the market valuation and post-listing valuation of startups. In case of platforms, one is not sure how the two-sided markets will behave and what are the inherent risks in the platform. In conclusion, while we are in a phase of high growth trajectory, the evolving situation warrants constant vigilance. The structural changes in the economy creates both opportunities and the vulnerabilities. Shift in technology create both sunrise and sunset sectors, and as banks, we have to ensure that the diversification process of exposure is not lost. As climate mitigation takes the center stage, banks will be at the forefront to mobilize large capital for migration to net zero, green bond mobilization, and green deposit will form a part of the bank's liability. This creates both risk and opportunities. Lastly, geopolitics is changing the growth and inflation dynamics. Given that geopolitics is not easily quantifiable, assessing the impact is a challenge. But it has to be done to ensure that banks are ring-fenced from the adverse impact of the geopolitical events in far-off places. Thank you very much for giving me an opportunity. Thank you.
Thank you, sir. Our next talk is by Dr. V. Anant Nageshwaran. His talk is on macro-financial stability and spillovers in an integrated world. Sir.
This laptop, is it possible? Like, can you put this low?
Yeah. You want to connect it? You have
No, I want to connect it to, no
Okay.
PowerPoint.
Okay.
Just close it like that, and then I'll keep it on top of
Yeah.
it. Thank you. Respected Mr. Dinesh Kara, Mr. Ashish Kumar Chauhan, Dr. Mridul Sagar and Tirthankar Patnaik, my friends Anant Narayan, Samiran, Chetan, Rudrasen Sharma and his colleagues from IIM Kozhikode. I also see at a distance Mr. Ayyappan Nair from RBI, who prepares the excellent twice-a-year financial stability report. So in fact, ideally, he should be the one talking about this topic here instead of me. So before I share with you my remarks, I would like to solicit your sympathy for me. When Mridul Sagar wrote to me and said I should speak on macro, financial stability and spillovers in an integrated world, he basically packed 4 topics into one headline. And now Tirthankar tells me I should conclude this talk within 20 minutes. When each one of them is fit for a day-long seminar. Macroeconomic stability, financial stability, spillover, and are we in an integrated world or not? So I'll try to do justice to it within the time allotted to me. Are we in an integrated world or are we becoming fragmented? You will be surprised to know or hear from me that I don't think we are becoming less integrated or more fragmented, much as commentary would like to have us believe that it is the opposite. In terms of global trade volumes, it is very difficult to disentangle the effects of economic slowdown and the fact that there could be trade restrictions, both of the tariff variety and non-tariff variety. And of course, countries are focusing on friendshoring, reshoring, all those things are definitely happening. So it is not that we are in the golden era of no need to plug in, no need. Era of globalization, but at the same time, based on the trade data, it is difficult to make out the case that we are definitely becoming more fragmented. Let me just share with you some numbers. The rapid growth of China's new breed of green exports actually went up by 30% year on year in 2023 to around $140 billion. And this is happening despite the Chinese economy undergoing a deep property slump, deflationary pressure, and low investor confidence. And if countries are trying to diversify away from China to other sources of supply, actually it ends up simply being a rerouting of China's products through these markets. And Vietnam appears to be playing that role. For example, Vietnam exports to the US and imports from China have surged since US-China trade tensions emerged in 2018. Annualized exports to the US from Vietnam rose from $42 billion in 2017 to around $113 billion in 2022. And in October 23, it was about $95 billion. At the same time, Vietnam's imports from China went up from $59 billion in 2017 to $121 billion in 2022, and then slightly moderating to 108. So as you can see here, Vietnam's exports to America surged, and Vietnam's imports from China surged as well at the same time. And you look at the data for Thailand, Mexico, etc., the same story emerges. And let me also tell you how difficult it will be for nations to diversify or reinsure their supply chains. If you look at China's involvement in global trade, you realize that in 2019, China exported 87 out of 87 HS2 products. 1,133 out of 1,133 HS4 products. 4,396 out of 4,422 HS6 code products. So you can imagine their footprints in so many product areas, and China's export market consists of 209 out of 225 countries, and it is the largest exporter to 74 countries in the world. These are all data as of 2019 pre-COVID. So when we talk of de-risking from China's supply chain, we should be under no illusion that it is something that can be achieved at the speed with which you can put out a tweet. Okay? It is going to take much longer. You move away from trade and look at renewable energy and dependence on critical minerals and rare earths. The production of these rare earths and critical minerals is concentrated in a few countries, but the processing of them happens exclusively in one country. If you haven't yet picked up a copy of Ed Conway's Material World, you are missing something. That's a book that was a runner-up last year or the year before in the FT Schroeder Business Books of the Year award. The world will be using more copper between now and 2050 than it has used since the metal was discovered. And you look at lithium, you look at nickel. You may say Indonesia exports nickel, but most of those Indonesian nickel mines are owned by Chinese companies. The same thing in Congo, same thing in Argentina and Chile, etc. So, are we really de-risking? Are we moving from an integrated to a more fragmented world, or are we becoming embroiled or entrenched in a more concentrated world when it comes to trade or even renewable energy? In fact, I would even argue that the shift from fossil fuels to renewable energy takes the world away from de-risking towards re-risking, because you're going to depend on one single source for many of these critical minerals and rare earths. So therefore, in that sense, if we interpret macroeconomic stability in a broader sense, we probably are creating the conditions for more instability rather than less. But if you interpret macroeconomic stability very narrowly, in terms of fiscal and monetary stability, you may argue that countries do have some autonomy. But if you expand it to include many aspects of real economy, I'm not so sure that we are becoming less integrated or even less riskier, much as we like to use the phrase de-risking. Of course, when it comes to macroeconomic stability, the fact that countries have their own policy levers to pull is very exemplified by India's own macro stability in the last several years during COVID and afterwards. One of the reasons why we have been able to grow at 7% plus in the last 3 years, and if RBI is correct, it could be a fourth year in a row in FY25, is partly because we did not overstimulate the economy during COVID, both of the fiscal and monetary variety, and whatever stimulus we gave was calibrated and targeted. And more importantly, both fiscal and monetary policy began to pull back from those levers in time. Unlike, let's say, 10 years ago, or for that matter, unlike what other countries are doing even now. I mean, look at several countries, the fiscal deficit ratio still is around 6 to 7% of GDP in some countries. So in that sense, whether we look at growth or inflation or current account deficit, and currency stability, we have demonstrated that despite the issues I highlighted in the earlier portions of my remarks, we do have certain room for practicing macroeconomic stability, preserving it and nurturing it, and reaping the benefits of it in terms of a better growth inflation dynamic as well as external stability. But when it comes to the world of finance, where I would actually posit, and this is an academic institution that is hosting this conference, and therefore one should set off a few fires here for discussion. When it comes to financial stability, I would argue that a slightly more fragmented world will be desirable. And that was the burden of my song in 2019 when I wrote the book, The Rise of Finance, Causes, Consequences, and Cure. But there is no sign that in the world of finance we are becoming less integrated either. Financial stability, you can think of it as stability broadly speaking, banking, non-banking, and capital markets. In theory, the first two are less susceptible to spillover effects, and the last one more so, capital markets. However, in practice, it turned out very different in the 2007-8 global financial crisis. In fact, Europe continues to suffer even a decade after the global financial crisis, as employment output and wages have stagnated significantly. As recently as 2019, 18 advanced economies still showed negative deviations in output compared to pre-global financial crisis levels. In fact, one could say that Europe has never really returned to the pre-crisis economic dynamism or economic situation. And even India, which was considered somewhat more distinct or less integrated, our domestic banking was not immune or exempt from global spillovers. The capital flows in 2004 to 8 period led to a domestic credit boom. Just to look at the banking assets to GDP ratio, which were hovering in the 20 to 30s between 1980 and 1990, surged to 55-56% of GDP in 1 decade. It is a ratio, by the way. It is not absolute numbers, doubling in 1 decade. So you can imagine the domestic credit boom that happened. Regulatory forbearance as a precautionary measure resulted in unintended consequences. And then banks and firms engaged in evergreening of loans. All of these things actually ended up in a situation of non-performing assets, which were around 2% in 2008, going over to 10% in 2018, with some banks even having a ratio of more than 20% of non-performing assets. So we were not exempt from a global financial crisis, which many people still call a North American or an Atlantic crisis. It was not. It was really a global financial crisis. And the 2004-8 capital flows also led to emerging economies experiencing currency appreciation, which resumed in 2009 and up to 2011 as well. Brazilian central bank governor at the time, Arminio Fraga, called it actually an act of war. The low interest rate policy of the developed world, sending capital out in search of yield, well known in the industry as carry trade, created basically a boom-bust cycle for exchange rates. You just have to do a simple internet search for the currencies that appreciated so much between 2004-8 and 2009-11. They actually tumbled a lot in 2012-13. Exact polar opposite of what happened in those 7 years compared to what happened in the next 2 years, and Indian rupee was one of them as well. Why is that? Why is this kind of spillover still there? Because in truth, even now, when it comes to financial markets, there is one country, one economy, one market, one monetary policy, and one currency, which is the United States and the US dollar, Federal Reserve. They matter. This is true even after the advent of China as a very large economy. The reason is American consumer still happens to be the first and the last resort for many countries, whether you are directly exporting to America or indirectly through other countries. So therefore, the global demand, if anything, in spite of the low growth post-COVID, the world hasn't really tumbled into a recession. It is because of the resilience of the American consumer even now. So in that sense, the financial world is not just integrated, it just depends on one country and its monetary policy trajectory, and therefore its currency movement impacting other countries. Therefore, I would like to see more fragmentation. But it is not yet a reality. The euro, more than 20 years since its inception, hasn't lived up to its promise of providing us an alternative to the US dollar. And China's economy is battling its own macroeconomic challenges. In any case, as long as one has a closed political system and capital controls, it's very difficult to become a global reserve currency and a global store of value. Okay? So, today, even if countries have no de jure fixed exchange rates, they still have de facto fixed exchange rates with the US dollar. That is why monetary policy cycles are synchronized. You ease when the US eases and you tighten when the US tightens. It is not just because of trade flows and trade competitiveness, it's also because capital flows, because when US interest rates are extremely low, other countries tend to attract so much of capital flows that they want to make themselves less attractive if possible, and therefore they lower interest rates. And then when the US starts to tighten, there's a scramble to repay and a hunt for dollars, and therefore you are forced to tighten monetary policy to attract the dollars that you need to be able to repay those loans. So you can imagine you are in a de facto fixed exchange rate regime, and both spillovers and integration are unfortunately still a fact of life. And the fact that we are dealing with the global debt crisis today, low-income countries, is because of the policy of extremely low interest rates, ultra-accommodative or unconventional monetary policies that US and developed countries followed in the second decade of the millennium. In fact, it is wrongly argued that developing countries' debt crisis today is because of higher interest rates of 2022 and 2023. That's not true. The debt crisis that low-income countries are facing today is because of the low interest rates that prevailed for much longer earlier in the previous decade. Is there a way out of this? So far, it doesn't seem to be the case. Therefore, developing countries are in a situation of heads you win, tails I lose situation. So there is even less macro stability and even less macro autonomy in a financially integrated world, and financial fragmentation has not really commenced at all. Therefore, in theory, there is sovereign policy autonomy. Then, if advanced countries are, as one would expect, setting monetary policies for their domestic economic agenda, as they are entitled to, the question that arises is, should emerging market and developing economies do so as well? Do they or can they? The answer is no, because the interest of global financial institutions and their clients accentuate the spillovers and lack of policy autonomy for emerging and developing economies, and therefore still endanger macro and financial stability in these economies. That is a question we need to ponder. In order to maintain macro and financial stability, do capital controls in some fashion or the other, selectively or otherwise, should it need to come back into policy vocabulary and discourse and discussions, let alone policy formulation? What are the various tools to enhance your policy autonomy? And capital controls is a legitimate such instrument of policy autonomy. And then next is the role that credit rating agencies play in encouraging spillovers, because their ratings transmit from one country to the other, creating contagion effects. Financial institutions and financial market players wake up when one country is downgraded, which usually happens after the fact, that after their fundamentals have already deteriorated. When it is a time for contrarians to start buying, the credit rating agencies will actually be downgrading them. That's a different story. But when they do so, other countries also catch the cold. And therefore, they also play a part in spreading spillovers. What do we do about them? There are no easy answers. And lastly, I would like to leave you with the question. When we are so keen to welcome multipolarity in the world, in terms of intellectual integration, we are homogeneous and not heterogeneous, because most of us end up going to one or two Western nations for our higher education and come back. Are we learning multiple schools of economics? Are we understanding that there are different policy options except one particular neoliberal agenda? So how intellectually fragmented we are, and that is a world where I would actually argue and make a case for more intellectual diversification and less intellectual integration. That is where everything starts. So if you want to have a less integrated, or in other words, more diversified world of macroeconomy and finance, we actually should become less intellectually integrated and more open and more pluralistic. As long as that is not the case, the rest of the diversification or less integration will not happen. Spillovers will remain a challenge, and macroeconomic and financial stability will be elusive except for a very few countries. Thank you very much.
Thank you, sir, for a very interesting and insightful talk. We would now have a Q&A. There's a QR code on the screen. You can scan it and post your questions.
From the floor, they can just ask.
Yeah.
What's the collateral damage for China's attack on US dollar hedging? Maybe I should ask you on the mic. Good morning. I'm Royston from Grameen Bank. Question is, what is the impact, that's collateral damage that's going to happen because of China's war on US dollar hegemony?
Yeah. But has China been able to mount an effective challenge to the dollar at all in the first place?
We're seeing a lot in Africa. I mean, I think in the developing countries, global south, there seems to be some real momentum, and that could be disruptive for the next couple of decades. So in terms of the development agenda, at least, are we seeing a lot more collateral damage than we are ready to accept?
No, that's No, that's a good question. But ultimately, in terms of the magnitude that are still happening, while it may be true that in some parts of the world, Chinese yuan, because of their swap arrangements or because of OBOR and other forms of bilateral assistance or lending arrangements, one might get the impression that the yuan is making much inroads. But I think, if I'm not mistaken, Professor Ishwar Prasad has been writing with a lot of data showing that they have barely made a dent in the ubiquity and pervasiveness of the use of US dollar for both bilateral lending transactions or capital market transaction, or as unit of account and settlement currency in both trade and capital markets. So I'm not sure that while I acknowledge your point that in some countries it is China is trying to grab market share, if I may say so, I don't think it is meaningful enough in terms of volume for us to think of it as a sort of posing a formidable challenge yet to dollar's hegemony. If anything, I think what I might say so is you look at the fiscal policy in the United States, where post-COVID the fiscal deficits are still very high, etc., and debt burdens being on the higher side, not just the US, everywhere. So it will be more domestic economic fundamentals that would have a much larger bearing on what happens to the US dollar rather than competition from other countries. Thank you.
Globally and India, this climate risk, are we factoring in the monetary policy as well as in the financial, planning in terms of the budget and other things? Because that is going to affect food security and, of course, in all respect of human, our sustainable development goals also. I wanted that matter to be little elaborated.
No, whether monetary policy is factoring in climate risk into its calculus or not is probably addressed to somebody from RBI. None of us are from the RBI. Mridul is...
Yeah, so actually there is some recent literature on how climate risk can matter for the basically monetary policy. I would urge you to go through the report on currency and finance which the Reserve Bank produced last time And there is enormous material in that on how it matters for the monetary policy.
In some of the spillovers that are taking shape now. Do you think that rating agencies also need to review and relook the metric framework within which they
Some of you might know that we did write about it in a collection December. I mean, the role that they played in the propagation of the crisis was very evident in 2000, both in misvaluing them, the collateralized mortgages, and then later on in downgrading them in one swoop. So, but this, who gets to bell the cat, and how and why, and what is the incentive for anyone to change the existing status quo from their point of view? There isn't one. A new credit rating agency, a new kid on the block, how do you then deal with the oligopoly of the existing institutions? And so I'm not sure there are easy answers to break the spell of the dominance that they have, unless regulators in the developed world themselves bring about these change and introduce more competition legitimately. Otherwise, it is very difficult to see the status quo changing within a short horizon, much as we might say that there is a need for change, which is well established, both in terms of the implications that they carry, the usefulness of the rating changes, whether they happen at the right time or much delayed manner, etc. But also in terms of the methodologies, and we wrote about it, about the non-transparency of some of the criteria they follow, and the arbitrary selection of both the so-called expert opinions that go into the qualitative ratings. All these parameters, all these things are definitely crying out for overhaul, or at least an open discussion. But we are still struggling to figure out how to initiate that and how to make it happen.
This is Anupam Johari from Raiffeisen Bank. I had a question. What are the monetary and fiscal conditions that India needs to reach for the Indian rupee INR to become fully convertible?
So I think convertibility on the capital account is a journey we have already begun. There is no timeline for that, but you asked for basically not the timeline, and probably basically like what metrics would enable us. So kind of convertibility will be more than just macro stability parameters, but it's essential to bring down the fiscal deficit further from here, and for interest rates to be aligned globally, inflation to be aligned globally, because you can't have an inflation differential running. See, it's an extraordinary situation where advanced economies have higher inflation rate than ours in recent period. But that's not going to stay. But endemically, we are a higher inflation economy. I think this budget has made a tremendous progress in consolidation. And while I was critical of the last budget for not enough fiscal consolidation, I this time wrote and gave it full marks for basically trying to achieve goalposts which are extremely difficult, and the consolidation trend has established our credibility, which in due course might affect rating, as somebody sort of said. So I'm very positive about it. So that journey will take a little longer. So let's live with it. Another point which Dr. Nageshwaran was very emphatically pointing out was about the Chinese yuan and its convertibility and sort of SDR basket. It only meets technically one of the two criteria. It's trade, essentially it's the trade size, but for financial transaction it's still not acceptable. So these things are very difficult. It's a long journey in the process.
Good morning. Thanks for the insightful thoughts from the eminent panelists. To introduce myself, Pawan Goyal, I'm junior of Anand Sir from IIM Lucknow and ex-JPM banker. Currently doing my PhD. My question to the point that Khara sir mentioned about the climate risk. So wanted to ask, when we are talking about climate risk, first the accounting standard, second the ESG standards, how they are evolving to assess it. And second, when do we think in the future the banks will be able to bring the climate risk into the risk model and into the pricing?
In fact, as a lending institution, we have already started evaluating our borrowers on the ESG rating. Though, of course, it is not influencing our decision in terms of the interest rate for the borrowers, but nevertheless, we are also sharing those ESG rating with the borrowers just to make them aware where do they stand. I think these are the early days. Our ask was to the regulator, if at all, there could be a nudge from the regulator in terms of helping the banking system in differentiating on the pricing parameters. But as of now, it has not happened. If you really ask me, there are two, we had put across two asks. One, of course, reduction in the CRR for the green deposits. And also the second one was that if at all, as a policy, it can be incorporated. The early beginning has happened from the regulator side also, but I think maybe it is another 2 to 3 years when perhaps it will start having an impact on the pricing too. But nevertheless, what I would also like to mention is that we are required to report the scope 3 being the listed entity to SEBI. So I think there's a increasing awareness being created in the ecosystem, which will eventually start impacting on the pricing part also. So I think we're in the right direction. The second question which you had put across relating to the accounting system for the green, to my mind, there has to be some kind of accounting standards, which perhaps can be given by some of the accounting bodies like ICAI type of bodies, or who can actually define these accounting standards. So unless and until the green component is captured across the organization, and also then there would be a need for its auditing too. Because if at all there is a green source of funding, then naturally all those who are providing the green funding, they would like to have some kind of a credible numbers too. And for that, perhaps even auditing will also emerge. That's how I look at it. And we are engaging with some of these entities also to see that if at all there can be some accounting standards which can be laid out. Thank you.
Thank you.
So there's a question on the portal. What are your thoughts on India emerging as the world's factory?
This can be the last one.
Yes. Yes.
No, I think there is enormous potential for that to happen. And some of the preconditions have been laid, because one of the reasons why we didn't industrialize enough was the absence of commensurate physical infrastructure, which has made tremendous progress in the last decade or so. And therefore, and given the interest that the rest of the world has in creating alternatives to the existing source of supply, The journey has just begun, and the potential is quite huge, and therefore, whether India emerges as the world's factory on the scale of China, that is probably not a relevant metric to compare, because countries and the context differs from what it was between 1980 and 2015 or so. But definitely India can emerge as a very important player in the global supply chain. Whether we will exactly emulate China or not actually is not necessarily an important way to look at this issue.
Thank you. So this brings us to the end of the inaugural session. May I invite Professor Thomas to deliver the vote of thanks?
A very warm good morning to all of you, dignitaries on the dais, Dr. Anand Nageshwaran, Chief Economic Advisor, Government of India, Mr. Ashish Chauhan, MD and CEO of NSE, Guest of Honor, Mr. Dinesh Khara, Chairman SBI, Professor Mridul Sagar, Head Urupiga, Mr. Tirthankar Patnaik, Chief Economics NSE, faculties, center, friends, ladies and gentlemen, students, everyone. It's a great pleasure to propose the vote of thanks at the first IMK conference organized by Urupiga, Center for Excellence in Macroeconomics, Banking and Finance, supported by the National Stock Exchange. We, the Urupiga team, is delighted to have created a platform to discuss, dissect and disseminate on the theme securing financial stability amid global spillovers. We have in our midst 200 odd delegates, speakers, drawn from the various walks of life. On behalf of Urupiga, IMK, let me first thank each one of you. First, let me thank Dr. Anand Nageshwaran, Chief Economics Advisor, for accepting our invitation to be present here. Thank you for the thoughtful inaugural address that has set the tone of our conference. On behalf of IMK and the Center, we thank you, sir. Mr. Dinesh Khara, Chairman SBI, for associating with the conference. Thank you for delivering the comments and accepting our request to be the guest of honor of the session. Thank you, sir. The conference is largely possible due to the unflinching support from the NSE. In this regard, we are grateful to Mr. Ashish Chauhan, MD, CEO of NSE. On behalf of the Center, we thank you, and we hope that you would continue associating and supporting our activities and future economic endeavors. It would be unfair if I don't thank Professor Mridul Sagar, Professor of Practice and Head of the Center. You've designed the conference, and your painstaking efforts are very visible, and we thank you, sir. I have to thank the NSE staff and who have coordinated with the Center. Mr. Patnaik, on behalf of IMK Center, we truly acknowledge your service. A big thank you to all of you. No conference is elegant without an elegant audience. We are thankful for each one of you who are present here, students, faculty, Center members, a big thank you. Ladies and gentlemen, once again, I want to state that we are most grateful for all of you. We thank you for being with us in this morning. It's a great pleasure. Thank you once again.
Thank you. We'll have now. May I request MD sir to felicitate our esteemed guests. Thank you, everybody. We'll now take a short break. Please feel free to refresh yourselves, and we'll reconvene at sharp 10:15. So, thank you, everybody.
to sort of introduce here the august audience, which you all know, and she has already told you about the death. So, as a backdrop, I will just say that we had global financial regulatory reforms after the global financial crisis. And that's a very broad sweep. They have touched institution, markets, market practices, everything. And as we go now, we face the pandemic, and my personal view is these reforms have done a lot to sort of bulwark against those spillovers and crises spreading across the globe. But I leave that to the panel to give their observations on that. Let's sort of kick off the discussion, and let me open with Anand, because Anand has actually a very widespread experience. He was in the banking treasury, and he was also an academic, and is now overseeing the equities market. I'm sure with a wide lens, maybe bifocal, also working about basically because you want market to deepen, market to sort of develop. So he's doing a fine balancing act between strict regulation and the development. So let me sort of ask you that basically, like, what are the key lessons learned from the global financial crisis? And are we safe enough today that the spillovers won't really affect the markets that much? The markets will remain stable, both domestically in India and from the global viewpoint, how this will pan out.
Thanks a lot, Mridul, and congratulations to you, by the way, and to IIM, Kozhikode, and NSE for putting this together. I think the morning session was absolutely fabulous. You asked for an honest and open conversation. Is the press here, just to confirm?
Yes, I'm afraid it is there. They're not going to leave you.
Okay, so that's fine.
But I will urge them to report responsibly.
Okay. No, the opening question is harmless enough. Lessons from the global financial crisis. Look, I think one key takeaway, at least from my narrow, limited perspective, is interconnectedness of the financial architecture, which was kind of underlined during the global financial crisis. So if you look at the way it apparently started, it started off with the subprime crisis, which was, you can argue, a niche part of the US economy to start with. That then transmitted to a few investment banks which were impacted directly.
Sorry to just intervene. So it was not the financial innovations, but the institutional regulation was weak?
No, it was a combination of everything, I think. So the domino effect really from subprime crisis hitting a few investment banks, the transmission from that layer to the larger financial sector happened through multiple ways, right? So you had very innovative derivatives which kind of spread the risks in ways which people didn't understand fully. You had leverage which had been built up in the system, often unrecognized, and therefore that added to the problems. And then you had this international connect. These derivatives and these capital flows were across borders, right? It was not just to one particular jurisdiction. So you had what started off as a niche problem hitting a wider set of financial sector entities. That in turn impacted the real economy, the stock markets, global flows, and take the case of India. You could argue that we were not really in the thick of any of these things, neither subprime lending, nor exotic derivatives beyond a very small sliver, nor real exposure to monoline insurers and stuff like that. And yet our real economy and our financial economy was impacted in a big way. I think the point to note is there is interconnectedness. We are a giant set of dominoes across the globe, and that's a good thing. We need this interconnectedness because that's the way in which the virtuous cycle spreads as well, when you have growth and capital formation and savings and investments all coming together. And on the flip side, it just underlines that if one of the dominoes starts to wobble or fall, you can't really predict how this can spread across the entire landscape, the entire financial sector landscape. Now, I think a lot of good work has happened since then. Obviously, we've learned a lot of lessons. So we've had tremendous, improvements in banking regulation. Some would argue maybe that it's too much of regulation, but the fact is the capital buffers have been increased dramatically. There's been a huge amount of regulation as far as removing the opacity is concerned on derivatives, getting them to come on to exchange platforms, putting huge margin requirements on over-the-counter derivatives, making sure that clearing corporations are strengthened adequately. So there's been, and then every regulator, whether it's the central banks, whether it's the securities commissioners, they've all done their bits to strengthen their parts of the forts. But I think the reality remains that we are a bunch of dominoes everywhere. Interconnected is there. Now, Ayyappan is here who writes the financial stability report, and they do a section on interconnectedness within the Indian sector, for instance. But the reality is it's a lot bigger than that. It covers a huge amount of players which you're not even aware of. Just a small example of this. The last year when Silicon Valley Bank kind of wobbled, over that weekend I remember, we were looking around to see what could be the impact on India. And the point was Silicon Valley Bank was a favorite amongst private equity players. So there was a sense that maybe there would be, both from private equity investors who have come into India and from those who have received funding from such private equity, they could be having exposures into Silicon Valley Bank. And I can guarantee you many people wouldn't have heard of Silicon Valley Bank in India before that event actually happened. So the point is, we don't know the unknown unknowns, even today. Yes, each of the forts have been strengthened dramatically, so that if the domino effect does happen, at least your domino stands straight. That's the kind of effort that's gone in. Some of the interconnectedness in terms of OTC derivatives, for instance, or cross-border collaboration, there's been a lot of good work on ensuring that those parts are strengthened. But we don't know what we don't know. And as a regulator wearing a regulatory hat right now, my job is to worry.
So thank you. It's very interesting. One, you pointed out that we don't fully capture the network, so that's very important. The second was the Silicon Valley Bank. Silicon Valley Bank was not a GSIB. Yep. So, and yet it had the potential to cause spillovers from systemic crisis. If Fed wouldn't have acted fast, we could have seen a wider banking crisis. Let me turn to Ashu, because GSIBs have caused a lot of pressure on the capital requirements which banks need to raise, not just for GSIBs, but then DSIBs have to raise more capital also and stuff. So do you think these reforms have gone overboard in terms of capital requirement, or is it something which was needed because we want to ensure more stable environment?
Yeah, so Mridul, I think, and I think Anand summarized it very well, I think GFC clearly exposed that a lot of this reform was required. So I think on the whole, while we can quibble about specific elements and what it may have done in terms of some of the risk-taking, private credit formation, market making having gone outside the banking system into the shadow banking system or the private equity world, on the whole, I think the regulator job of strengthening the banking system, no question about it.
So that's coming a thumbs up from the bank, which actually got the largest support from the top, like 34 billion.
I thought I'd forgotten that information, but thank you for reminding me.
6 billion. Okay, fair point.
Yeah,
sorry,
but
go ahead.
So I think the point on the GSIB, and again, in the Indian context as well, I'll mention that, all the foreign banks who operate in India, we have to have that extra supplement. So for me, the minimum capital I need to operate is 15% as opposed to the 11.5%, and I think Hitendra probably has slightly lower because his GSIB is lower. But, does it really impact our ability to operate in this market profitability and add value to our customers? I'd say no. Okay. One, because I think most private banks operate around 18-19% cushion in any case, so I think, and there are enough opportunities in the Indian market for us to, despite that little bit of an uneven playing field,
not let it become a drag on what we want to do in the business perspective.
Yeah, thank you. By the way, I may add that Treasury made $12 billion out of the support they gave, if I have my numbers correctly recalling. But Hitendra, would you like to add anything?
Yeah, no, I want to say one thing first. It's a great privilege to be in this auditorium. I had the privilege of meeting Dr. R.H. Patil when I was a student and studying exactly what many of people in the audience are doing. I never thought then that I had been an auditorium named after him and addressing students. So it's great to be here. I think just in terms of whether the regulations have gone overboard, underboard, you'll never get this right? I mean, you as a regulated entity that is being asked to keep more capital, that means your returns go lower, you'll feel that. But at the same time, having a 10, 20, 30 year run of no run on any bank, you know that that's giving you a lot of benefit. But maybe so what's been the change pre-financial crisis to now, right? So one is for every rupee of asset, you are keeping more capital than you were earlier. The rupee of assets is being defined much more properly. So for some assets, you require more capital. For some assets, you require less capital. So there is a bit more science to this rather than a generic every rupee sets aside the same amount of capital. That's principally one. Types of capital were changed. Earlier was capital as we traditionally understand it. We are in National Stock Exchange, so we understand what capital is, right? The equity capital. But now they have allowed those loss-absorbing capital. And the principle everywhere was, before any depositor gets hurt, let's have a series of shareholders or other investors who can be impacted first, right? And the third significant change, apart from what Anant mentioned in terms of central counterparty and bringing the derivatives mark to market and other things much more transparently, was on liquidity. And I think that's possibly underappreciated because now the amount of liquidity that banks receive as deposits, but we can't lend out, right? That whether it's through LCR, what in India was historically SLR, some form of LCR, but now the idea is that in a stress run also you should always have liquidity so that any withdrawal of deposits can be met. But to sort of the speed at which money moves now, okay, SVB is a classic example. Over the weekend, Twitter, everyone calls it a Twitter-led downfall of a bank. And we have had similar cases in India. I mean, WhatsApp, it starts before you know it, you can keep as much liquidity as you want, but you can never keep 100% of your liquidity available because that's not a business, right? Right now we are doing roughly 1 month of stressed outflows are kept. But so that's the other thing, that on liquidity, the norms have been tightened quite considerably. It's difficult to imagine for large banks now to have a liquidity run in terms of them not being able to meet the liquidity outflows. But given the technology and given that we work, India works 24/7, you can have 10,000 crores moved in the middle of the night. No, so things like that. So yes, it's a safer financial system. Yes, we have more capital. Yes, we have more liquidity. Yes, we have more well-defined assets or RWAs or things like that. But Credit Suisse tells you, Credit Suisse capital adequacy ratio at the time of its downfall was around 15%. Credit Suisse LCR was 140 odd %, right? So, and yet it fell, right? So it's a confidence I don't think regulations can fix. That's the issue, right? How do you fix confidence as a regulation? So it was a crisis of confidence at SVB and CS. So lessons from there, I'm sure regulators are working through on what next to be done.
So that's interesting. I think a very important perspective. He seems to be having the view that probably we are going not even with the LCR numbers we have, we could still face crisis. So what's your view, Neeraj? I mean, we in India have the double whammy of SLR and LCR, and then NFSR also comes in for a 1-year duration. So RBI has already tried to align this. So in one sense, we are a jurisdiction which should be happy that we had a LCR-like instrument even before the global financial crisis. So it has a meaning. But do you think some more calibration is needed there, or is it the right ratios we have?
So thank you, first of all, for inviting me here. You're right to say that LCR was introduced in the beginning and we had a parallel regime of SLR in India. over a period of time, SLR has been subsumed in some senses into LCR from a reckoning perspective. But SLR is still there. I'll give an example. If you're a bank who's entirely funded by retail deposits, typically by LCR calculations, the amount of liquidity that you need to maintain is 10% of your liability base, right? But you still need to make sure that you have minimum SLR being met. So effectively your threshold starts at 18%, which is SLR. Typically bank wants to keep more than the minimum threshold, so you typically end up being 20% or thereabouts. So there is a limit to how much you can optimize your balance sheet for LCR, given the fact that SLR puts a lower threshold on the amount of liquidity that you need to run. The second is the implementation of LCR in India is actually quite stringent in some senses. We were discussing this just before this discussion started, that certain jurisdictions are actually not as stringent as probably India is, and therefore we end up maintaining probably more liquidity than, and therefore the implementation of LCR regime doesn't seem to be very consistent across jurisdictions, right? There seem to be a lot of jurisdictional deviations, or you may say liberties being taken about how the LCR is getting implemented. I think while at a macro level, the fact that intermediating institutions are now required to maintain a certain amount of liquid assets with them to take care of the eventualities of a liquidity stress is absolutely, well called for. But the local jurisdictional idiosyncrasies, the fact that each country has a certain kind of financial system and a certain kind of banking system, how well that is baked into these liquidity requirements, I think that leaves a little bit more sort of fine-tuning and nuancing. So to take an example, in India, for the HQLA requirement, we say that financial institutional bonds are not considered as an HQLA. In India, 70 to 80% of AAA rated bonds are issued by financial institutions. So how do we tweak these differences into national implementation, I think is something that we need to sort of really think about.
So corporate bond is one issue, but what about SDLs, the state government bonds?
That's the other one.
Where you have a clear advantage because Indian jurisdiction is treating it as level 1A.
No, that's the other one. I think we are, it's a government bond. States are governments as per Constitution of India, right? So the point that I'm making is that yes, we have some tweaks here, but there is a lot more that is required from our implementation.
The point is, it's a government bond, but the subnational government bonds are not included in level 1A asset because they don't have the power to inflate. So the fiscal power is constrained for the subnational power because under Article 293 of the Constitution, states just can't raise whatever they want to raise. We are facing this issue across the states. So I would rather reserve my judgment on that, but okay.
No, I think it's also the fact that historically we've allowed SDLs to be part of SLR, right? If we were to exclude them, that would have been a huge transition away from what the banks were already doing, and transition cost would have been a lot more higher, in my opinion, right? So it's a midway, but I would also like to argue that on the liability side, for example, we have today said all financial institution deposits are 100% outflow. Again, that's a very significant chunk of deposit base in the country. In this country, still corporates and institutions rely upon banking system as compared to maybe a developed jurisdiction, right? So these differences need to be a lot more sort of taken into account when LCRs are implemented. These regimes are implemented.
Let's move ahead. This is an excellent answer, but let me come back to Anand, because I think IOSCO of late has been pretty active in suggesting a range of regulatory reforms. And there were a number of other reforms done post-global financial crisis. So I'd like your view, which was the most important of them, and what is the most important which has been happening in last 2 years under discussion, which might come forth or which has already happened recently.
Yeah. I think rather than just IOSCO alone, it's been a combination of bodies coming together. So CPSS, IOSCO, BIS, IMF as well in some ways. That's been the good part, the fact that we've tried to do all these things together in a coordinated fashion. I mentioned to your first question about what's been the big change, what I mentioned earlier about trying to put guardrails around over-the-counter derivatives, making sure that they're centrally cleared, making sure that there are margin requirements when they're not centrally cleared. And then the whole point about trying to move derivatives away from this wild west of O2C into exchange traded, strengthening this exchange itself along with the centralized clearing and making sure that it can stand as a bulwark against any financial instability that percolates from elsewhere. Of course, you could argue that we now have a bunch of large institutions that are simply too big to fail and have to be watched very carefully. But I think improving that architecture so that that transmission which happened during the global financial crisis is controlled is an important facet which has been adopted by ISCO along with other bodies as well. What are they working on and what are we working on along with ISCO over the last couple of years? Lots of things. I think climate is a huge agenda which is there on ISCO's top list. DeFi, decentralized finance and cryptocurrency is another hot topic which is being debated there. More mundane topics like finfluencers, which frankly engages the attention of many exchanges and securities commissioners across the world is something which is high on the agenda as well. And of course, things like, stress tests, cyber risks, which is a huge, if there is one point of concern for regulators, which gives us sleepless night, it's probably that. It's cyber risk, right? Too big to fail institutions to make sure that the level of reserves are very high and therefore the chances of a domino effect kind of percolating is kind of controlled.
Okay, Ashu, very quickly to you about the legal entity identifiers, the LEI reforms which were done. There were reservations by some, and especially the foreign banks, about the LEI issue. Have these been resolved now, and are you comfortable with the LEI regime which has been put into place?
Yeah, so again, as a backdrop, I think again, LEI came in as a way to improve aggregation, transparency, and interconnectedness of exposures, right? And I think now RBI was obviously one of, India, it came in later. Initially, we did have some, not pushback or resistance from some of the subsidiaries of perhaps the multinational companies, but I think it's not an issue. People have fallen in line, everybody gets it. Frankly, I think this is all improving the global systematic, information transparency, especially in a world which is as interconnected as we are right now. So the purpose is clear, and I don't think there's any issue anymore.
Okay. And Neeraj, on the OTC derivative reforms, I think you are the best person to sort of judge. I mean, nominally they have been implemented now. Non-centrally cleared derivatives also have been taken into account. But is it a nominal compliance of the regulatory reforms? What's happening on the ground? Are we safe? Could there be an issue with the market?
So the fact that standardized derivatives, standardized OTC derivatives are now central counterparty cleared, right? That's obviously improved a lot of transparency in that market. And in some senses, to the extent you're required to margin for the volatility of the underlyings, it's also in some senses increased the, I would say, the risk, or reduced the riskiness of these contracts from a credit risk standpoint. We still have centrally cleared OTC derivatives market. Innovation continues to happen. And while there is an attempt to make sure that even in those cases, there is margining between the counterparties, between the large counterparties, I think the counterparties or the banks versus corporate angle is still a little bit exposed. The one thing though that we need to really think through, and I think that should be a matter of enormous debate, is that by doing all this, we have brought the risk in the hands of one or two single entities, which is the central clearing houses or central clearing counterparties. And that is creating an enormous concentration of risk there. Effectively, you have created just too much, too big to fail, right? And if there was an issue there, how would you deal with such an issue? Particularly if one kind of derivatives are just being cleared by one entity, right? So to my mind, look, managing risk is a whack-a-mole game. You manage one side of it, it shows up somewhere else. So you've got to be constantly ahead of the game. I think in some senses, transparency is improved. To some extent, risk management has improved in the banking system, because the moment you start posting margin, you have a different way of measuring the risk. But the risk has shifted from a whole bunch of counterparties into a single counterparty now, right? And therefore, that's the matter that everybody needs to think about.
Okay, this provokes me to ask Anant and then Hiten, because CCPs is a big issue. So Anant, what's your view? Is it going to be hypercenter for the next financial crisis? The CCPs have become monopolistic, big, or are they, because on one hand they seem to be very efficiently working, at least, I don't know if on equity side you do the stress test as rigorously as it is done for the bank-oriented CCPs or the markets-oriented CCPs of debt and all. So are we safe on that angle?
So Mridul, as I said, my job is to worry, as was your job till recently. But let's put things in perspective. And I think Neeraj is absolutely right. There are some too big to fail entities which have been created as part of the solution, the architecture for solution which has come through over the last 15 years. And clearing corporations could be one of them. Let's acknowledge that, and let's then talk about the context. So let's talk about the equity markets in India. And there are some unique characteristics in India which actually strengthen the bulwarks and the guardrails that we have. First thing which we don't tend to recognize or realize enough. In India, our depositories have information at an individual trader level, because our index for figuring out who's doing what is the PAN number, a unique PAN number, deduplicated, right? So unlike the US, where the depositories would be holding on behalf of some broker-dealer, who in turn would be holding on behalf of other participants, and therefore the depository has no visibility as to who the end holders are. In India, we know exactly what every individual is holding and doing in the markets. So our margin requirements, which by the way we are often criticized, that our margin requirements are far higher than global centers. For instance, for simple Nifty futures, our margins are 11%, whereas SGX is, I believe, around 5%. So it's quite high in a sense. But our margins are required to be maintained at an individual level, not at a clearing member level or at a broker-dealer level. So we know exactly what every person has to put up as margin, and we require every person to put up that margin. You have no Peter Paul, Peter funding Paul, or some miscibility happening at the broker-dealer level. And that's being maintained by the clearing corporations and the entire exchange ecosystem. Every day we ensure every person has enough margin for his or her position. That's a huge positive, which in terms of the build-up to our financial stability. Add to that the fact that our margins are admittedly higher than global standards. But that doesn't stop there. Our clearing corporations are required by SEBI to hold pretty conservative, your SGF, your settlement guarantee funds. The default mechanism per PFMI principles are absolutely followed. And our SGF, our settlement guarantee fund, follows the cover 2 principle, which means even if the top 2 clearing members were to fail, we would be having enough buffer built up in the system. Having said that, we don't stop there. These are minimum requirements. Clearing corporations are encouraged to keep even more as required and make sure that there are enough buffers. We do stress tests. In fact, the clearing corporations do stress tests every day. And these are pretty strenuous stress tests, including a 20% fall in the market across the board. We're now also looking at stress VAR as an implementation of stress VAR and looking at what the numbers throw up. And we are constantly reviewing ways in which these buffers can be enhanced even more. Okay.
What about the liquidity support with the CCPs? Are there lines to ensure that? You think that there can be rethink on how to
So as I said,
give liquidity?
The waterfall is pretty clear. It starts off with these, obviously the margins, and then you have excess collateral, then you have capital, then you go to the SGF, and then you have lines of credit possible. So all the waterfalls exist. We encourage CCs to have additional lines of credit, from the banking system, if all of these waterfalls are exhausted as well, or as a part of these waterfalls. But the point is, Mridul, in fact, even last week we had, or 10 days ago, we had what we call the Risk Management, Risk Monitoring Review Committee, which is an independent committee, includes all the market infrastructure institutions as well as some academic people. We're reviewing constantly what is the safety buffers required. And we recognize that there is a too big to fail risk out here, which we have to guard against.
So they can exist in a liquidity crisis without a central bank liquidity support. Direct one.
The intent is to ensure that there is no bailout required. Okay. Now, having said that, I don't think any regulator can ever stand up and say we've covered for all the risks. The balance, of course, is what Ashu also mentioned earlier. We've got to make sure that we are absolutely covered for the worst case that we can think of. Do we want to multiply that by 2 or 3? Then the question of cost of capital comes in. And remember, we are also a capital-starved country, right? So the fine balance of erring on the side of being conservative and making sure that financial stability is top priority, without completely going overboard to an extent that we start to impinge on capital formation, is something that we have to keep in mind. Our job is capital formation. It's not just to ensure that...
That's a big comfort. I think you've more than made us comfortable on this risk. Hitendra, do you think it's fair that some of the global jurisdictions are demanding that they actually scrutinize the books of Indian CCPs, because else the OTC market gets a hit? EU gave us an equivalent status, but then withdrew it. I mean, where do we go on this?
I think I agree with the local regulators here, where they have said that you have to leave some things to our regulatory architecture, the quality of the regulation we will place, as opposed to get an independent right to do an inspection and supervision and including. I think they also have a right to impose penalties, if I remember correctly. So, which is clearly, I can't see too many large markets, right? I mean, maybe if you're very small and your voice at the table is not exactly what most countries, but a country of India's size, with the quality of the regulatory organizations we have and their track record of regulatory, compared to many countries, you would have to say the outcomes would seem to suggest that it's a better regulated market. So with that background, it's very difficult for me to see how a regulator would permit a regulator in another country to have the kind of rights and access and including, like I said, financial penalties, etc. I think it's only right that you have a right to ask questions, and the questions have to be answered in conjunction with the local regulator, and if you're not satisfied, you discuss with the local regulator. Okay. I mean, I'm sure there is regulatory conversations happening around the world. I don't have visibility to these conversations, but it's presumed that they are talking to each other. But if you're unsatisfied with the answers, you talk to the regulator and say, I think you could do a bit more here or a bit less there, and that as a mature conversation would take place. So I agree. I think let's hope that the EU does sort of reassess its current position, because it will only create fissures and fractures in the market. There are ways around, but it's never as good as the what we have in place. So no, the short answer to your question is no, I don't agree.
Would you like to add, Ashu? Especially because
and to be fair, we were not impacted as a US institution, which also is interesting, right? Because you've got only ESMA, which has raised an issue. It was not an issue for the other regulators, which is interesting to note. I think the good news is...
Yeah, but here, the CFTC is bound by the Dodd-Frank, and it's asking the same thing. So hopefully that issue may not necessarily come to fore, but it had earlier. So,
yeah, because at least my understanding is right now the way I think it was going to affect the ability of a European bank to either be a custody player or in fact do trading in government securities was impaired. It wasn't impaired for us. The good news is I think now they have till I think October 24 to sort it out, and I'm hoping it sorts out because there are far too many foreign investors who could get impacted because the custody market is a very concentrated market. And while from a very short-term perspective I could say I'll get market share, it's not good for the system to have such a big impact on the European players. And I think on SCA, I think Europeans have accepted and given equivalence where they would therefore not give or not want to have the rights of inspection of books.
Okay.
So there's some positive sign there.
Thank you. This is good news. Neeraj, what about the benchmark reforms after the Libor scandal? I mean, have they been well implemented? Is it still a concern with the markets? Is the transition still in progress in terms of revising the contracts, covenants, etc.?
So our experience as a bank is that it's gone off fairly well. Market has seamlessly shifted to ARRs now instead of LIBOR benchmarks, both for cash as well as for derivative markets. It's a bit too early to say that whether this is going to prove to be a better underlying as compared to what LIBOR was. Obviously, the issues of LIBOR were fairly clear, to the extent that this is now a traded market that is being used, hopefully this is a much better way of doing things. But also bear in mind that the dominant part of this reform is overnight traded rate, right? It's the SOFR rate which is traded in the US market. So the dependency on that one single market, and if anything was to happen to that market from a disruption standpoint, it will have a big impact across the world. I think that in some senses is a new issue that we need to sort of keep in mind. Also, the liquidity of term benchmarks is not very good. They are still very thinly traded benchmarks, the term ARRs. So it's still being a bit of a theoretical extrapolation of what the overnight is doing. And to that extent, I would say the jury is still out. The LIBOR transition started in June 23. We've not yet even finished 1 year. So we'll have to see how stable this proves over.
Okay, we are running out a bit of time, but let me try accelerating. Hitendra, your comments on the decline in correspondent banking and what have been the drivers? Is it the unintended consequence of the regulatory reforms?
I think it's partly to do with the fact that I think the expectations, especially on financial crime risk management, have gone up a lot, right? So if I am processing certain transactions which are sent to me by a customer of mine, then I already have a very detailed level of CDD, right? And therefore I can understand why the remittance is coming in or coming out. But when you're receiving funds from another bank, then you're depending on that bank's standard of CDD, right? So you will find, therefore, many small banks in whichever part of the world, but when they want to have an arrangement in another part of the world, the amount of due diligence that is done. So I think you do find that global flows are moving more and more towards a bunch of, let's say, 50 odd large banks. And that's, I think, partly my understanding of why the flows through intermediated, why processing of flows by one big bank which came from another bank have come down. While the focus of the financial crisis was lot on capital and liquidity, etc., I think there were other incidents which were happening in the background where there was a question mark over KYC and what we call AML and PMLA, etc. So I think it's a mix of all of that which has come together.
Fine. Ashu, very quickly, would you like to add something?
Yeah, the only other perspective I'll have is, I think ultimately we serve for our clients. Our clients are not going to not be or not continue to be global, right? Global trade will carry on. Superimpose that with the fact that I think increasingly the banks, especially after the financial crisis, are becoming more and more focused in what businesses and geographies they want to work in. So the Italians going back to Italy, Nordics, I mean, it's just a way to play on your strengths. So I think the need for correspondent banking, I just don't see how it goes away. As long as there's global trade, I mean, for us, we're in 100 countries. That's a great platform for anybody to have because nobody wants to replicate that kind of a thing. Now, you may go from paper-based clearing to digital and all of that, but I don't think correspondent banking's requirements will change as long as customers of ours are going to need to trade globally.
So let's turn the focus on to the digital innovations and the use of AI. Is there worry from both the bankers we can first hear, and then we'll have Anant giving the securities market perspective? Yeah.
No, I think it's a subject which you can't stay away from today. I think it's impossible. It's impossible to spend a week and not be invited or be part of some of the other artificial intelligence conversation, discussion, seminar or whatever. I think most of us are artificially knowledgeable about this, to be very honest. I think, so it's a subject you want to remain very close to. It's clearly not at a place where you can, at least we don't think we can start exposing consumer data to it, right? I mean, we will expose our credit policies. We are in the process of getting our engines to ingest, and then therefore the internal staff, if a customer calls, do you do this or not? I mean, I'm just oversimplifying it, but and then the answer is very fairly, and this could be 10,000 page documents which you're ingesting into the system, so that, and similarly, we are thinking in terms of contact center and things like that, where it's a low risk. But beyond that, I think we are currently being very cautious in terms of what kind of use cases, what
time, and I haven't touched climate finance, but let me open the floor to the questions, because we can have 5-7 minutes of questions now. And, yeah, Professor Ashima wants.
Great to hear all of you. Yeah, you know, this has been a big test of financial reforms, the post-pandemic period. And especially after SVB, a lot of banks were expected to fail in the US and so on, but it did not happen. So is it that regulation, because the other thing we heard was that banks have withdrawn from money markets, so liquidity is very tight, it's a potential risk. So was the lender of last resort necessary? Did that help? What kept the system stable? Was it reforms? Was it lender of last resort? What was it?
I'll just add my perspective, and please, others should add on. I think one of the things, Ashima, was I think these SVB or First Republic, they were very narrow business models. And I think that's what, and we talked about CS as well, you can regulate the hell out of everything, but ultimately, if people have overly concentrated business models, obviously some regulation which was relaxed, which did not, for example, mark to market a lot of their government security portfolios. So it was, I think, a mix of both. What I think helped was how quickly the US regulators moved to stabilize the system. With the result, none of that spillover happened.
Yeah. I'll just add to what Ashu said. In fact, this is a question I'd love to pose to you, actually. But having said that, beyond SVB, even when the onset of COVID happened, and we had that initial shock in March, beginning of April 2020, the speed of reaction from the regulators and from the fiscal authorities across the globe, and across the globe that mattered, was really swift. Compare that to what happened in 2007, 2008, where frankly a lot of people were caught like deer in front of the headlights and took that time to kind of react. So there were lessons learned from, I think, the previous crisis, that there is need to react quickly. You could argue that the error that was made was we probably overreacted in some ways by pumping in too much money and keeping it on for too long. But it wasn't the same error which was made of not reacting quick enough. The second, I think, what we discussed, which is the bulwarks and the guardrails built since the global financial crisis, of having very heavily capitalized banks, of having had, critical market infrastructure institutions such as clearing corporations adequately capitalized and adequately having safety buffers. I think all of that really helped, not just in absolute terms of giving that resilience, but also giving that confidence to the ecosystem that things are under control. Having said that, we should also count it as part luck. This doesn't mean that we don't have to worry about the next big crisis which would come over the next 5, 10, 15 years.
Hello. I would firstly like to thank all of you all for your precious times and wonderful insights. All of you spoke about using AI in your businesses, but there's one more question that I'd like for you to answer. Do you think AI poses a risk in terms of KYC, with digital KYC being present? Like, for example, I'm sure all of your banks have exposure either directly or indirectly to, let's say, two-wheeler lending, where KYC is not as extensive, and a lot of these NBFCs give out loans digitally through online KYC and disbursing the loans like instantly in 2 minutes. So how do you think AI is a risk that you might have to face there? And if so, then how do you think that could be tackled?
No, I think what you're saying is right, but definitely as a bank, when we undertake any kind of lending, whether two-wheeler or unsecured or whatever, the KYC standards don't get diluted. What we are learning, however, is that people do use, so there'll be an applicant named Mr. Dave, but you see the image and then you realize that there's something wrong in the image, and therefore, some technology, our technology team, partner will say, okay, look left, look right. So you do all these, you learn from the very people who are trying to sort of, get through the cracks in your system. They have artificial intelligence. The good thing is we also have artificial intelligence, right? So it's not like they only have it. Now, who's smarter and who does this better and who's constantly focused on this? But overall, at least in the context of India, with the multiple checks you now have on KYC, right, through the digital public infrastructure, etc., the risks are lower than what they were. But you know, whoever wants to take the money in the wrong name will try every trick in the world, and it is our job to keep learning from the common tricks. I think I know there are plans afoot to have a common database of all the bad mobile numbers, for example, or the identified laptops, etc., from where the wrong applications keep coming in. So, you know, they will be one step ahead of us. Hopefully, you know, we will not be too far behind them, is what I would say. Thank you. Thank you for the question.
Can we take question?
Hello. One question from there before I close it.
Yes. Hello. Do you want to choose the question, or should I?
Sorry?
Do you want to take a question from the line?
We are running out of time, actually.
Hello.
Yeah.
Can I?
Yeah, I have a question. I have a question to Anand sir.
Yeah.
Sir, in India, we have a fairly well-developed equity market. I mean, on the cash and the derivative side. But when it comes to non-equity derivatives, whether it is interest rate derivatives or FX or commodities, despite these products being there on exchanges for almost 15, 20 years, has not developed. So what could be the possible reason? Because as we aspire to become a 10 trillion economy, obviously the risks are also increasing in the system. So how do we go about it?
Probably is a question better answered by the three bankers here, especially Neeraj and Hitendra. Look, when you talk about FX and interest rate markets, they continue, I think, to be dominated by the OTC markets, right? You have a very well-established OTC market ecosystem, which is offered by banks and RBI regulated entities. So when you talk about things like currency swaps, currency options, interest rate swaps, cross-currency swaps, there is a thriving market under ISDA, under margin, under CSA, which actually operate reasonably well. And I think in the case of currency and interest rate hedging, for instance, a lot of the requirement is bespoke. You know, you have a specific cash flow for a specific loan that you want to see hedged. It's easier to hedge that through OTC specific bespoke structures than using an off-the-cuff, off-the-line standard product on the exchanges. That could be one reason. What at least I've learned over the years is that if there is a strong market requirement which sustains over a period of time, things will happen. Equity markets, derivatives have developed over the last 2-3 decades because there was a requirement for market liquidity, price discovery, hedging, and all of that. OTC markets have developed here. If there's a need for them to converge, they will happen as a matter of time. I wouldn't fret about the lack of activity in the index, even though the exchanges might have a different view on this.
So we had a lot of OTC questions also. So you have exactly, we have covered that a lot. So let me sort of leave that. But there was this question about basically what event can cause a crisis. So at the end of it, if a short one, because we have run out of time.
Can I please? Hello. Thank you very much for giving this opportunity. Giving me this opportunity. So this is a question, little different type. As an investor, I would like to know from SEBI, especially from NSE, BSE and SEBI. So you all give importance more to the analyst or to the investors? Because when a company is coming out with an IPO, initial meeting, initial gathering, when they make, analysts are given more importance. While we investors, we face too much of a problem in knowing that company initially, which we would have done it before IPO comes out.
Let him very quickly answer this.
So maybe, ma'am, we can have a chat outside as well, offline. But very quickly, SEBI's job is to ensure that adequate disclosures happen with respect to any issue. We don't opine on whether the pricing is right, whether the issue is right. Is to make sure that the disclosures happen adequately.
No, we would like to know whether the company is financial stability is good, how much they are in debt. What is it? As an investor, we would first like to focus on that.
See, I would say as an investor, you also need to do some due diligence.
I will also, no, I don't want to duck that question. It's a good question. I'll give you personal advice. It's not SEBI advice. It's personal advice. The data that we have seen in SEBI indicates that the retail folk who come into IPOs are frankly flippers. Who come in, flippers. They come in and get out immediately. let's face it, IPOs are risky. No, if you ask me personally, I'm not saying as per SEBI, because as SEBI doesn't have a view. But personally, I would strongly recommend, if you're a retail investor who doesn't understand markets as much as you would like to, please wait for the prices to stabilize before you enter.
Correct.
Right? And that's a personal advice I would give, not a SEBI, to everybody. Having said that, specific to disclosures,
Thank
etc.,
you.
very happy to have a chat.
This is actually a very honest answer. Please, we have to stop this now because we have run out of time. There was a question about what potential event might cause a crisis ahead. So my last question, very in one-liners to all the panelists, when would be the next crisis and what would it cause it?
I have absolutely no idea when will be the next one, but clearly it looks like, basis everything we see and do and read every day, the source of it is more likely to be from outside India than within India. That's my only comment on this question.
I tend to agree with Hitendra very quickly. So one of the discussions that are happening in ISCO, and by the way, we're talking about unknown unknowns here, so who the hell knows, but one of the discussions we're having in ISCO is around private capital and private finance. The size of that market has become extremely large. It's $13 trillion in the US. In India, we don't allow leverage, etc., so there are checks and balances, but globally there are lots of ramifications. And it has a lot of the features of that derivatives had pre-crisis, opacity, people celebrating the fact that it's opaque and let it be as it is, which I think is a little worrisome. And the size is not small. $13 trillion is definitely not small. If there is one area I would personally pay attention to, again, as individual, not as SEBI, it would be private finance.
I actually agree. I mentioned the word shadow banking, but I think so much of the activities have moved into the private markets. Obviously, banks have exposure to private markets. Some of it is leverage. It's not transparent. Also, the banks have, a lot smaller in terms of market making. So when changes happen, volatility happens, it will be a lot more accelerated in terms of impact on prices.
No, I agree with you. I think that domestically things are looking far more stable. And internationally, besides private markets, I think geopolitical risks clearly are something that one needs to watch out for.
Thank you, everybody. I mean, this has been a wonderful, wonderful insights from four very distinguished panels. I think we need to start the next session.
We'll have the felicitation. I call Dr. Tithankar Patnaik for felicitating our speakers.
This wouldn't take long.
Thank you, sir.
Spices, not spicy, spices. This was a discussion full of spices.
I suppose they would want a photo. Yeah. Come closer. Come to the front. Yeah.
Yeah, please be seated. We'll start the next session. We have two lectures. The first lecture is by Dr. Ashima Goyal, Professor Emeritus at IGIDR and member of the RBI's Monetary Policy Committee. In emerging market economies. Ma'am, may I request you to come on stage?
Can you hear me? Yeah. So I'd like to thank Mridul for the invitation and to congratulate IIM Kozhikode for setting up this new Center for Research on Banking and Finance. I think there is it fills a real need because in India the analyst landscape has come to be dominated by those associated with financial institutions. And while that is very good, that there are so many analysts, it really contributes to the richness of the discussion. But in financial institutions, the main concern seems to be forecasting. And while I think more academic or at a distant analysts focus more on explaining why. And that explaining why is important both for market-based analysts to improve their analysis and for policymakers to improve policy. So I wish the institution all the best, and I'm happy to participate in the inaugural conference. I'll be talking about external shocks and the kind of risks we've been discussing in the previous session. And from the emerging market perspective, what I want to emphasize here is that there is a reversal of roles. Earlier, the kind of global shocks, we were talking about which will the next crisis be. Global shocks originated in emerging markets. Their financial sector blew up, the exchange rate crisis, something. But over the past 20 years, there is a role reversal here. The shocks have originated in the advanced, the developed capital markets. And emerging markets have been at the receiving end and have had to respond to this. Policy, my view is, has an important role to play in moderating the impact of the shocks. But the unfortunate thing is that most of the advice is still caught in a time lag because it seems to come from the perspective that the emerging markets are the source of volatility and problems and they need to improve their shop, so to speak. And that misses important degrees of freedom, which I think our policy over the last post-pandemic period has really benefited from. So I'll try to illustrate some of this. Starting with some research I've done with some students. I'll give you the details later of the references for those who are interested. But in this much time, we can't do very much. So these are rigorous sort of panel database for emerging markets, 8 to 10 emerging markets over more than a dozen years. And what the chief results you get from this is that there has been a change in cross-border flows from cross-border loans that dominated before the global financial crisis to what EDS, emerging debt securities. And that this EDS and their volatility is influenced more by global volatility, the VIX, rather than monetary policy. So here in a lot of discussion, we see focus on the Fed and what the Fed is doing, while it's global volatility that seems to affect these inflows and their effects on us more. Therefore, and also a very important result for us is that the spread, the EMBI spread, rises with domestic inflation. So domestic variables are important. Also, exchange rate volatility has a major role. And it falls with growth, with better macroeconomic stability. And therefore, another paper we have, the last line talks about this, looks at the importance, finds that just plain Taylor rule is not as efficient in welfare terms, or even augmented Taylor rule, which brings there is some problem, so you don't have to raise interest rates in general. So it's a substitute for that and allows policy to achieve its outcomes to improve stability at less cost. Another set of papers I have with Kritika Banerjee is on the determinants of real misalignment for the exchange rate. And here we test a whole lot of domestic EM variables, fragility, etc., mercantilist motivations, as well as the quantitative easing, etc., high liquidity cross-border flows, which originate from emerging markets. And we find, with a lot of robustness tests, etc., that portfolio investment flows do cause a lot of the overvaluation, and that the spread risk premium is important for spread again, rather than interest rates or monetary policy. And some mercantilist variables as a motivation for exchange rate intervention were important for some countries, only Russia and China. So again, we see the dominance of cross-border flows, and risk premium has a larger effect than monetary policy. So this is just highlighting some of those results. Of course, this is just the key, which we have been discussing, a lot of control variables and so on, which are dropped in this table. But you see here that when VIX is high, the impact on EMBI spread is much higher. The second row shows that. And you show the large, significant impact of the exchange rate change on the risk spread. So since the global financial crisis, this causality from advanced economies to emerging markets, while and World Bank careful research over a large range of countries, as well as our own, which focused on 8 to 10 years, shows that for emerging markets, growth was much slower in the 2010s, this period after the global financial crisis. And this global volatility affected capital flows and financing conditions. There was overreaction in effects on flows, on all sorts of financial sector. There are all sorts of financial fragilities in advanced economies especially. But my own view to answer the question I asked is that the lender of last resort, they continued with quantitative tightening, but made a lot of liquidity available to a range of the financial sector wherever there was any trouble. The interest rate risk that affected a lot of banks in the US, not just SVB, really helped. Now, what can emerging markets do? So what we have been doing in the MPC or emerging markets in general is keeping the natural interest rate, the interest rate near equilibrium, and responding to domestic variables such as inflation and growth. And this in India required the spread with US rates to narrow, as the US Fed raised rates more steeply than we did. And we got a lot of worry from Indian analysts who tend to be very focused on the US and on maintaining spreads with the US. But our experience suggests that interest differentials do not really matter that much in the Indian context at present. I flag both these I flag, and I'll explain why. Now this shows the spread in repo and 10-year G-Secs over the US corresponding rates. And we see that it's falling through. The spreads were at the narrowest in the latest period after the US rate rise finished. And our rate rise was just half of that. But we began from a higher level. So, but in the same period, you see those blue spikes, and the red spikes are debt. You see that we see that there was a very large rise in inflows in this period when the interest differential was the narrowest. So again, the focus on interest differentials by analysts in India seems the evidence suggests it is misplaced. So do we have independence from US interest rates? There's a basic text equation I do, and I'm very happy to see so many of my students here. And they'll have seen me discuss this equation in class, the UIP. The interest rate in India is linked to that in the US, plus expected depreciation and country risk premium. So, and this research we just reviewed in the first slide suggests that this risk premium and exchange rate change matters more than the US policy interest rate for volatility, foreign flows into India. And in India, we have more independence because this country risk premium is coming down. One reason is our carefully sequenced capital account convertibility. So the capital affected by interest, when I said in India and at present, the US and Japan is really affected by interest differential, UK, where there are absolutely no barriers and the share of debt flows is very large. So when India reaches that, we will also be sensitive, but not at present. The share of capital affected by UIP is small. It's less than 6% of the domestic market. That is one of the caps in existence at present. And as Indian macros become more stable, the risk premium is falling. Our interest differential is much lower, with the US much lower than they were historically. Growth is more stable, increasing size, economic diversity. And moreover, timely support, reversal, and reforms in the post-pandemic period actually reduced this interest rate spreads also. Financial stability improved. Banks were regarded as very vulnerable, but NPAs came down over this period. We saw stock markets become much more, I'm in the home of the stock, one of the major stock exchanges. So we saw volatility. Earlier, in any time of crisis, you'd see large outflows and markets would crash. This time, this was an opportunity for domestic players to come in, and that made the whole thing much more stable. And overall, an emphasis on corporate governance and transparency, disclosures. Again, some of the reforms Ananth was talking about, the kind of information they have at the individual PAN level, the margins and so on. All that made our markets very stable. Another thing that has increased our degrees of freedom or made us less vulnerable to these outflows is that in absolute terms, these outflows are very large, the first graph we saw. But as a ratio of GDP, they're actually falling. As our GDP rises, that means that the absorptive capacity is much higher now. Please tell me if I have 5 minutes left.
10 minutes or so.
Okay, great. So apart from keeping the interest rate near equilibrium, an equilibrium determined by domestic growth and inflation, the second policy focus is to keep the real exchange rate near equilibrium, because we have a current trade deficit, and the exchange rate must be competitive so that we can export enough to cover all our import requirements for oil, etc. And moreover, reducing the volatility of the exchange, nominal exchange rate now, is important, we saw, for reducing that interest risk premium and interest spreads. There are much research on this, which shows that the UIP premium charged to emerging markets is on average 3%, and it's an excess return to markets because actual depreciation is much less than this. Again, there's a policy brief that talks about this. And this UIP premium, emerging markets have to pay more for excess volatility, which unfortunately is due to advanced economy policy overreaction, QE, QT, etc., etc. And the textbook prescription is that under inflation targeting, you need the exchange rate to be flexible to absorb shocks. And the exchange rate will depreciate and then appreciate back towards equilibrium. In emerging markets, it does not happen like that. You'll have one-way movements. Yeah. So this policy, textbook policy, does not reduce spreads in emerging markets. And raising interest rates to defend the currency, which is sometimes advocated and was tried in 2013 in India, only raises risk premium. So what is required in emerging markets is to use multiple instruments to reduce volatility, risk, and spreads. there is work on resilience recently after all these crises, this particular period of, as I call, pluri-crisis or poly-shocks, is that central banks should target risk premiums to reduce interest rate spreads and risk in the financial sector, not only in emerging markets, advanced economies also. And unfortunately, this is exactly what India was doing in the foreign exchange market, the Reserve Bank was doing in the foreign exchange market, where our large foreign exchange reserves were used counter-cyclically for the first time. I remember in 22, we got so many queries, people were so worried. They're happy when reserves are rising, no matter how high they go. But even a little fall makes them really worried, and they think disaster, we're going to be, so after all, if you accumulate any buffer, it's meant to be used. It should go up and down. So, as I said, the fall in rupee volatility reduced Indian forward premium, really fell. The figures are here. But still, some volatility is good for markets, and it helps them in price discovery, because this intervention is only to prevent excess volatility, not to find the price or to fix the interest rate, exchange rate. But if there's overshooting and persistent overshooting, it can lead to deviation from this competitive equilibrium real exchange rate, which is required. And this excess volatility itself hurts exports and widens the current account deficit. But unfortunately, the IMF has labeled India in this period, Indian regime in this period, as a stabilized arrangement and not market determined or whatever. Now, this is absolutely not correct because, first of all, you can't make this kind of label based on a one-year period. This was a period of large inflows which would have strengthened it above the equilibrium level. And international institutions provide very little in terms of safety nets to emerging markets. And so this is that policy mindset. They assume there are problems in emerging markets. They must follow the most conservative policies, while the US Fed should follow whatever maximizes their growth. Emerging markets can't do that. So the advice is for the most conservative policy set, and it wants exchange rates to float. That means you just follow the US Fed. You don't think independently on your own policy. And we've had episodes in the past, although the exchange rate is market determined, 1 or 2 years in the past, also the volatility fell during periods of large inflows. One of these periods was after the GFC. So for a short period, if the volatility is relatively lower than it was historically, there's more intervention. That does not mean it's a stabilized or it's not a market-determined regime. So this shows two different bases, the real effective exchange rate and how the real effective exchange rate around 100 is a value that is near equilibrium and that is good for the trade. And we were at that level, and therefore intervention is required to keep it at that level. One of the policy successes in this period was because in the 2010s, when our exports really fell, there was real appreciation. So what are the consequences of policy choices? As I said, one of the reasons we had this degree of freedom, apart from improving size and diversity, was the choice of gradual capital account convertibility. For example, Indonesia, again in the 2010s, there was a huge push from international institutions saying that a lot of money wanted to come into emerging markets, the local currency bonds. You will not have the currency risk, you should allow these to come in. And Indonesia did that, and their share of foreign money in the bond market went up to 40%. India was at 4%. And they were really affected by the taper tantrum in terms of interest rate volatility. Similarly, today, while we were able to determine our own repo, they had to follow the US Fed much more in its tightening. So you lose degrees of freedom you have to keep those degrees of freedom and use them in order to be able to respond to domestic needs. So of course, I've said that policy was successful, but we must all recognize that there are huge risks that continue and you have to be really vigilant. Risks in India really suffers from a lot of volatility in oil, and even this is to do with some deregulation that created a lot of volatility in oil markets. deregulation of the Global Future Commodity Market Act in the US in the 2000s. This graph will show you how volatility of oil prices really increased after that period. And again, this is something that emerging markets suffer, the lack of regulation or the kind of deregulation that is there in some advanced economies that are dominant for the world. Other risks for India include food prices, climate change, agriculture. We need to diversify our supply chains and do much more over there. Given that we have natural geographic diversity, we can take advantage of.
We are almost about to.
Then using buffers strategically, which we've done, building buffers and using them. So resilience requires that policy should be balanced, not textbook or extreme. Some flexibility is really required for India's own huge complexity and diversity. And it is possible to smooth external shocks and to differentiate macroeconomic policy if reforms and policy maintain degrees of freedom and use them. Thank you.
Thank you, ma'am. Next. Institute of Economic Growth and former RPI MPC member. His lecture is on debt flows and sovereign debt management.
Here. So since I'm an academic, I think our job should be to produce new research and show it to you. So that's what I'm going to do. And but the motivation where I'm coming from is, the first motivation is that a lot of work on spillovers, on global spillovers, tries to understand how unconventional monetary policy is the source of these spillovers. And the question that this research asks is, what impacts does it have, of course, on the real economy, but what asset prices does it affect, right? So we know that unconventional monetary policy leads to a lot of base money expansion. Whether broad money increases as much is not clear, but it affects real estate markets, it affects the term premium, it affects the most important asset price in international finance, which is the exchange rate, the stock markets, and the risk-free rate, amongst others, right? So that's how one would think about the spillover impact from unconventional monetary policy when advanced economies are stuck at their zero lower bound and they have to enact expansionary fiscal policy and unconventional monetary policy. And the second question is, and the flavor that I've been getting all morning is that these spillovers are a cost, they're a source of fragility. We need to think about some arrangement of capital controls, appreciation of the currency, reserve management. Is how do EMEs get impacted? Now, one interpretation could be that if EMEs are at full employment and have current account surpluses, then that spillover, which leads to an appreciation of a currency, may actually be beneficial, because that appreciation leads to less export prospects, and from the trade channel cools the economy down. So that's one way to think about the impact of spillovers, is the source of the spillover, what asset prices it is affecting, and how EMEs stand to either gain or lose, right? But in this discussion, what is missing is the spillovers, and I think this is kind of a post-COVID phenomenon, that will stem from attempts from national economies to reduce public debt. And how these spillovers are going to impact EMEs. And that's the flavor of what I want to talk about today. And within this sphere, I want to propose an alternative calculation to the average maturity of Indian public debt, using the market value of public debt as something else that market participants may be looking at when they assess the fiscal fragility of a country or fiscal headwinds of a country. And let me just say at the outset that I also think part of this exercise and part of my desire to want to speak here today is also driven by the fact that because we've had a long period of accommodative monetary policy, I think there's a complacency that is set in national economies to reduce public debt. And this is to kind of push this research, so to speak, in that sense. Okay, now, spillovers refer to, the international repercussions of domestic policy choices. And this stuff is known. We know sovereign debt markets are central to the macroeconomy. Spillovers can have significant wealth and risk effects. And international capital flows to sovereign debt markets have grown in importance. So India has recently been included in global bond indices and the JP Morgan global bond indices. By the way, there's an interesting thing there, because there's a 10% cap on each country in that bond index, right? But it could be that if a particular country's bond increases in value, you would actually be in excess of that 10%. And then the way the global bond index works is that you would have to rebalance. And passive institutional mutual fund investors would then, who are replicating the index, would also rebalance. And that may actually lead to a source of capital or outflows or inflows into particular country bonds. So in this whole issue of identification, these are what are called informationless capital flows, because they're essentially stemming from this rebalancing that needs to be done in the global bond index to make sure that every country is at that 10% cap. So that's the exogenous event that drives this analysis and trying to understand what happens. But what this research kind of shows, of course, India is now going to be part of it, and I think they'll slowly raise it by 1% starting in June, if I'm not wrong. What it shows for countries who are already part of these indices is that capital flows by passive mutual fund investors do actually spill over to the exchange rate market and leads to an appreciation. But as you all know, in government securities, most government securities in India are now at the flexible FAR, right? It's the free accessible route, or the flexible accessible route. So 5, 7, and 10, 14 are FAR, and I think the 3-year may not be, but many of them are. Now, capital flows to EMEs, excluding China, have grown. And if you look at the orange kind of peach color, that's debt FPI. That bar has grown. And this is capital flows to EMEs excluding China, because China kind of swamps everything. But both debt FDI and debt FPI, the yellow and peach bars, are much larger. So this is something that, that we want to worry about. And the idea here is that, and this is just drawing from research, not that I've done, but which is Ashima has done and others have done, that growth differentials and domestic term premia are, so when you're thinking about push and pull factors, are the predominant pull factors driving capital flows to India, and global risk aversion appears to be the major push factor. And this is just a similar graph looking at capital flows to EMEs, but the point I want to emphasize here is India is this kind of turquoise blue thing here. On top is that the share of India in EME capital flows is still about 13% of all EME capital flows. So it's not large, but it is large, but it's also not large. And even here, I think in India we've always had this hierarchy of in terms of capital account liberalization is thinking about a hierarchy where we've always deemed FDI to be better than FPI, and we've deemed equity to be better than debt. And one of the things I want to propose is that maybe that hierarchy is possibly not that valid anymore today. Okay? Okay, and then here are a set of other graphs. I'm sorry, this is not very clear, but again, it looks at India versus regional peers, and looking at capital inflows and volatility. Our average quantity inflows for FDI volatility is not very large. For portfolio debt, it doesn't tend to be that large. For portfolio equity, it tends to be larger when you compare to other Asia EMEs. And that red little diamond is the India diamond. And then if you look at non-resident capital flow volatility, again, FDI is the lowest, portfolio is slightly higher. And then, of course, if you look at quarterly average capital flows, percentage of quarterly GDP, debt flows are fairly small. So portfolio equity and FDI is about 2.5% of GDP, and debt flows are about 0.5% of GDP. So they're much smaller, right? So one rule of thumb could be that the amount of reserves that you want to have are a quantum that covers these, right? That's a very risk-averse approach to looking at it, but that could be one approach that you quantify these different flows and you say you want to cover it by having these many reserves. And then in our, again, this is not work I've done. I borrowed it from Goel and Novikova. I have a nice paper here showing that India's FDI restrictiveness has begun to come closer to the OECD average and doing slightly better than the EMDE averages as well over time. So it's slowly beginning to. And then here's an important point is that the upper limits on foreign portfolio investments in different types of bonds have been increasing over time, but there's unused capacity in these buckets, and those have slowly been declining over time. And this is the thing about capital controls. They don't bind until you actually meet the caps. So the argument that it's a proxy tax doesn't really hold because you're not really filling the cap, right? And I'll talk later on about the efficacy of short-term capital controls versus long-term capital controls. The view in capital controls is that because you have pecuniary externalities from financial flows, capital controls act like a Pigouvian tax to prevent these externalities. So you have unutilized capacities in different buckets, and these buckets' upper limits have been increasing over time. Okay, now, so that was the first motivation. First motivation is to basically say, look, we tend to think of global spillovers as being driven by unconventional monetary policy. I want to propose, and this is also work in the academic literature, that we are now going to begin to see global spillovers stemming from fiscal simply. So you have a country that, let's say prior to COVID, decides to expand fiscal policy. So it's governments. You all know that should be a boost to GDP, and that should raise output, and output caps begin to go up. And as inflation begins to go up, central banks respond by raising the nominal interest rate. But here's what is key here. The real interest rate doesn't rise. We typically argue that, if nominal interest rates rise and prices are sticky, then real interest rates rise. Because that fiscal expansion, the original fiscal expansion, comes in announced with a future consolidation path, market participants anticipate that this fiscal spending is going to be reversed in the future. So the immediate impact effect of this rise in government spending is to reduce these long-term real interest rates. And the reduction in these long-term real interest rates, despite an increase in the short-term nominal rate, induces consumption and investment and absorption to increase. So what you get is a bigger boost in output because the initial impetus was a rise in G, but now you have this increase in C and you have a higher increase in I, and so you get this boost in output. So now income has gone up more than the initial fiscal stimulus. And then because income has gone up, import demand from other countries go up, so that gives a boost to other countries' exports, that forces them to raise interest rates, that leads to inflation. But the key thing here is that because real interest rates fall, you see a depreciation in the currency of the country that has enacted the stimulus. And because you see a depreciation, a real depreciation in the country who's enacted the stimulus, you see an appreciation of the EME, who's at the other end of the thing. So this is the spillover and the mechanism through which we're possibly going to see an appreciation as countries begin to fiscally consolidate. This is possibly one way through which it'll happen, and it'll happen through other ways too, but this is one way through which an appreciation happens, is because these other effects kick in due to the endogenous dynamics of global interest rates. Now, I just want to mention that since the adoption of flexible inflation targeting, the volatility across a bunch of components in India has gone down. For one, the institutional framework is much more clear for market participants. People understand what the central bank is doing. There's an MPC, there are minutes, MPC members communicate their views, so market participants understand it. And so credibility premia rise. And one way of actually seeing that is in the 2018 interest rate cycle, when the MPC was raising interest rates, and I think the 10-year GSEC at that point went up to about 8.5%. Now in this cycle, you see the 10-year GSEC going to about 6.5%. So for a similar magnitude rise in the policy rate, you see a lower increase in the 10-year GSEC, reflecting the fact that there's a credibility premium that market participants attach to the fact that there's flexible inflation targeting. And while the RBI curbs flexibility in the exchange rate, and of course the motivation for central banks to intervene in exchange rate markets is to reduce volatility, excess volatility, it has not fixed the exchange rate. So it does allow the interest rate differential to therefore predict the behavior of where the exchange rate is going to go. Okay? That's important to appreciate. Now, going back to the public debt story and my argument that we need to worry about the size of public debt and what the spillovers are going to be when countries begin to consolidate. Now, this is India's debt to GDP ratio, and this is based on recent work. It's a carefully kind of crafted series, but we see this rise starting around COVID, and this is aggregate debt. This is general debt. So this is central debt plus state debt, and it goes from about whatever 60, 70% of GDP to about 85, 88%, and now there's a Fiscal Finance Commission announced a glide path and so on. And then most of the financing of the fiscal deficit is from market borrowings, and this is kind of a time trend of it. But here's how I want you to think about the average maturity of debt. The government budget constraint, and I'm sorry to throw an equation at you, but I have to. The government budget constraint is this equation on the top. And it's met by three different things the government can do. The ST plus J is the primary surplus, right? It's just G minus T. So if the government basically, let's say, cuts government spending, right? So government spending goes down. What will happen to the primary surplus? The primary surplus will go up, right? Right-hand side goes up, and it can be met by, or if the government spends more, then the primary surplus will go down. Let's take that example. Suppose the government spends more, primary surplus goes down. It can do two adjustments to the left-hand side for the government budget constraint to meet. It can basically inflate away that action, right, by raising P, or it can change Q times B, which is the maturity structure of debt. It can issue more dated securities, it can issue dated securities in some buckets, but as it begins to increase the supply of that paper, that's going to affect the price of that paper. So it can alter the maturity structure of debt without inflating away the impact of the reduction in primary surplus on public debt by changing the maturity structure of debt. But that's why it is important to therefore capture the average maturity of debt. And this just shows that over time you see issuance in higher buckets. So I think now there's a 50-year Government of India bond. By the way, in all these things, a form of subtle capital control is that they're withholding taxes. So, and that's a hassle for FPIs, and they get it back, I think, when they file returns. But these are all parts of it. But you see, moving the red lines, the red dotted lines, as it moves up along the vertical axis, is essentially showing that there's been far more issuance of dated securities, and this is based on granular data that we've calculated from using RBI's sources. So to highlight this approach, this is the approach that calculates the average maturity of debt. So we have all central government securities issued from 2000. We break these into zero coupon bonds. we have the principal matrix, we have the coupon matrix, so we have total payments. Total payments just means this, that in every period we know that some security is either the principal is being paid back and the final coupon period, or if that principal is going to be paid back, paid out 5 years from now, there may be coupons being paid now. But in every period, there's some obligation by the government through coupon payments or principals, so we calculate that. So you get a coupon matrix, you grab the yield to maturities, right, from the yield curve, so you're able to construct prices, and then from P, for those prices, you're able to calculate the market value of debt. So the Holland-Sargent approach is important because it looks at the market value of debt. When we calculate average maturity using the status papers or the status reports of the Ministry of Finance, we're just looking at the face value of debt. We look at a particular bucket divided by the total face value, multiply it by the year it is due, and then we add the face value over total, multiplied by, let's say, 2-year issuance, and so on. But in the Holland-Sargent approach, you're capturing all obligations due in one period, all principals and all coupon payments divided by the market value. Now, if the central bank is running accommodative monetary policy, which means the risk-free rate is low, then the market value of debt will be high. And if the market value of debt is high, then obligations relative to the market value of debt will be low. But anybody who owns a government bond, which has a rising market value, may want to sell it to make a capital gain. And that raises the rollover risk. And therefore, that gets reflected into declining average maturity of public debt in a way that face value calculations don't incorporate. Okay? So we've done this exercise, so I'll just show you what we get for the average maturity of debt. But in the decomposition, what we get is that the nominal returns on marketable debt, so in the top thing, 2020 to 2022.
Professor Ghate, we are almost about time.
I have 2 minutes, maybe?
Sure, go ahead.
Okay, market value in 2000 was, central government debt was about 19.7% of GDP. And in 2022, it went to, this is just central securities, not state securities, it was 50% of GDP. So there's a roughly 30% change in the market value of debt. Of this 30% change, the nominal return on marketable debt was 55% of this total change. It was the biggest driver of the change in the market value of debt, much more than, and then if you compare this broken down to the 1 to 2 year bucket, the 2 to 10 year bucket, the 2 to 10 year bucket, of course, is the most liquid, so you see the most issuance here. It's about 30% of this, of this 30% total change. Okay, so the Holland-Sargent approach allows you to quantify this breakup between and breakup in the change of debt. And this is the average maturity that we get here for India. It hovers between about 6 years, whereas the status reports say that that graph I showed you where there was higher issuance would calculate it to be about 14 to 15 years. It's a very different number because they're looking at face value and we're looking at market value. And so you would say, United States, country with, a large public debt, but, they issue the dollar. They probably presumably have lower rollover risk, so they can, afford to have a lower average maturity. But we overstate our maturity by just looking at the face value of debt. Okay, since I've run out of time, let me spend the last minute basically on a few implications for capital controls. Now, this is where we need more work, and this is for the students out there, is that we need more work on figuring out what the optimal level of reserves are. And what's the relative efficacy of ex post controls and ex ante controls, right? And we need also to determine the optimal level of reserves depending on the risks of sudden stops. We need to tie in that discussion on how to think about sudden stops. That's one set of observations. And then I think what we really need, this is what's interesting, is that if you look at the Chin-Ito index, it doesn't really budge much as far as my kind of preliminary looking of it is. It doesn't really budge much, even though India has successfully dismantled all kinds of capital controls. But I think we need more research here on thinking about capital controls beyond the Chin-Ito index, maybe related to the amplitude of credit cycles, maybe looking at credit cycles and subsets of capital flows like FPI cycles, FDI cycles, and FPI debt cycles. We need more work on that. And then this goes back to the point about, the Tinbergen principle. So if you have multiple targets, you need multiple instruments. There's a little bit sort of with flexible inflation targeting, the idea is that, the flexibility of the exchange rate gives you an additional tool to absorb shocks. But there is now some work which is now beginning to also help shape thinking about whether central banks should also, in addition to target inflation, continue to sterilize the exchange rate and may begin to reap higher welfare gains because of doing that. So they can, actually target the exchange rate as well in addition to targeting inflation. And just finally to end, this is our calculation of the average maturity of debt compared to what the status reports pulls out, and it's substantially lower. So I'll just end by saying that we need to think about spillovers, the sources of spillovers, the asset prices they affect, and one of the under-thought, under-researched aspects of spillovers are the ones that we are going to now the ones that we're going to see in the future, which is coming from debt consolidation. Those spillovers are going to have effects on all kinds of EME asset prices, and we therefore need a whole set of fiscal metrics to better understand how debt outflows may or may not happen. Thank you.
Did not happen, right? So in fact, one of the discussion in the morning session was, how do we make that case, right? So, how does academics play a role here? And what are the various ways that we can make that case academically, right? And in fact, some of the work that has been done on implied ratings, is there a direction that we should take? That's one of the areas that, if you can comment. The other one, of course, we also kind of talked about it, the bond inclusion that we all are expecting. And you've talked about the rebalancing effect, right? What would be the potential rebalancing effect probably on corporate yields going forward? Is it something that that we have to also worry about? And what will be the predictions from your models on the maturity profiles, right? On as a result of this particular inclusion, like would it be something which is will lengthen the profile, or would it make a difference in the other direction? And one of the interesting aspects that Professor Ghate's work also brings in is that there's a difference between face value and market value, right? And we have seen that that makes a difference in terms of the actual maturity that you see that the market participants are actually telling us versus what is being claimed. What would be the overall, for example, lesson from this? Like, how does the overall market debt to GDP ratio fare vis-a-vis the face value that we all kind of talk about, right? So are the profiles going to be different? If so, what could be the various factors behind the difference in profiles? Maybe the factorization that you talked about could be something that we can use on. So if you can respond to any one of them, or we can open up the floors.
Maybe we can quickly respond. You want to go first, Ashma?
Okay, I'll just make a couple of points. First, I think the impact of bond index inclusion, there's a lot of discussion on this. One of those graphs that I showed that we are much below in terms of GDP. And also that given even the medium-term framework, there's some limits currently. We are much below those. So there's a lot of scope for and given that this is going to be graduated at about 30 billion is expected, I don't think it's going to create any volatility, and to be absorbed, it might bring down yields and lower the cost of government borrowing, etc., which should be useful. The second thing I'll comment on is the rating agencies and what. So here, when I was saying that there's that policy lag, we see this in international institutions. I think all of us, we take a long time to perceive that things have changed. We are trapped in the past. So to help that realization and that shift, recently kind of discussion of India's fisc, for example, the IMF told us that our debt GDP ratio is going to rise beyond 100. Now this is happening in the US, but in India we are seeing deficit ratios come down. And I have this, and actually because we have much higher growth, we should see the ratios come down. In fact, I had a paper on this, I call it a possible escape route, because it is true our ratios are much higher than East Asia and so on, but it's partly because you've never been counter-cyclical, and this government seems to be conservative. I have this very interesting graph, where you look at the deficit ratios after the GFC, it's like a plateau, it continues. While after the pandemic, there's a sharp V shape, partly because GDP was negative then positive. But we are seeing fiscal consolidation immediately. So the big mistake India made in the 2010s was high growth, so spend more. So it was pro-cyclical spending instead of building up buffers. But I think we are understanding the utility of buffers, so creating fiscal buffers also. And all this should gradually help people understand that the reality is different from their perceptions and things are changing on the ground. Thank you.
So on your question about inclusion, so the index is about $230 billion, something of that magnitude. And India's weight is about 10% of that. So it's about $25–30 billion of additional flows. And I think that probably be limited appreciation from that, just from that quantum. What we're putting on the table is another way to assess fiscal risks that for countries that run fiscal deficits, they want to extend the maturity of their debt because they worry about rollover risk. But what we're saying is that that may not necessarily be true, because once you take the market value, you actually do have quite a lot of rollover risk. Average maturities actually fall. So the fiscal risks do still come back onto the table, and they are something to worry about.
Do we have time for audience questions? You can take one question.
I am Navdeep, a student from IG Ideal. I have a question for Asima Goel ma'am on things which I don't understand in the MPC statement. So first of all, if the interest rate differential doesn't matter much, as you have said, then why is RBI hesitant on even changing the stance of MPC? And why the RBI has complicated the stance language in the second Monetary Policy Committee by introducing withdrawal of accommodation? And the second question is that since the core inflation is coming down, then how do RBI justify the projections, growth projections which they have made?
Yeah, so this is, sort of out of this session. I don't know if I'm allowed to answer. Anyway, I'm not in a quiet period, so I can... so I don't see why you think that we are following the US in whatever we are doing, or whatever we are doing is really related to what is required domestically. Now, the stance... it has to be understood as coming from the pandemic time when there was a huge, for the first time, an expansion of the balance sheet, a large amount of liquidity injected, and overall stimulus, and therefore withdrawal. But currently, since we are not at the target, you still want to focus on disinflation and reaching the inflation target. So you continue with that withdrawal term. But now it has to be interpreted strictly in terms of the rate, the real rate or the policy rate still being disinflationary. Yeah? And core inflation, since our target is headline, core inflation is lower than the target, but it is headline which affects people's expectations, wages, and therefore other enters various contracts. So we want to see that headline comes down to the target. Although core is more what is affected by excess demand that the RBI can control, but also inflationary expectations. There's a very important expectations channel, and this affects headline also. And research now suggests in current situations that it is core which is more steady, and that affects expectations, and headline comes down to core. So we should see this happen soon. Thank you.
Thank you.
I think you can continue discussions afterwards, informally.
But we have to close right now.
Yeah.
Thank you so much.
I invite Dr. Sagar and Dr. Patnaik for for the felicitation. We like to felicitate the speakers. Okay.
I thought this was a band.
No. No goods and bands.
Ladies and gentlemen, we'll break for lunch. I request everybody to head to the round ticker area where we have the lunch arrangements, and we'll reassemble here at 1:45 sharp. We'll start the next panel discussion. Thank you so much. 1:40, so we can start by 1:45. Yeah. उसका रेंज चला जाएगा.
Hello, 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 check.
effective financial policies that will lead to lower loan delinquencies and improved profitability for both borrowers and lenders.
At Urupika, one of the themes which we explore is the demand-side determinants of financial behavior. In particular, we look whether skills such as financial literacy and financial attitude could improve financial behavior. We also investigate whether financial education can improve skills, consequently fostering financial behavior. Given that we have made large strides in removing the barriers of financial inclusion, our work can provide insights to asset managers, lenders, regulators, and policymakers to the existing issues of household finance, such as poor participation in insurance markets, poor credit behavior, and low diversification of assets.
Some 20 years ago, the Nasdaq considered reducing tick sizes. The dominant belief was that if you reduce tick sizes, more trades would go through. But not everyone was so sure. So they went out and tested this idea, not in the real world, but in silico, on a computer. The buyers group at Santa Fe built an entirely artificial stock market, populated with artificial agents, trading with each other, bidding, asking, and so forth. And therefore, this idea was tested out well before being implemented. We at Urupika hope to bring this technology called agent-based modeling to promote better decision-making in India, whether it be at stock markets, firms, or at the level of government policy formulation.
We live in an interconnected world. With globalized financial markets and asset classes, it naturally results in spillovers and fault lines. The impact of these spillovers and fault lines are not merely limited to market participants, but also stretch beyond to macroeconomic policy making. Our work at Urupika is not merely limited to traditional asset classes, but stretch beyond to postmodern asset classes, including decentralized finance. We intend to work on the interconnectedness of these assets, cutting across asset classes and geographies, and providing practitioner-oriented insights for sustainable markets.
The themes at the center and at this conference have the power to determine how finance and its future will affect real economy. Macro financial spillovers erode financial stability. We hope to undertake research to mitigate these. In a world of financial networks, domino effects, systemic risk, asset price booms and bursts, Urupika hopes to undertake research and build networks which will mitigate these risks to financial stability. If you want to know more about Urupika and engage with us, visit our website and reach out to us on this email ID.
I wish the conference and the center all success and urge you to work with NSE to create a permanent network of stakeholders to push the mission of macro financial stability forward. Jai Hind. I'm glad we created Urupika as a public good. This unique IIM Kozhikode Center of Excellence combines powers of macroeconomics with banking and finance to unleash research and public policy designs in aid of macro financial stability to foster enduring growth. Such a center will bridge the gap between practice, academics, and policies, with each of them benefiting from the center's work. The center has curated a befitting inaugural conference on the theme Financial Stability Amid Global Spillovers. We are thankful that National Stock Exchange readily agreed to host it. The theme is eminently important, as history is replete with episodes of black swans and other disruptive shocks that generate financial market turmoil. The resultant chaos and disorder rip through the economy with social upheavals, with several small and large businesses folding out, millions of livelihoods lost, and deep recessions that follow leave permanent scars with lost outputs of mega proportions. The conference will improve our understanding on this and how to prevent this.
The name of the center, Urupika, has a historical significance. It was one of the coins early in the circulation in Calicut during the kingdom of Smoothries, which has given the name to the modern rupee.
At Urupika, We analyze both macro and micro issues related to money and banking. We do macro forecasting and policy impact analysis. We study financial inclusion, including access and usage of financial services. For example, we are developing a credit score for micro borrowers, which will help in designing effective financial policies that will lead to lower loan delinquencies and improved profitability for both borrowers and lenders.
At Turupiga, one of the themes which we explore is the demand-side determinants of financial behavior. In particular, we look whether skills such as financial literacy and financial attitude could improve financial behavior. We also investigate whether financial education can improve skills, consequently fostering financial behavior. Given that we have made large strides in removing the barriers of financial inclusion, our work can provide insights to asset managers, lenders, regulators, and policymakers to the existing issues of household finance, such as poor participation in insurance markets, poor credit behavior, and low diversification of assets.
Some 20 years ago, the Nasdaq considered reducing tick sizes. The dominant belief was that if you reduce tick sizes, more trades would go through. But not everyone was so sure, so they went out and tested this idea, not in the real world, but in silico, on a computer. The BIOS group at Santa Fe built an entirely artificial stock market, populated with artificial agents, trading with each other, bidding, asking, and so forth. And therefore, this idea was tested out well before being implemented. We at Urupica hope to bring this technology called agent-based modeling to promote better decision-making in India, whether it be at stock markets, firms, or at the level of government policy formulation.
We live in an interconnected world. With globalized financial markets and asset classes, it naturally results in spillovers and fault lines. The impact of these spillovers and fault lines are not merely limited to market participants, but also stretch beyond to macroeconomic policymaking. Our work at Urupica is not merely limited to traditional asset classes, but stretch beyond to postmodern asset classes, including decentralized finance. We intend to work on the interconnectedness of these assets, cutting across asset classes and geographies, and providing practitioner-oriented insights for sustainable markets.
The themes at the center and at this conference have the power to determine how finance and its future will affect real economy. Macro financial spillovers erode financial stability. We hope to undertake research to mitigate these. In a world of financial networks, domino effects, systemic risk, asset price booms and bursts, Urupica hopes to undertake research and build networks which will mitigate these risks to financial stability. If you want to know more about Urupica and engage with us, visit our website and reach out to us on this email ID.
I wish the conference and the center all success and urge you to work with NSE to create a permanent network of stakeholders to push the mission of macro financial stability forward. Jai Hind.
Good afternoon. I request everybody to be seated. We'll start the next panel discussion. Our next session is a panel discussion on can sound regulations mitigate cross-border spillovers from digital finance. Our esteemed panelists are Mr. P. Vasudevan, Executive Director, RBI, Mr. Vikas Bansal, WTM and Head of Amazon Pay India, Professor Arvind Sampath, Professor of Finance, Accounting and Control at IIM Kozhikode. The session will be moderated by Professor Rudro Sen Sharma of IIM Kozhikode. May I now request all panelists to come on the stage and take their seat, please.
Good afternoon. So this is a challenging session for the simple reason that this is the first post-lunch session. So, when I go to teach in a class after lunch, I say it's the graveyard shift. But this is a very, very important and very, very exciting session. So I'm sure we will be able to keep you awake. We are going to talk about exciting stuff like digital payments, peer-to-peer lending, cryptocurrency, central bank digital currency. So a lot of exciting things to discuss. So welcome to the very distinguished panelists. See, digital finance, according to me, is probably the most important development that has happened in finance in this technology-powered age that we live in. So let me just give the background what we will cover when we say digital finance. We'll cover a broad spectrum of things like digital payments, peer-to-peer lending, cryptocurrency, CBDC, so e-money, so all these things will get covered. Now, I saw an estimate by McKinsey Global Institute who said that digital finance is going to increase GDP of emerging economies by 6%. And they put a figure of some $3.7 trillion. So that's the impact digital finance is expected to have on GDP and particularly emerging market economies. So very important area, a lot of obvious advantages because digital finance gives us a cashless, low cost, high speed mode of transfers. But other than the convenience, there is also risks. So because it is high speed, low cost flow of money, so particularly when it comes to cross-border spillovers, which is the theme of our conference, there are issues of very fast movement of capital that could have contagion effects, that could create volatility of capital flows. So we will discuss about what are the benefits and also challenges and how do we think about a regulatory framework for digital finance. So let me start with the regulation part. So as we know, digital finance does not know national boundaries. So do they pose threats to stability of domestic economy? So I'll start with Mr. Vasudevan. So my question to you, sir, is, do you think digital finance poses risks to financial stability, and how should we view that, and should we worry about it, or is that something that we are comfortable with?
Good afternoon, everyone. When we look at the national boundary, some other jurisdictions may have other reasons for letting innovation happen or digital finance flourish, but we have our reasons as well. We want to balance innovation with also a responsibility that needs to be also ensured. For example, when there are various players that are already there, if a new player comes in, he also has to play by the rules of the game, at least to a reasonable extent. It cannot be a free for all. And when you look at the responsibilities we in India are expected to have towards the common man, towards the stakeholders from a regulatory perspective, we also look at basically consumer protection, we also look at the financial stability, the data being also safe and secure. So multiple responsibilities are enshrined upon us when we look at the various aspects of digital finance, and the new instruments and the new players who are coming in are also expected to play by these rules. If you are looking at, say, we never were having these phrases like, or these acronyms like LSPs, lending service providers. We were also not very much clear about what they are supposed to do and how they are supposed to partner with the banks or non-banks. We have something called as a FLDG was one phrase earlier being used, now we have a different phrase being used for that. So if you look at who is taking the risk on the balance sheet and who is actually interacting with the customer, who is actually taking care of the front end and back end support, etc., there are multiple players who have come in. So what was a normal market has become more or less like in the payment space we have seen a slice and dice atmosphere, and each one is supposed to play the roles, and we are here to ensure that the framework is there and people are compliant with that framework. So you would have seen the digital lending guidelines that have been issued. Those were also followed earlier by wide consultations with the industry, and that also was necessitated because there were various experiences and experiments being undertaken by many players, so we had to have all those engagements. Now I feel we are in a very nice space, and people who are now active and involved in this space do also know what responsibilities are expected from them, and we are happy about that. So definitely they also now know the national boundaries, and probably we also know in what framework they have to function. Thank you.
Thank you, sir. So I think what I took away is RBI seems to be confident that of course this is an innovation, but then regulation is keeping up with the challenges. So on top of things, that's good to know. So let me come to the digital finance industry now. So I'll go to Vikas and ask his views about the growth of digital finance. So how do you see the growth of digital finance, and do you think it is substituting the traditional modes of finance? So how are you seeing it?
So digital finance, right, is nothing but kind of doing this digitally, and considering now that the world is now moving more and more to digital, I really feel that digital finance is here to stay. It's not that something that will slow down, it will accelerate as more and more customers, more and more consumers come to the digital fold, right, and digital economy. Now there are certain really important benefits that digital finance brings to the table, right? First is obviously the access, because with access with now mobile phones, smartphones, and internet, that any part of the country you can access financial services, which was not possible. The cost of distributions is better or lower than what it was earlier, right? And then efficiency. So there are multiple such benefits that digital finance brings to the table, but obviously it also comes with risks. That unlike that, you have a risk of cybersecurity threats, and then those risks get multifold and manifold. The digital payments and the kind of evolution crux of it. But in addition to this, financing, point of sale financing is again a very important use case where it's at the moment of truth when I need to buy something and I'm worried about how I'm going to buy it and how I should buy it. And then for now, in terms of your question about would it replace traditional financial institutions, I don't think so. I think that we have to, this is going to complement, and that's the thing that's already playing out, is that, there is a very close collaboration and partnerships. We absolutely everything we do is kind of powered, through financial institutions. So I think it's complementary. I don't think it will ever replace it. And it will be, I think the financial institutions will continue to be the backbone, of digital finance in my view.
So you are saying that they will coexist, the traditional forms and the digital form of finance.
Absolutely. Yeah, I think this would absolutely.
So on that note, and particularly you mentioned this point of payment financing. So these are of course innovations that only digital finance can allow. So I'll come to Kunal. What other kinds of segments do you think are growing within digital finance? How do you see the growth, and in particular, which segments are you optimistic about?
I think the decade that we saw, where we moved from a absolutely cash-driven society to kind of we have to acknowledge the role that the regulator played in terms of the innovation that was done, companies that were allowed to participate, and we saw this acceleration of digital payments. And today, when we look at India, it is significantly ahead to anybody else in the world when it comes to just the payment capabilities that we have built. And that opens up many sorts of opportunities on top of that. So one of the things that we talked about was, let's say, point of sale financing. But the thing about, let's say, credit on UPI, the opportunity of participating, and you have like probably 350, 400 million customers already on UPI. And traditionally, like if you look at the cost of kind of getting customers on board on credit was limited. I think we are entering pain for everybody. We just are in a mode where we are going to really accelerate. And I see 10 years from now, I have been now in payments for now over 14, 15 years. The word fintech did not exist before. And sir has also asked what does fintech mean also. Because the thing is that all of us existed in the ecosystem in some ways. And I think the acceleration that we see is unique. More and more opportunities, more and more product capabilities are being done, including what sir mentioned about LSP. I think the ability to kind of innovate on top of the existing things. And now the digital public infrastructure that exists right now, there are so many more participants in the ecosystem that can actually get many people into the healthy mix of credit, healthy mix of responsible financing, and so on and so forth. And to Vikas's point about digital finance and thing, let's just understand that the medium has changed. Not too long ago, we used to go to the branch to withdraw money and deposit money. Then the ATM came inside the branch. Then the ATM came outside the branch. And now you can see ATMs at the mall also. It doesn't mean the mall has become a bank. The thing is that it's just the capabilities that are there, and there will be a role that each of the players will play.
So I think, you didn't use the term, but I think what you also hinted at is that it is helping financial inclusion. And particularly, we know traditional institutions, they did a great job of opening bank accounts. But what I took from you is digital finance is also allowing the next level of inclusion, which is getting the credit going and enabling payments, point of sale financing, etc. So now let me move to another domain, that is cryptocurrency. So I'll come to Professor Arvind, because I know you have some interesting insights to share about cryptos. We all have a fair idea of what cryptos are, but when it comes to the investors who are investing in cryptos, how do you see them? So is their behavior any different from the investor behavior in other financial assets, or are they wired differently?
It's a pretty interesting question, Professor Rudra. If you look at the traditional asset classes, I can value an equity. I can always say that there are 3-4 ways to value an equity. I can look at a company's cash flows and say, okay, fine, I project the cash flow so much, I think this is the risk and I think this is the value. And then you do your trading. You go to debt, there's a similar way to do. Derivatives, very similar. You come to this new age postmodern asset class called a cryptocurrency. I joke in my students in class saying there are 7 billion people, probably 70 people understand how cryptocurrencies are valued. And I tell them I'm not one, right? But the point is, what interests me more is, it's not just the nature of the asset. You look at the trading rules. The asset is available for trade 24/7. You want to trade on Sunday night, 8:30 p.m., you can trade. There's no trading halt. You look at the market structures, right? Every other asset class, either asset, you have a trading break, you have an auction mechanism, you have different ways in which the orders are executed. And here we have something which is, many people don't understand how the value is driven. Many people can trade anytime they want, and they can sit anywhere in the world and they can trade. And they aren't governed by a local regulator. So my interest, I mean, I have a student here with me, Karthik, who works on his PhD dissertation. Our interest was more about, okay, do we think we have established evidence in other asset classes on how, for example, somebody is an informed trader, how do I mask my information so that I maximize my outcome? Do these people behave the same way in an asset like cryptocurrencies? And surprisingly, I mean, we are just not even scratching the surface. We are scratching of the surface in cryptocurrency research. And we find that the behavior of investors are not that different. When you look at an asset like cryptocurrency, I might not understand how the value is driven. But if I think I have more information than, say, somebody else, my trading mechanism is exactly the same as I would do an equity. So that's a fascinating insight to look at. And like I said, we're just scratching the surface. And I think the exciting stuff about crypto research is more on the behavioral angle rather than how to value a crypto. I mean, at least that's how I would look at it.
That's very interesting, Professor Arvind, but there is a regulator we know of who wants to ban cryptocurrencies. So I would come to Mr. Vasudevan on that note that RBI wanted to ban cryptocurrencies, but then I think the Supreme Court had an order in 2020 sort of reversing that. So what is your view on cryptocurrencies? Should they be banned or should they be regulated?
I don't want to take your mic. I'm very glad that the question has come back to me after the professor's comment, and you were mentioned that now we know more about cryptocurrencies. I do hope that everybody knows a bit about cryptocurrencies. Let me make a few points straight. The Supreme Court did not set aside the ban. If you actually remember, what we did in April 2018 was to only ring fence the entities that are regulated by us. We told the banks, the non-banking financial companies that please do not have any dealing with virtual currencies, nor do you provide any services, because at that time, if you are aware, even prior to that, couple of years before onwards, we have been warning the public, also cautioning them about the risks that are there if you start dealing with the cryptocurrencies. And it's something which not many people know about. So we did say that the institutions, before you deal with them, you have to exercise caution. So we said that you should not deal with them. The Supreme Court, if you have actually read the order, 180-page order, I have seen the entire order. And if you see actually, the Supreme Court has said that Reserve Bank has the powers to take preemptive action. Okay. And what we did was, according to us, preemptive, but the Supreme Court said that you actually should be tested by the degree of our doctrine of proportionality. If you feel that the institutions that are regulated by you, if they have been actually facing a loss, or if there have been some instances where it has caused some harm, then probably you could have some justification. And when the base instrument, the crypto, has not been declared unlawful by the government, then why do you want to do this? So that's how they said. They only set aside the order. And if you see the 180-page judgment, for most part of it, they are in favor of what has been done. In fact, they have even thought of giving more powers to RBI than we ourselves thought we had in many aspects. And if you still look at the stance we have been taking, that still remains the same. The cryptocurrencies are not to be called currencies. So crypto is a nice word. I don't know whether they are an asset class as well. There is no underlying on which you have a cash flow in to invest upon. The crypto is a code, and crypto can be as volatile as we have been seeing today and a couple of years as well. People want to put money in, it's their choice, but it's our duty to warn. And our governor in the recent couple of interactions has made it very clear that Reserve Bank's approach is consistent, continues to be consistent. It's a call that the government will have to take about the nature of the crypto, how you have to deal with them. And if you also have been seeing the discourses during the recent G20, we have been pushing this as an agenda where there should be a global consensus, because one of the aspects which you have as part of this panel is about the global spillover. So we are also very conscious of the fact that these assets or these maybe instruments or these codes may not see a national boundary. So we have to be very careful, and we have to build a national consensus, global consensus to which we are working. And if you already are also familiar with the papers that have been brought out by FSB, the BIS, one of the aspects of regulation could also be banning it. There are many other things that are there in the ecosystem which could be easily good for the public to have, follow, adopt, but need not be legal, need not be also officially allowed as well. So those are the things you will have to live with it. And the interactions with the crypto guys also tell us that now they have accepted a point that, sir, we are not currency, so we don't want to be anywhere around RBI. We are somewhere else. If you look at it as an instrument, maybe we want to be under some other regulatory fold. So things are changing. And honestly, I was just having a number, 23,000 cryptocurrencies. I don't know if all of them become legal and start playing around in the country, what will happen. And if you also see the number of currencies that are folded for whatever reason, and the bigger institutions that are folded again for whatever reason, and the institutions that are also backing the crypto also folded for whatever reason, we can't afford to have such big failures in our jurisdiction, so we have to be very, very careful. So probably we reiterate what has been mentioned in the earlier press releases. You can go and see those things are even valid as of now. I hope I have made myself clear, including on the Supreme Court judgment. Okay.
Yes, absolutely. Thank you for clarifying. Of course, I wanted to be provocative so that we get.
We enjoy being provoked and we enjoy being reiterative and repetitive. I love actually being provoked. You can ask any of these colleagues. We have a lot of interactions.
So then let me come back to the industry views. I'll come to Vikas, continuing on cryptocurrency. Now, how do you see cryptocurrency, particularly the regulatory situation right now? Do you think there's a confusion or do you think there's clarity? How would you like to see cryptocurrency be treated in India?
No, I think Sir said that cryptocurrency, presents a lot of risk, right? Because it doesn't have boundaries. It is very volatile. We don't know what's the underlying asset. We know what the definition is. I think all those challenges are real. And it requires deep deliberation about how, but at the same time, I will also say the benefits are pretty compelling. They're very early stages, but the benefit of speed, cost, distributed ledger, I think there are some really benefits come with it, but what it requires is kind of a deliberation to say, how do you do that? And the way probably we were thinking is that it requires very close collaboration, with the regulator and the industry first to understand, right to your point about what is it, what's the underlying technologies and the associated risks. Then it also kind of engaging with the industry and saying, look, what's the bound and how do we really think about so engaging with the industry is also very important, right, to that point. And then to have a clear regulatory framework. So I think, in my view, the framework will evolve, but I think whatever framework it is, that it should be predictable and it should be consistent so that the players know, and obviously that new risk emerge, then we will adjust, and I'm sure regulator will accordingly adjust. So I think if we really solve those things to really understand the technology, engage with the industry, and then most importantly, sir also touched on this, is the education and awareness, is that when you're really doing it, the customers or consumers should really know the risks. And then it is very, very important, right, in that framework to also talk about the customer education and awareness. So I think as long as, first of all, the benefits, the challenges are pretty clear and evident. And how do we regulate or how do we come up with the framework is probably following that process could really help in that direction. I would say it's very, very early days and something I think as an industry we will have to evolve over time.
Thank you for your views. Kunal, I have a question on CRED, but before that, would you like to share your views on cryptocurrency?
I think we have to understand that as a country where we are in an early journey of money, literacy around money, and understanding of risk per se. We are also a very young demographic where we probably watch content more than understand the quality of content that we consume. And I think from that lens, taking a view that will not cause disruption is the right view. And I think the regulation has been actually following that same principle. And on tenet level call, I think it's been consistent, and therefore, while we may say it's innovation, all of that, we also look at suitability for the audience, suitability of customers, and so on and so forth. And I think we have to understand that as a country, we need to understand who can say it is a currency and not a currency. We should never confuse that part. And therefore, while it may look like, and I think the world has already seen the whole, he's moved to AI already from crypto in terms of the wave. So I think the point is that we just need to stay focused on how do we kind of take our country forward and really use the digital wave on all the things. And today, about convenience of money, like as a country, we have solved it completely.
Thank you. Let me move on from the crypto theme now. So I had a question about cred. So how did you evolve this idea of using credit card payments and loyalty related to that as a business model? And follow-up question to that would be, how do you view the regulatory framework for digital businesses that we have currently? So tell us a little bit about the model and then the regulation.
I think I want to answer the second question first. Sure. The point is, none of us would have existed if we did not have the regulatory support and these capabilities and infrastructure that was created on which many of these businesses have built. So fundamentally, we are all products of all the innovation and all the work that has been put in for a decade plus, including the creation of NPCI and UPI and many other things that have come, including the latest innovation on CBDC. I think we are all beneficiaries and we exist because of that. So I think we'll only see that kind of evolve further. When it comes to credit, the idea was actually simple. I'm personally a product of a bad loan. My family went through a severe financial crisis and we had to sell all of our assets to pay off a loan. I realized that while we punish for bad behavior, there was no reward for good behavior. And I think both needs to exist together for a society to kind of do well. And I think we realized that credit card as a market, while it was booming quite a lot, but many customers were the first people in their entire family to even have an instrument like that. So we realized that if we reward people for doing good behavior, which is paying their bills on time, ensuring that they understand what are the underlying costs and other things that they could have for having any lapses in their promises. And that was the idea behind that. And we realized that it's a large enough market. My previous company, Freecharge, we saw the power of mobile payments and all of that. And we realized that while we are trawling for all of India, I think there's a segment that needed focus. And on top of that, we currently help banks kind of use our platform to cross-sell many of the products that they have. So the idea is fairly simple. It's just that we took a unique approach to address the customer need. And I think the sentiment that we could get and get customers to come to is that rewarding for good behavior was historically not the case. And we saw merchants who were keen to access these customers, were very happy to sponsor rewards. A Swiggy or a Zomato or a Cult, any of these companies are very keen to acquire some of these customers. So we use this motivation of merchants to incentivize customers to get themselves to acquire these customers, and the customers need to kind of create a reliable payment experience and use that and build on top of that. So credit is a simple journey. It's just that we focused on a customer segment, and we are also, like recently into UPI, we've just become the top amongst the top 4 companies, and I think we are very bullish now on credit on UPI, RuPay, many of these initiatives that the regulator has launched, and I think we'll see many more, like I would say years or probably a decade of innovation that continues to be there.
Thank you for explaining that to us, because I think most of us know cred for the quirky ads that we see on TV, but now we know more than that. So I'll come back to the regulation side, the regulation of fintech. So I'll come to Mr. Vasudevan. That initially there was a light touch approach to fintech regulation, but do you think that has gone wrong, or a tipping point has been crossed where now the regulation is getting tough? And I'm specifically talking about the case of the Paytm payments bank. And there's a lot of social media chatter that, is this hurting innovation and startup spirits in the economy? So how do you balance that innovation versus stability when it comes to fintech regulation? And any thoughts on the Paytm bank issue?
The fintech sector is still led to be on its own only. We have not tried to regulate them. If you would have been seeing the recent paper that we had released, we said that we will be happy to have a sectoral self-regulation happening in the fintech space. We have come out with a document and on which we are awaiting inputs as well from the ecosystem, wherein we have said that the sector could try to have among themselves regulate, like self-regulation, SRO, what we have said. So we will be happy if the inputs evolve and the sector, it takes care of itself. We want to be as much as possible hands off and hands away. Of course, we'll be monitoring very closely what's happening in the ecosystem, because as I said, one of the things we have put in there is what's a fintech. It's very difficult to define what's a fintech. I've been saying in many fora as well, when I talk to some people, they said that they are a fintech, but when I try to discuss more, they end up realizing that we are not a fintech, we are just a partner to somebody else. So that's how it's coming out to be. So we will be very happy if the sector evolves and tries to have an element of self-regulation. If you see even in the payment space, typically initially everything was left on their own. If you see the prepaid payment instruments, we came out with guidelines. There was nothing on payment aggregators per se. There are a set of informal or indirect regulations which were told the banks that you have if you have a want to do. We didn't want to touch the payment gateways because they are only technology partners. They don't handle funds, or they are not expected to handle funds. If you are handling funds, typically we have been seeing in some of the companies that are quite comfortable in getting funds, that technology is their forte, handling funds is not, okay. And it is somebody else's funds, definitely you don't have so much of passion to handle those funds as well as we feel you should be. So in the case of payment aggregators, since customer funds were being passed on to the merchants through the PA route, we said that payment aggregators should come in under our direct regulatory fold. Over a period of time, we said online payment regulators and offline payment regulators, in between cross-border payment aggregators, all our payment aggregators should also be brought under the fold. So we have been having a very phased-in approach, even for the fintechs. If you see the account aggregators, what have we tried to do? We have said that these are the things you have to follow from a data consent perspective. Customer consent should be there. Who is the data owner? That should be very clear. How the data should be stored, should be used, is what we have mentioned with the account aggregator framework. Even for the P2P lending platforms, we have been very, very light in terms of our expectations from them. So to say that it is a space for which we are going to look heavily into regulation isn't correct. In fact, Kunal did mention about, especially how does a credit score get formed. Like I always like to take this example. If I buy a product and then through a credit card, so credit is there, so I'll say using a credit card, and I get a couple of messages from the card issuer saying that would you want to convert that into an EMI. Now, if I convert that into an EMI, probably I may get into the credit score area. But if I have 5 or 6 such purchases and I have refused 6 EMI offers, will my credit score improve? It doesn't. If I am paying my loan ahead of time, does my credit score improve? So those are the things we want the other credit score evolving concepts to be molded to the Indian way of life. Even now, if you see 95, 96 idea had been launched on the debit card platform, imagine credit, where will it be, or deb, where it will be somewhere else. So we are trying to understand that whatever is our culture should be the way what these entities who are operating in our space should be living by. There is nothing as a harm to expect this. And when you say global spillovers, I am very keen to see that the other countries should be scared of us now. Because we have established and we are very comfortable with the volumes, we are comfortable with the way in which we have handled some issues, and we have never tried to be swayed by some people come and tell us that I've implemented this in a couple of jurisdictions, I want to implement in India. Definitely not. You have to implement the way we want. And that's what we have done. And we will learn from our good examples and we will try to do on that. So even the fintech space, we are very happy to see them innovate, to see them participate in our ecosystem. Certain frameworks, certain rules about customer consent, data privacy, customer grievance handling, all those things are our expectations. Even if you see the digital lending guidance, simple thing we have said, give an annual percentage rate, APR, to the customer. Key fact statement should be given to the customer. The recent monetary policy, it has been extended to all sort of retail loans. Basic minimum things. So sector should be happy, we are away, but we are also around somewhere.
So good to know that you are encouraging innovation, but as you are saying, within the Indian context, there should be transparency, customer privacy, data consent. So these need to be respected, but innovation is welcome. Professor Arvind, I want to now talk about decentralized finance, which has a cute acronym DeFi. So can you explain to us what is this DeFi, and does it replace the traditional finance models, take out the middle person, so to say, and or is this just a passing fad that will go away, or is it creating value and delivering efficiency?
Very good question, and I think it's very important to learn about this in today's world. So I look at DeFi as something that's not going to replace traditional finance, but I have a very contrarian view, maybe unpopular also. DeFi has been the traditional finance. You have money, I have a need, I take money from you, I use it, I pay it back. You are a person with cash, I am somebody who needs the cash, and we enter into a transaction. And this is how it used to be, at least when markets were centralized and we were living in our own rural spheres. But what has happened over a period of time is, which is a necessity, is things have been centralized. Now you have a third party, which is the entire banking system, whose job is to behave like a market maker who creates market for the financial services. That's what has been happening in the entirety of the modern history. Now suddenly we have the advent of tech, and I look at this in a way similar to how the subject I work in, microstructure, where you had your traditional code-driven markets, and then suddenly you had an order-driven market where you didn't need the market maker, and I'm a buyer, I just go to the electronic order book and I place my trade. You're a seller, you see my trade, you like my trade, you place a sell order and it's done. But it hasn't eliminated the market maker as it is. If the concerns are that the middleman, the banker might go away, I tend to agree with what Vikas said earlier. They're going to coexist. In fact, we have hybrid, again a comparison to the markets. We have hybrid markets where you've got the market maker and you have an order book. So I see in the future where the peer meaning somebody like you and me, could have a choice where either you go to the bank and get a loan, or you directly get a P2P based lending. I'm just giving one service as an example. So in that sense, it's not going to go and replace traditional finance, but I would say traditional finance is coming back. So like any postmodern system, you have two realities coexisting, and both the realities I think will coexist.
It's very interesting. It's almost like we have gone a full cycle and going back to where we started when it comes to finance.
Correct.
So I want to keep 15 minutes for Q&A, but still let me just do one quick final round of questions to the three of you, and then I'll open it up. So maybe I'll go to Vikas. So, are digital payments, particularly ones involving cross-border payments, posing threats in the form of security risks, particularly cybercrime, AML? So do you see that as a risk?
So, no, I think first of all, this whole notion of cross-border payments and the work that regulator and the government is doing is, I think, phenomenal, because I remember even like a year ago or even 6 months ago, it was so hard to kind of send money or receive money, right? And the way we are opening up and linking different countries, right, that we've done, I think is phenomenal, and a lot of other countries are learning from what we are doing. So first of all, I think it's a really good step in the right direction. Now, in terms of anytime we open up, absolutely it comes with risks. And that's where, the regulatory oversight and framework is very important. And I'll give you some very simple examples, right? First is around consumer protection. So when we are domestic payment system, there are rules around, customer protection, around refunds, around when things don't go well, like who do you go to and how do you go to? When you open up cross-border, right? So then you will have to collaborate to make sure that the rules, are consistent and standardized across, different jurisdictions, so that the consumer is protected. So it becomes a very important factor. You also touched upon cyber crimes and, the financial stability. There's also risk about, like, for example, basic things as KYC, right? To make sure that that as we think about opening up gross order payments, that the KYC standards are pretty consistent, because otherwise the risk of, kind of money coming in, illegal money coming in into the system and transfer through locales becomes very, kind of severe. So basic things like, having KYC standards, having consumer protection standards, and then there could be other things about, linked to that. You said about cyber security and all, that one place where it's an operational issue or compromise can really impact the whole system. Because now it's just kind of very broad brush, right? So something to spill over, something spilled over somewhere else can impact us in India. So there are a lot of these things that have to be thought through, but I think we are like on the right path, and a lot of work. Thank you to the regulator that we are in the right direction. So, but that's some of the views on that.
So you mentioned consumer protection, and earlier Mr. Vasudevan also referred to customer consent and data privacy. So I'll come to Kunal. So do you think these things are treated seriously by the industry, or are they brushed under the carpet?
I think anybody who wishes to be a meaningful player in the industry, we are in the industry of trust, right? And industry of trust cannot operate when you take some of these things lightly. This is why it is the most important thing that amongst all things comes first, right? And you have to do it not just for the sake of saying it, but comply on many things. For example, all of us go through several audits, like CRED particularly goes to like 35, 40 different audits throughout the year to kind of address all of these things. And we have very clearly been given guidelines on what is okay, what is not okay, what is consent, not consent. And there are many, many things that are very, very clear. I think we will always have situation for every now and then some odd situation happening. But I think as a country, we've done great job on this. Sir talked about account aggregator as a consent-based thing. It is really, really progressive. You think about it, that you can actually get the entire system to participate as long as you follow the guidelines which are very clearly specifying what is the role of data, how to use it, and so on and so forth. But I think that the key aspect is the consumer's understanding about what are they doing with this, right? So one of the things that we've done at CRED is we've actually literally taken 1% of the company and moved to something called as CRED Foundation. And what we are doing is using that to solely use that capability to raise capital within that to create financial literacy and understanding about right behavior when it comes to fraud, literacy, understanding of data, so on and so forth. And we realize that unless players take active role in doing some of these things, we are all going to cause an event which will not be great for the progress of the country. If we are really hoping for 10 trillion economy, we have to move with the speed of fast bowler, but we need wicket-keeping mindset also, otherwise we'll have a boundary for ourselves.
Thank you for the cricket analogy as well, and that really resonated with me what you said about consumer knowledge and empowerment, because our own research at IMK shows that through consumer education and empowerment, we can have a win-win situation for both the company and the consumer. So that's really important. So my last question is on CBDC to Mr. Vasudevan. So we have heard of CBDC, and now we are at the stage where probably we'll be looking at cross-border convertibility of currencies. So when that happens, can that create risks in terms of very fast movement of capital, and therefore those volatility of capital flows causing contagion risks? So how do you see CBDC's role in causing crisis in that sense?
CBDCs are still being discussed, and they are still in a pilot stage in our country as well. So probably we will come and cross that level of what are the risks that could come if you go cross-border, etc. Anything that settles or happens quickly can be a factor of risk if not properly addressed. So we have to have those guardrails. And one of the benefits of CBDCs we have been saying is that they can actually help reduce the number of intermediaries and the role of intermediaries in a cross-border chain. Typically, if you have been seeing, the correspondent banking model is looked at as a costly intermediary for cross-border transactions, cross-border funds flow. CBDCs could help because we could have two countries, if they have CBDCs to exchange and convert quickly. So we are looking at some of the benefits. We are in early stages. You must be aware that the pilots are happening. Recently, we have announced that we will also look into the programmability as a use case for a CBDC. You could actually get CBDC for a particular purpose, and we will see that you will use it only for that particular purpose. So that is one way. Second is, of course, the offline use case. Just like you can exchange physical currency between two persons without the need for any technology or any other connectivity, here also we are looking at offline as a use case. So there are a couple of other use cases being looked at even on the wholesale segment as well. So we are very bullish that CBDCs could also be one way of actually settling funds even in a cross-border or in a domestic transaction, in addition to the traditional existing ways of money. So that's how we are looking at, and it's something, if the crypto guys can look at blockchain or digital distributed ledger, etc., why can't we? And why should there always be a token that is a reward for a particular transaction? We could have a token that's part of a transaction chain for various purposes. So there are multiple things, and sometimes Vikas earlier was mentioning that the DLT and other things could actually give an advantage in terms of speed and in terms of efficiency. Those are some of the challenges we are seeing, because the more the volume increases, we are finding it that these technologies are finding it difficult to handle those aspects. So it's a wonderful thing. We are also experimenting, and Central Bank also does all those things. We also do a lot of innovation. We have our own innovation hub, if you are aware. We have set up our own fintech department. We also have a regulatory sandbox where you can come and experiment with us, play on our ground, on your rules. What more you want, we can do that through the regulatory sandbox route. We also organize hackathons. We'll be organizing one more very soon. Come and partner with us. So I'm saying we also can experiment. We want to give the industry also sometimes a tough challenge. We also, yeah.
Thank you for very interesting views to everyone on the panel. Now let me open up to the audience. So first offline questions, and then if there are any online questions. The Paytm question.
Yeah, I deliberately did not respond to the Paytm issue. Because enough and more has been said in all media, including newspaper, print, and social media as well. And the reasons for which some actions have been taken are also very clearly explained from our side. In fact, recent interaction, the governor also did mention that probably we will be coming out with some frequently asked questions as well, so you can await. See, there are people who actually have to comply with certain requirements as you scale up. Maybe let us take the case of Paytm. Before becoming a bank, they were like a fintech. They were operating on certain segments. After becoming a bank, there are certain other expectations that come in. So those things continuously get looked at. Kunal was mentioning about some 35 audits that they undergo, but definitely not from us. Could be from their investors, could be from anyone else as well. So, but here when you are looking at the banking as one activity, there are certain expectations, and those things get looked at. Maybe continuous KYC, there are ways in which the customer accounts get risk profiled, and there also have been instances where they have been warned earlier, some penalties have been levied for certain deficiencies. If you would have seen in 2022, some actions were taken to prevent fresh onboarding, etc. So it's a continuous process. Even it is so like that. So I'm very happy you remembered Paytm, though it's always at the back of our mind, but you know very well that it's not about a particular entity or sector being targeted or something. It's about a general expectation of good behavior, and if some things are not there, then we do step in, and we know that it can cause some inconveniences. That's why a lot of time also has been given for certain whatever activities are there unfolding, or people have to use that money, etc. Time also has been given. So it's a process. Don't have to worry too much.
Questions?
Yeah. Hi, sir. Yeah. I know that lot has been said about Paytm, but still I have a question about it. So, you said you're open about fintechs having self-regulation, but after what has happened to Paytm, do we expect a more strict set of regulation for fintechs? And another question is, after the 29th Feb deadline, what is next for Paytm?
Okay. Can you identify yourself quickly?
Yeah, sorry. I'm Shrishti from Money Control.
Yeah, media is here, so definitely we don't want to say about what happens after 29th February. You can wait and watch. But like it also emphasizes the need for self-regulation to be more stronger. People probably would have been aware of some of the practices among themselves. So self-regulation, we still feel, can be one layer which can actually protect the sector, ring-fence the sector much more better. So this is one more instance where we feel that self-regulation can be very much useful. As we also have mentioned in that paper, that highlighted. So you can actually do all those things in self-regulation, and we still believe in that paper. We are waiting for the inputs, and we'll be very happy if the sector comes forward and has their own set of groups that can self-regulate. This incident is totally different. Paytm is a payments bank, so let's not have that issue about whether the fintech will be disrupted or there will be some other harsher or other measures coming in on fintechs. No, definitely not. And we have also said, if you remember, one more announcement we have made is that there are 9,000 fintechs, people say. There was a number which our moderator friend was mentioning about what is the extent of fintech investment in the country. We are definitely not very clear about the numbers. So we have said that we'll be very happy to set up a registry. So we have said that fintech registry and the emerging tech repository will also be set up by the Innovation Hub. Again, we don't want to be seen as the one who is setting up. People should not find it very hesitant to come and register with the Reserve Bank. So we said, come to the Reserve Bank Innovation Hub, please register there. We'll be very happy to see who are all the players, what type of help they would like to have. I'm talking about mentorship typically, and what to have for themselves. So those are the things we are looking at. So definitely this is nothing to do with the entity or with the example you were using.
I think one point I want to add is that I've been working very closely with the regulator on the SRO framework, and I will tell you that the kind of proactiveness in which the regulator is working with the industry on point by point in terms of what is the opinion of the industry, our views, and the guidelines that the regulator has come up with is such a good collaboration within the industry and the regulator, is that the intent is very clear that, let's establish the framework and let's operate within the framework. And it makes easier things for the regulator and it makes easier things for the industry. So I think it is absolutely the step in the right direction.
There was a question. Yeah, maybe. Yeah, go ahead.
My name is Chinmay Srivastav. I work with InSolutions Global. We are a payments company, and we obviously are regulated by RBI for PAPG and PPI. I wanted to understand that in CBDC, there are no private players that are working at this point. So do we see in the future private players also participating, such as Cred or Amazon or PhonePe, who have led the way for UPI and established the mass reach that we were able to obtain? Secondly,
I think let's restrict to one question.
It is very much related to CBDC
quickly.
only. So in UPI and RuPay, we see a lot of interest by now Middle Eastern countries and APAC countries, where they expect companies like us to be able to process UPI. So we get asked questions, can you process UPI? Can you process RuPay for us if we were to do cross-border transactions with India? Similarly, can we see India leading the race of the CBDC, and then people look forward as a tech provider or as a case study towards India that India has led the CBDC adoption?
Thank you.
Yeah, why only Cred, why only Amazon? You can also come and partner in the CBDC world. But I'm saying at this point, we are looking at the banks being part of the pilot. We are trying to have more use cases. Definitely, we will be open to partnerships with the non-banks as well. So that has been the way the digital payment journey has been. This also can be expected to be that way. And I don't want to jump the gun at this stage to see whether we will be world leaders in CBDC, whether other countries will like to emulate us. No, they will have their own experiments, we will have our own experiments. Incidentally, just before coming here, we had a meeting with a set of people who had come from overseas. They were also very keen to partner with us on CBDC. Sometimes I tell our Cred and Amazon guys, you don't have to have marketing guys at all. You can just follow us, because we are the ones who are interacting with the world at large, and when the market opens up, you are definitely in as part of that also, maybe you as well. So I'm saying the various countries that are interested in are also keen to see the way we have developed, including having, say, NPCI, including having the digital public infrastructure as an approach. Those things are being discussed. So definitely everybody here will have a role to play there as well. So you can rest assured that could be a good takeaway for you from this session as well.
So let me go to the online questions now. We have run out of time. Okay, very quickly, please. Very quick question. Short question.
So myself, Smita, I represent TMI Network. I just want to know, like a lot of things are happening, fintech companies, UPI and all these things, but what is the things which you are doing on the awareness side, on the social impact, on the remote areas, and a lot of frauds are happening on the digital payment side. So what are the things you are doing on that? Because I work on the social skilling and all that. So we see a lot of things. So what impact you are doing on that area, that I just want to know.
To whom is the question, by the way? Yeah, it can be for them.
Like anybody can answer it.
Yeah, I know, but these awareness initiatives have to be done by everyone in the industry, not just the regulator. But we are, if you look at other regulators versus us, we have been one regulator who has been heavily into creating awareness. The RBI kehta hai and Bachchan talking about all those things, Jankar baniye. So we have been really involved a lot in creating awareness. Every other day, if you open a newspaper, you will find an advertisement from the Reserve Bank about what to do, don't click on links, all those things keep happening. But it's a continuous activity.
I think there should be something ombuds thing, because on some areas like people, the frauds are happening on the digital side, they don't know where to go, what to do. So on that kind of things, like awareness will be really...
Yeah, I'm very happy you asked this question, because we are very clear that the digital payments also, if there are some concerns, grievances, they can be addressed to the banking ombudsman. We have a separate ombudsman for digital payments also. Now the One Nation, One Ombudsman scheme takes care of that. You are all guys in the media, you are all guys in the rural areas as well. You can actually tell them that there is a very good grievance mechanism available. Let's always think that the narrative you said about there is increase in frauds. It's not true at all. If you say UPI frauds are increasing, that's not true. See, the frauds are not increasing in UPI. People are compromising their credentials, because of which the system and their transactions may get used by getting the credit to another beneficiary instead of the one that is intended to. So you are actually seeing a compromise of credentials. So I would be very happy to change the narrative that it's not a UPI fraud. It's not a payment fraud per se. It's that you have been a little reckless, or you are not aware of what you have to do. If NB say that you don't have to give your PIN for receiving money, people still do that. So those are the things we have to change. Everybody is a brand ambassador, will be very happy. Everybody should say that Indian payment systems are good. You have got very good ways of getting your grievances redressed. Customer liability laws are there. You can actually be protected even if you have compromised something before the actual loss happens. You can complain. You will not be having any other loss thereafter. Multiple benefits are there. If you see our ecosystem, people are spending more on giving this protection to the customer. Simple thing like a debit or credit card. We have come out with a mechanism where you can switch on, switch off whenever you want. Nowhere in the world it is available. And on UPI, let me tell you, there is an online dispute resolution system that is there. If the money doesn't go to the beneficiary, the system automatically takes up and gives you the redressal, and if it is a delay, you would get a penalty as well. And believe me, 80% of the transactions on UPI are getting automatically resolved. So they are all the people who are also will be accepting and partnering with us to facilitate all these things. So,
if I may interject, bank robberies have come down because those guys have learned coding and moved online. So if you look at the overall data, it may not, Okay, so one last online question, because I committed to that. So maybe I'll ask Kunal the question on digital payments and the risks to digital payments, and how do you recover money that is lost?
Well, I think Sir addressed many of the things. The weakest link has been about people having behavior versus systems having compromises, right? And all the initiatives have been to educate. We have to understand that there is an acceleration of growth in payments that happen, whereas the hardware that operates this is us has not upgraded as fast, right? And I think there are many, and it's not right to say that, only people in small towns are having this. Everywhere around us, there is a situation where we need to actually educate and understand simple things, right? For example, not sharing OTP must have been mentioned a million times by now, but that kind of happens still more frequently. So as an industry, like multiple initiatives have been done. We've been working with Play Store, Google, on creating some of these capabilities all of us, our industry has come together to share the list of common practices, and you will realize that the evolution of the risk will keep happening, because let's say now AI is there and many things will evolve to that. But there's a simple thing that to think about, that as a percentage, we'll probably be the lowest in the world in terms of fraud. Now, but the thing is that if you take an anecdote of, oh, my uncle had a 25,000 rupees fraud, then we'll all have an emotional moment towards that. But the point is that as a percentage, look at the initiative of bringing OTP to credit card and debit card transactions probably a decade ago, right? It was probably the most proactive step done, which brought the fraud down to the lowest, like probably the lowest in the world. So I think we should talk in percentages and keep reducing the percentages versus saying that, oh, there is fraud, but it's like saying there is crime. Like we have to look at percentage crime.
Thank you. You have been a wonderful panel and a lovely audience. Thank you very much. We will end the session here.
Thank you so much. May I request Dr. Sagar and Dr. Patnaik to felicitate the panel.
Moderator first also. You have asked the questions, so you should be first.
No, please. So, yeah, thank you.
Thank you so much. I said elephant in the room, crypto. Yeah, sure. I will not vote if you tell me to vote.
Okay, good. Yeah, you have to give it back. Please come, sir, please come to the center. Room for come, please, sir, please, room for yeah. Come closer. Take care, sir. Yeah, sure.
Thank you so much. I request everybody to be seated because we'll start the next panel discussion. The next panel discussion is on are emerging market economies sitting ducks or can spillovers be managed? Our panelists for this session are Dr. Sajid Chinoy, member of PM Economic Advisory Council and MD and Chief Economist JP Morgan, Ms. Sonal Verma, MD and Chief Economist Asia Japan Nomura, Dr. Samiran Chakrabarti, Chief Economist Citibank, Dr. Mridul Sagar, and the session will be moderated by Dr. Tirthankar Patnaik.
Can we start? Can we start?
So, is Rudro around? He's here. You did have the graveyard shift, but you did discuss things which were very important. In fact, absolutely, as we heard in the morning panel, Mr. Dave saying, not a week goes by when we have either some function or we get invited to talk something on AI. The technology-based aspects or digital finance was something equally interesting. So we had crypto and we had DeFi. You made sure that no one really slept. So I have the onerous burden of talking about something more mundane, but dare I say equally important. I mean, I'm talking about, do we really see spillovers from emerging markets? And I have the, the good fortune of asking my panelists some very important, absolutely important questions. These are the questions that we look forward to in the credit policy. What are the changes? What are the views that we have on these very pertinent questions? So with that, my first question is to Dr. Sagar. I have to start with you, sir.
Okay.
Are emerging markets sitting ducks to spillovers?
Well, I won't say we are sitting ducks. We can be sitting ducks if we want to be sitting ducks. So we have tools. We ought to build buffers. We ought to use them. So we need not be sitting ducks. But if we choose to be one, then it's our choice. So the fact remains that the global balance is tilted. I mean, today the financial cycles have deepened. The financial cycles have become very strong. The so-called trilemma, as you know, the Helen Ray's piece showed how the emerging markets really face a dilemma, so they need to curb capital flows. I think there was some morning discussion when Anant was here, the chief economic advisor, and there was this issue of capital flows coming very strongly. So in essence, what we need to do is we need to build buffers in good times, and we need to build macro financial stability. So that's why this theme of the conference was very much, and this reflects the counter-cyclicality itself, because today we are not in a crisis. Today the emerging markets are not facing the spillovers, but it's the good times that we need to think about it and set in place the policies which should be there. Reserves have a cost, yes, but we need reserves. So we can't really bank on the global financial safety net. So we need to sort of, I mean, reserves also are part of global financial safety nets, but we can't really be dependent on swap lines. We can't really be dependent on IMF. Those are resorts we need to take later. The first choice is build your own buffers.
We may choose to be sitting ducks if we want to, and reserves are important. Sonal, if I could request you to take us into this a little more in detail. What happened in 2013? We had a taper tantrum. How have emerging markets coped with taper tantrum, and how have we improved things so far? How can you give us some examples as well?
All right. So on a day-to-day basis, we are seeing that these spillovers from US policies onto emerging Asia has declined over a period of time. And I think the question to ask, therefore, is why are the spillovers less? I don't think anyone is arguing that spillovers from what the US does or how US rates move onto domestic interest rates, domestic FX because of capital flow channels. I mean, the spillovers will be there. But what we have observed is the spillovers have come down. And I think, for India, which was classified as a fragile 5 back in 2013, this is also true of Indonesia, which was also part of the fragile 5 bucket. We have seen some improvements. So one, unlike the developed economies, we have seen, I would say, more prudent policy response to COVID from a lot of emerging economies, particularly EM Asia. So you are not in that position where, you know, fiscal and monetary have been excessively loose or inflation out of control. We've seen a lot of focus on better fiscal finances in these countries. We've seen, you know, the monetary policy framework, inflation targeting framework being quite active. That's been an important pillar. One of the big lessons from 2013 was we needed, as Mridul said, have your own FX reserves buffer as the first line of defense. So countries have done that. If you go even further back to 1998 Asian financial crisis, one of the big learnings for countries was, you know, you should not be pegging your exchange rate, but allow the exchange rate to be an automatic stabilizer. So countries have followed a more flexible, you know, not fully flexible, but a more flexible exchange rate policy. There was a lot of debt taken in foreign currency, short-term debt, which was difficult to roll over. We've seen countries actually shift the external debt more towards local currency. So I think, you know, one, I would say spillovers will be there. Two, EM as a bucket, you know, we tend to club it all together, but it's a motley crew. There are good EMs, there are bad EMs. And what we've seen particularly in EM Asia are countries that have tried to improve their fundamentals because there's no substitute for good fundamentals. And on top of that, you know, you build your safety buffers in terms of FX reserves or swap lines. But, you know, what I would call sort of a more eclectic approach to how do you deal with currency pressures that countries face. So I think things are changing. We cannot classify everyone in the same bucket, and EMs are not just sitting ducks anymore.
You made a very important point. In fact, after the Asia crisis, the EM response in the global financial crisis was far better. You know, relatively speaking, you know, one remembers the fixed exchange rates that countries like Indonesia, others had put in around 97, and what kind of issues had cropped up around that time. So clearly much higher forex reserves, much better buffers, and, you know, in general stronger macro fundamentals, which leads to better growth. Shifting gears a little bit, Sajid, my question for you would be, see, we had the VO numbers come out earlier in January, right. And which, you know, posed a higher growth for the world, about 3.1% is, if I remember right. Who do you think will be the major gainers and losers?
Thanks, Inaugural. Great to be here. Mridul, thank you for an excellent conference. You know, before we look forward, I think it's important to look back. Mm-hmm. And we sometimes take these things for granted. But if we were having this discussion last year, in February, and we said the US has raised rates by 500 basis points, where would US growth be, right? 2022 had been 1.9%. Yeah. Most people with the hand on the heart have said, you know, close to recession, 0.5%. Yeah. US growth accelerated from 1.9 to 2.5% in 2023. Global growth has been far more resilient, despite the fact that China disappointed last year. Global growth only slowed from 3.4 to 2.7. So I think the first thing we have to acknowledge and question is significant resilience, right? Where did that resilience come from? Everybody was so fixated on the monetary tightening and the transmission from 500 basis points of rate hikes that you forgot that there were other things moving in the system. This was not what economists call ceteris paribus, all else equal, because all else was not equal. And what was happening at the same time was, where we were focused on the demand curve, the supply curve was normalizing. That there was more normalization of manufacturing goods supply chains, which meant that there was higher growth and lower inflation. And there was the supply side moving in labor markets, especially in the US, which we don't again fully appreciate. Peak labor force participation between prime age workers, 25 to 49, is today at the highest level it's been, higher than previous peaks. So that return to the labor force did happen, right? And so you had other things, and of course, in the case of the US, fiscal policy turned pro-cyclical. In the sense that, you know, despite growth doing better, the fiscal deficit correctly measured expanded by 3% of GDP, which was bizarre because even as the Fed was fighting to push inflation down, fiscal was moving the other way. But the short point is that we've seen more resilience of the global economy, of developed markets, right? And that's the first point to acknowledge. Now, with that resilience has come divergence. That some, to your point, some geographies have done much better than the others. I think the US has outperformed, Europe has disappointed, Japan did well in the first half of the year. So there is this geographical diversity, and you're getting a sectoral divergence as well. That goods fell very sharply, services held up a lot. So it was a complicated story, and I think going forward, one can expect much of the same, in the sense that US growth is expected to still hold up relatively well, as per the IMF forecast in 2024. Europe is going to increase, but still be less than 1%. So we don't have time for it today. The big analytical question is, why has US done so well and Europe not so well? And if Europe has not done so well, why are European wages so sticky and European labor market so tight? But that's a good question.
Into recession, I suppose. Yeah.
Well, the supply side response was much weaker in Europe, and that's a whole PhD thesis about flexible labor markets in the US versus much less flexible labor markets in Europe. But let me summarize by saying we've seen tremendous resilience around the world because of the factors I mentioned. Households in US, consumers in particular, have been the epitome of this resilience, right? China has disappointed. The question going forward is this resilience going to be accompanied by lower inflation that makes for this perfect soft landing in 2024 that markets until recently had priced in? Or is the resilience going to be too much of a good thing, and that you will still, the odds of a hard landing have picked up? I'll end by saying the following. You looked at the inflation print of the US that came out two nights ago. Services inflation remains very, very sticky. The reason core inflation has come down is because goods were in deflation. And that was in large part because China was exporting disinflation. Now, our China economists say that process is troughed. At the margin, China's disinflation exports will be lower. If you look at the US inflation basket, goods prices have now begun to stabilize and pick up. And that, in a way, is not good news, because it suggests if goods inflation remain where they are and services don't come down and labor markets remain tight, then all these expectations that we have that central banks can start easing interest rates in the next few months and engineer the soft landing, will not be met. So I'll end by saying lots of resilience, but the resilience doesn't necessarily, resilience with divergence, sectorally and geographically, but that doesn't reduce the policy challenge that lies ahead.
No, it doesn't. It doesn't. In fact, Samiran, my next question to you is, when do you see a pivot, if at all? Sajid says it's very difficult.
Did Sajid say that it's very
difficult?
No.
I said don't take it for granted.
I'm not taking it for granted, but what do you think?
First, let me thank Mridul for bringing a macro conference into Mumbai. It's always been a thing of Delhi. Being a Delhi boy for a long time, I miss it in Mumbai. So I hope we get to see it every year. Sajid has touched upon quite a few things, and I'll say where I agree or disagree. But first, we need to understand that while Sonal was making a point that EMs are different, we have to also understand that increasingly the nature of spillovers are also different. Our natural bias is to think that the spillover is only coming from the developed world. I think we have to increasingly start thinking of spillovers coming out of China. If we have this same topic being discussed in Singapore, I can tell you that the direction of the discussion will be very, very different. Everyone there is worried about how China demand spillover, which was the story of the past, is now being converted into China supply spillover as the story of the future. Because China is sitting on now excess capacity on a whole lot of stuff which these countries were good at exporting. So how these countries now, these EM countries now cope with their new growth model? Because ultimately, while we can think of the economic stability parameter on one front, fact of life is that EMs need to grow faster than DMs. So you need those drivers of growth also to be in place. And that's where I think it becomes important that when we think about global spillovers, we just don't think spillovers arising from Fed rate cut. We also think about how the spillovers will come from a place like China. And there, I guess the one point which Sajid very clearly brings out is this goods versus services issue. And I think where we economists got it wrong in hindsight is that we focused too much on the monetary policy to control inflation and somewhat underplayed the role of fiscal policy in boosting inflation. For a very long time, fiscal was contractionary across the world. And suddenly fiscal turned very expansionary. And we kind of did not factor that enough into our calculations. And the other area where probably we got wrong is this labor market being extremely tight in US and the spillover effects of that. Fact of life is that if US wage growth is more than 5%, then on a sustained basis you cannot have US inflation at 2%. So then everything boils down to Fed cutting, not because it has reached its 2% inflation target, but because it feels that the real rate in US is much higher than what the growth equation would suggest. City economists believe that US will go into recession sometime in the middle of the year. The main argument seems to be coming from the labor market side, that certain labor market indicators are turning softer. And in the past, we have seen that that softness can very quickly translate into higher unemployment rates and lower wages. So if that sort of a thesis one brings in, then through the real rate argument that then even if real rate is 250 basis points, that's too much for an economy which is getting into recession or coming close to recession, you could argue for rate cuts. Citi's house view is of 125 basis point rate cuts in 2024. It's a bit of an outlier in the market, but the fact of life is that if the nature of inflation is a bit more structural and not just cyclical, then this might not be true. On the other hand, if China is exporting as much deflation as they are today, then who knows, 6 months down the line, we might just say that, look, what's the problem? Fed can cut as much as they want.
So I have a related question, Samiran, just for you. Do you see divergence? I mean, you answered us for the states, but where do you see other major central banks? What do you see them doing?
So at this moment, if you look at it, Japan is in recession.
Yeah.
Europe is in recession. UK is in recession. Yes. Except for US, practically the entire DM is in recession. So there is a clamor for rate cuts everywhere. I mean, of easing of monetary policy everywhere. The only thing is that once central bankers have got their sort of forecast so badly wrong on inflation, would they be that much more cautious in doing the first rate cut? Would they want a bit more comfort that actually the inflationary trends are definitely down? They don't want to get shocked again that they ease policy and then 3 months down the line, inflation picks up. And who knows, we have not yet got there, but there could be this whole geopolitical thing, Red Sea, whatever, creating another round of supply side shocks. So somewhere, although the dynamics are very different in different DMs, but in one aspect, the central bankers everywhere might be very similar, that they will be cautious in doing the first rate cut.
Mudal, question to you. You know, you were a part of the MPC. What do you think will be our central bank's thoughts on what Samiran just pointed out?
Well, I thought Ashima was here.
I think you need a mic.
You just have to press this. Hello. Yeah. So I was saying Ashima was here, who is the current MPC member. Chetan is here, who was past. But since you're directing it to me,
I have you here now.
So let me make it one thing very clear. The way I see in India, India didn't do the aggressive monetary tightening which the advanced economies did. So central banks all over the world were behind the curve. So that's one thing. But the advanced economies have made good by significant tightening. I mean, from March of 2022 to July of 23, 525 basis point is the most aggressive Fed action in 4 decades.
Since Volcker.
Yeah. So, in essence, I think now they are reasonably soft landing. I'm not saying that the risks, as my colleagues here have pointed out, like from the market, basically there are a significant amount of risk still there, and that's why that may delay the pivot what you are talking of. In India, we didn't do that kind of tightening anyway. So is there really a need to pivot early? I mean, we have to be very careful about it. So long period of higher than the target inflation, some kind of averaging behavior is there, also requires that you shouldn't let the price expectations of a higher order anchor for long. So you don't need to prematurely ease. But yes, if there are more shocks global on the way, at some stage, if geofragmentation increases significantly and there is a global downturn, which also spins off into India, then some action would be called for. So when that happens is anybody's guess. So, as unknown was Anand Narayan's theme. So that's something I won't want to hazard a guess. The earliest we could see is June, but it could be very long period, and that makes very little sense to start on a easing cycle when you can't really cut much.
You've raised the same concerns that Shamiran did actually. You really don't want to move first and go wrong.
So it's not move first among the central banks. That's not probably the consideration. So what is more a consideration?
Move early and go wrong.
Yeah. So that's fairly, I think, logical. I know Sonal has a view about a stronger slowdowns she's been holding for over a year, but I would.
Sonal Sinuple, please. Yeah. Let's hear about it.
About
you have a stronger view on the RBI pivot, as Biddle says.
I mean, I think RBI will do how macros play out. So I think the central view that RBI has right now is growth is strong, sustains into next year. Private capex is picking up. It's broad-based, and core is down, but headline is still up, and therefore we need to basically stay on the path, and which is fairly fair in terms of the current macro outlook. I think where we have a more divergent view is essentially, as Mridul was saying, in terms of the durability of growth next year. Primarily because when we look at the composition of what's driving growth right now, it seems to be driven largely by public capex and discretionary demand on the urban higher income side, whereas rural and private capex, I would say there are pockets of strength, cement, iron and steel. Autos, but it's not the kind of broad-based capex which is what we want. So if that is the nature of growth, then in terms of the forward-looking outlook, we have tight liquidity. We are tightening on macroprudential norms on unsecured loans, which from a prudential point of view I completely agree with. But of course, this will have some spillover in terms of driving forward discretionary consumer demand. We're getting into an election cycle. We know that once the model code of conduct comes into play, new awarding activity will slow for a period of time. So it could mean slower capex and spending over 1 to 2 quarters. So if we put all of that together, then I think our basic view therefore is FY25 will see a softer growth, particularly as we enter in the first half. So we are looking at around 6.2. I think, and this is one debate, as economists we've been having, is why core has seen such a significant disinflation despite, growth at 7.3. My view is India is a supply constrained economy. We don't see disinflation till there is weakness in demand. I think, multiple things might be happening. You've seen commodity costs come down. You've seen consumption being soft. Maybe statistically adjustments haven't happened. But the underlying run rate on core is such that I think the convergence of headline will happen to core in the back half of 2024 calendar year. So under that thesis, I think the pivot should come through. But I'll take a step back. I think more than repo rates, it's really liquidity that drives transmission in India. And I think the fundamental concern right now is that banking system liquidity is quite tight, and which will have forward implications on credit creation also.
The recent budget's thought process going from a 5.8% fisc to a 5.1% fisc and then on to 4.5 by FY26. Does that factor in this calculation? I mean, sorry? No.
Thank you. We have a monopoly here. So before I talk about fiscal, let me just put my 2 cents on monetary. And this may not be a popular view. I think the core inflation argument, Sonal, in my mind is less of a puzzle, because I think you have to look at stocks and not flows. If you just, this is what we've been using to guide India's recovery or EM recovery from the pandemic, just draw a pre-pandemic path and say we were having this discussion in Jan of 2020. And I said India's potential growth is 6%. I think there'd be few people who would object to that. If you draw a 6% line, right, and then you ask yourself, what is the level of output today? Despite 7% growth this year, we're still 4.5% to 5% below that, right? And that to me tells me there's slack in the economy. And you can see the slack in parts of the labor market, you can see the slack in capacity utilization, you can see the slack in the evolution of wages. So I haven't been particularly surprised that core has come down, because slack will exert this gravitational disinflationary force. In my mind, much of the core inflation pickup last year was goods. Input prices surged to the point that firms couldn't but pass it on. The middle input prices have come down and commodities have stabilized. Goods inflation has come down. Services is the dog that didn't bark in India. Services inflation, with or without housing, has been consistently below pre-pandemic levels. And because services is your non-tradable inflation, it kind of reinforces the hypothesis that labor markets are not that tight in India. There is slack, and therefore you didn't see much non-tradable inflation. Second quick point I'll make is, I know there are Chetan's here from the MPC, Nidhul is here, but monetary purists would say that in an inflation targeting regime, you should use rates and liquidity for inflation. And this is a financial stability issue, you should use macroprudential measures, and I completely agree with that allocation of labor. But in India's case, there are many tensions in emerging markets. One tension is, and I think Sonal alluded to this, is inflation is much lower. There's comfort on core, headline, hopefully there'll be comfort this year, but there's a lot of financial exuberance. And we've seen the RBI use a lot of macroprudential measures to just slow things down, right? Credit, quality of credit, you'll see a huge BOP surplus this year, equity valuations. Now the conservative or conventional thinking is you use different instruments for different objectives. But if you read Bernanke's latest book, Bernanke changed his mind. 15 years ago he thought the same thing, that you should not use monetary policy instruments for financial stability objectives, right? You should use macro-prudential measures. But then he realized 10 years later that this separability argument is clean on paper, but very messy in practice, because monetary easing, especially if it's premature, actually there's a lot of evidence now to show fuels private sector risk-taking. So in a way, if you're putting on more macro-prudential measures to reduce the financial exuberance, but you're easing monetary policy at the same time, you're in a way you're undermining your own objectives. So I'm not saying that should be the primary objective. Inflation targeting has worked very well. It should focus on that. But you can't help but think that central banks will also take into account there are some situations where you want to be cognizant of the implications of your easing on financial stability. Very quick point on the fiscal. I think it was a consolidation that was bold, necessary, much needed in my mind, and therefore needs to be complemented. Despite very strong growth this year, India's public debt to GDP, we've discussed this, Mridul and me, will actually increase. And that tells us that in peace times, outside of crisis times, the consolidated deficit is much too large. So to stabilize debt and bring it down and create space for the next shock, which prudent macro policy must do, the combined deficit has to come down. The state deficits will actually widen this year after a long time. So the center had to do what it did, and I think needs to, and I think that process has started, needs to continue, which goes back to Sonal's point. If the public sector is forced to retrench, then growth prospects are going to depend a lot, and monetary policy is constrained from overacting for the reasons Mridul mentioned, then the growth prospects will depend on how vibrant and how broad-based private sector growth is.
So before I go international again, Samiran, one last question here. When do you see private corporate capex coming back? Yeah, we know some parts of the system have seen. 10 years
So,
now, please.
First, I think the problem in answering this question in the market is that people don't have a good sense of what reference point to use. So the natural instinct for people is to think 2010-12 or 2006-8 and say that, oh, private capex is nowhere close to those times. And I'm quite sure that we are never going to get back to those levels of private capex. Those were exceptional levels of private capex. So those 37-38% of GDP investment to GDP ratio, I don't think we are going to achieve in this cycle. Part of the reason simply is that the nature of private capex is changing. I just give this example that the data that RBI puts up on spending on private capex, or rather lending to private capex, that data has a size parameter in it. And in 2012, there were 28 projects which were quote-unquote large projects. And then for next 8 years, the sum total of large projects did not reach 28. Okay. So we are not doing large projects anymore. Part of the reason is that we are not doing, say, let's say a thermal power plant, which was a large project always, or large airports, those kind of stuff. So that itself will kind of bring the overall capex number lower. The second issue is that we are doing huge amounts of digitalization, mechanization, which improves productivity significantly, but is not as capital guzzling as some of the other sectors. So that improved productivity in turn would require less capex. And the third thing is that we have to understand the mindset of private producers in this country. They had 10 years of a capex drought.
Yeah.
And after that had shocks like COVID, Ukraine, now Red Sea, Israel, Hamas. Every day you open the newspaper, there is something new of that sort. In this sort of an environment, for anybody to think of a 8-10 year long private capex horizon is extremely difficult. So the capex horizon is shrinking to 3 to 4 years, where people are more comfortable, they have demand visibility. By the way, the points that Sonal and Sajid they were making, if those points are correct, that the demand side is actually significantly weak, then the need for private capex will be that much lower. We should not forget that in last post-COVID in 4 years, the cumulative inflation has been more than 30%. And a large part of this country's population has not seen income growth of more than 30%. So that is itself in depressing demand. So on top of the uncertainties, if there is uncertainty over demand also, then we might actually see private capex being delayed or less than what the market wants it to be. And this is despite all the great arguments on how the quality of balance sheets on both private corporate side and the banking side has improved tremendously, how the government policies have become more favorable towards private capex. Despite all those things, because of the reasons that I mentioned, you could see a more muted private capex, or you could have to change your lens to understand private capex.
How do I see 4 years of 7+% growth then?
So the growth number is mostly coming from public capex, or a large part of it is coming from public capex, and part of this is also catch-up consumption spending. The consumption that did not happen over COVID, that part of that is happening. Sajid mentioned the number of the gap between where the trend line GDP versus current is 4.5. But what is interesting is that he was here last year, he would have told that number to be maybe 10%. Or
10% gap?
9%.
5, okay.
So that gap is narrowing, and that gap has to narrow. So that will give you growth to some extent. But this growth is not what the private corporate would want to see. Wants to see a more sustained demand growth, which probably at this moment is not happening.
Thank you.
And could be the reason why core inflation is also low.
Yeah, that's down below 4%. Mridul, my question to you, what kind of financial safety nets are available today or needed in the international architecture to prevent, or we've sort of come to a position here that I think all EMs are not the same. To use Sonal's terms, they are a motley crew. Some have done well, some have not really done well. But do you see any room, or is there any need for any change in the current international financial architecture to be even more protected towards future crisis?
Basically, a lot of questions again here. If I see the global financial safety net today, it actually comprises of the reserves which the country hold, but that is pretty lopsided in the sense that few countries have very large reserves, and it doesn't really afford a safety net in true sense to everybody. I mean, if you calculate, around 90 odd countries account for 97% of the international reserves, and the rest account just for 3%. So the other half doesn't have reserves. So there is an imbalance on whether you have safety net for everybody, especially the low-income countries don't have that safety net of reserves. Second issue which comes in is that in terms of the size, see, if you need to add the reserves with the IMF firepower, and then the bilateral swaps. And we have here from Bundesbank, so he'll know about the ESM a lot, and the regional financial arrangements, which also are significant. Both the bilateral swaps and the regional financial arrangements today provide a safety net bigger than, each of them provide a safety net bigger than the IMF firepower. And that's a very significant shift in what the global safety nets exist now. Are they usable? Clearly not. I mean, very few of these RFAs or the BSAs, the bilateral swap agreements, have been used. We have entered into BRICS CRA arrangement. We have swap lines with the SAARC countries. The swap for the SAARC countries are often used, but rest is not used. Now, can we have a bigger firepower with the IMF, which is sort of well managed? But is there a willingness in the advanced economies to do those reforms? I don't see necessarily, because quota revisions have lagged, quotas have been diluted, they have been substituted by new arrangements to borrow or bilateral swap lines, and therefore the effective power of the global financial safety net has weakened considerably. I think we need to address this rather than the sheer size issue, but the size issue is also worrying me because it has come down from 4.3 trillion pre-pandemic to 3.5 trillion after the pandemic, and global debt levels are now rising sharply. I mean, at 116%, 112 for last 2 years of the GDP for on an average for the globe, and that can, for some of the countries like US, it's going to head to 136, 139%. So that's a big worry to me that global financial safety nets are falling while debt levels are rising.
I need to bring geopolitics into the game now. See, what you mentioned, Mridul, presupposes a lot of coordination, a significant level of coordination, which has emerged out of the post-World War II rules-based international order, which is increasingly being questioned today. There are a lot more claimants to the throne, as it were. So, where do you see cooperation in this framework, and how do you see the lack of it affecting this protective armor that countries have?
Yeah, so I think we are shooting ourselves in the foot, because this lack of global coordination is really a huge economic cost across countries. I mean, the geopolitics has taken the front role. We have to cope with these harsh realities that's happened, but nobody today talks that free trade is the best policy. Even the advanced economies have stopped talking about the free trade, and they're all talking about the second best and the third best practically. So global growth is dragged because of that. Global finance is dragged because of that, and we see more bubbles and bursts coming in. So I think we need a very strong sort of a counter push from the academics, from the G20 to sort of counter this trend, because otherwise it's a Nash we are all facing. A Nash equilibrium is falling.
I want to shift a little bit towards supply chains, Sonal. What do you think is happening with supply chains today? How are countries dealing with? We've heard about significant supply chain issues all over the last 2 years or so. Where do you see things improving? And a related question to you would be, as countries are shifting away from China, there's a China plus one strategy that many people sort of talk about. Where do you see India coming?
Right. So I think so ensuring enough supply for so one is the aspect of shifting supply chains from China. I'll take that separately. And then you have the supply chain issues because of these geopolitical disruptions, climate change, in terms of access to food, energy, critical minerals, which is one priority for most countries today. I think like in terms of building our own resilience, therefore it becomes important to build strategic reserves of food, oil, in order to have that buffer in case of any particular shocks. It is very important to diversify our supply chains, wherever we are procuring our energy or food. Thankfully, we are largely self-sufficient, barring a few products. So there the focus has to be more on how do we improve production, productivity more going forward. But I think still in the case of other critical food items and on energy, like I think diversification of supply chains is quite important. You cannot any longer put all your eggs in one basket. And the entire sort of management of supply chain inventory has got to move from just-in-time to just-in-case inventory cycle. So the thought process around how one does inventory planning, etc., needs to change. So that's one part of it. There can be more government-to-government, coordination. Yesterday, the governor talked about food corridor, critical mineral corridor. So there are those issues. The second aspect is the shift in supply chains from China, which is basically the goods supply chains which are moving away from China. I mean, we've done some work on this. I would say, first of all, China is still very important. Even with all the shifts that have happened, like majority of the production across majority of the products is still happening in China. So when we are talking about the pie that is moving away, it's actually a fraction right now. It could turn into a flood over time, but as of now, it's a small pie. What we find is, though, that this reallocation of supply chains is benefiting different countries in different product categories. So Vietnam is seeing supply chains move both on labor-intensive product categories as well as on electronics and others. You have the likes of Bangladesh, Cambodia, which is more textiles-driven. Mexico is seeing supply chains on auto move because that's also closer to US, so that becomes much easier. For India, the benefit we've seen is mainly on mobile phone on the electronics side, where back in 2015, India's share in global electronics exports used to be around 0.3% of global exports. Today, that number has gone up to around 1% and rising. So we've seen a benefit on electronics, but some of the other supply chains that are moving from China, I think we still need to see them move into India. So uprooting supply chains is not an easy process. So this is a 3, 4, 5-year story we are talking about, but we need to essentially ensure that we benefit from more of these firms that are moving away from China, and also move up the value chain so that the value addition that we are doing domestically is increasing and we are not just doing the assembly job.
I agree. The value addition will take time. I mean, one is very pleasantly surprised with India actually exporting iPhones. This was not thinkable maybe 4 to 5 years back, but now today we are doing it. I have about 5 minutes. I'll open it up for questions. Please identify yourself and keep the questions very short. Are there any online questions? Yeah.
Patch. So I have a question regarding RBI. RBI's move. So now RBI there's a kind of a thinking that RBI will move after the Fed moves, and this is the theme for the EMs generally. What we have seen. We had a session earlier as well. There was discussion of India decoupling with the US in terms of monetary policy decisions. What is the take on that? Are we really in a position to decouple with the US, or are we still worried about the carry trade that will come up? If
you spoke about it, but you want to talk about it
very quickly. I just broaden the discussion out. I think one has to distinguish between EMs not going through a crisis and the resilience they've built, but the fact that they haven't still extricated themselves from the trilemma. And you're pointing to something very important. In Latin America, many EMs raised interest rates much before the Fed to levels that were much higher to protect against the implications of what the Fed was doing. In Asia, the FX buffers worked, but that doesn't mean that monetary policy is fully independent. And I'll give you a small example. From last September onwards, what you saw was de facto tightening of monetary policy in many Asian central banks using different tools where liquidity was tightened, so that overnight call money rates or short-term money market rates went up. And that was, in a way, designed to reduce pressure on the currency. So I think while we've made progress on that front, I think it's too simple to say that buffers allow EMs to completely divorce their monetary policy from the Fed, because there is still this significant preference to intervene in the FX market. And you're seeing this across Asia, in particular in this cycle, that there's a lot of intervention in the FX market. So as an economist, my preference is that if you want to break the trilemma, something has to give. That capital accounts are now open and to some extent irreversible. And so the choice is, if you want to have some more degree of monetary independence, of course there are never corner solutions, you have to let go of the FX a little bit. But because Asian central banks have been intervening so much in the last 6 months, it's a sign also that they don't let go of the FX, and that means that interest rates cannot be fully divorced. Last thing I'll say is, this is going to create a tension, because the cyclical position of the US and many EMs is very different. So if EMs, even to some extent, are importing tight monetary policies from the US, that may not be in their best interest given domestic growth inflation dynamics vis-a-vis where the US is.
Thank you, Sajid. We have an online question which I will pose to Shamiran. What happens to India after 2 years when, say, Chinese and the Chinese economy starts recovering fast?
There seems to be an assumption in the question that in 2 years' time, Chinese economy will start recovering first. So, I'm going to play with the assumption and not question the assumption per se, because then that will be a different answer altogether. So there are two different channels one needs to look at. One is what happens to the real economy and what happens to the financial economy. If you look at the real economy part, the fact that world GDP growth is so weak and below trend in the last couple of years is partly because of China. And if China is recovering fast, that would mean that the entire supply chain along with China, and I'll go back to what I was saying a while earlier, that there was a big chain which was dependent on the Chinese demand. That chain will start doing well. And that would mean that overall global growth would improve, and in turn that should help India as well. Typically in periods of high global growth, it's a tailwind for almost everyone. Then no one talks about the relative growth. If you go back to that 2004 to 2008 period, no one complained that China was growing at 10%. Everyone was happy with India growing at 8%. So that sort of a thing will work. The financial side is more complicated. I think there is a ongoing thesis in the market that capital is coming out of China and going into India. Honestly, I need more proof of this thesis because if you look at the portfolio equity capital, most of the Chinese investments are out of EM funds. And similarly, Indian investments are also part of EM funds. The India dedicated funds are actually very small in number. So if the EM fund starts getting more flows because China is doing well and rest of the EM is also doing well, then we can be also floating better in that sort of a scenario and start getting more capital flows. I know that it sounds very odd to think about it that way, but the quantum of inflows probably matter more than the relative share of flows between India and China. The debt side, anyway, India had a relatively lower share of flows. That is going to change after this bond index inclusion. I don't think that will materially be impacted by the China story. But last, I must say that at this moment, the questions that are posed on China are very, very fundamental in nature from the investor's perspective. So just 1 or 2 quarters of good Chinese growth are not going to remove those questions. So when you're saying that China will recover, that recovery needs to be a very broad-based recovery with a lot of boxes to be ticked.
Any questions from here? So, I'm Bhavesh Bhatia from Accurate Study Center. My question is to the panel. The credit rating of India is low since past 20 years due to biased opinion of Western credit companies like Moody's. So, it might not become, it might not be a specific reason for spillover, but it could be a resistance to India becoming a developed market.
Sajid? Biased opinion of credit rating agencies, and that is stopping us from becoming a developed market. Do you agree, first of all, with this?
I mean, credit rating agencies have their own framework. So, the weight that is put to fiscal deficit, public debt, in some cases, per capita income. So some of the parameters that are used to make an assessment, and you're comparing different countries. The framework is such that India ends up ranking low despite having faster growth, despite reforms, despite, better external fundamentals. So, it's their framework. I think, it is what it is. But I don't see this as a constraint. Like, if you look at the dollar bond issuances that are ongoing offshore, the spreads at which companies are raising money is very tight, and it's actually much better than triple B minus rated already. So effective on the ground is actually reflecting much better rating, even though sovereign rating is at triple B minus. And I don't see this as a constraint at all. I think if we continue to do what we need to do, rating agencies will catch up.
Just one very small point. I'm sure most of the people in this room know this, and I'm not a representative of any rating agency, but there should not be any confusion that the rating is on the sovereign's ability to repay. It is not a rating on how good or bad the economy is. And because it's a rating on the sovereign's ability to repay, for obvious reasons, the fiscal parameters will dominate the rating and not how good we are doing on 15 other things.
Repay foreign long-term debt. Yes. Yeah. Another question, please. We can go there.
Debt to GDP ratios are not falling.
Yeah.
See, we had this debate in the inaugural session when Ananta was there. We had this again, and this is the third time I'm seeing a rating question coming back. What is very significant is that we touched 89% of the GDP on the pandemic year 2020, but once growth improved, this came down. But we are stuck at 83%, and it's actually destined to, even with this fiscal consolidation, it's actually destined to marginally increase from here. So where is the issue? I mean, Samiran actually clarified that they give a lot of weight to the fiscal parameters on this. And we had heard Chetan on significant issues on this kind of very solid work on how the framework would occur for the debt management. Some suggestions were there. And we will have this discussion probably again when we discuss the bond index inclusion. But we need to be very clear that the ratings are a function of debt sustainability with the highest weight is on that.
So 2 points. One, Mridul, you have a question here. You did mention global debt GDP ratios are rising and US is at 135%. What are the steps to control this? And a related point to your debt GDP question for India, in the FRBM framework, correct me if I'm wrong, but we need to get down our debt GDP ratios to about 40-45%?
60%.
60%, sorry, 60%.
Yeah, but that's something now not being even considered on the card because we have a long journey to 60%. But I think if we are able to get down below 80% in the near term, at least some of the risks will wane. So I think we should first move towards that, and that's why this cut in fiscal deficit is extremely important and should continue. But coming to the other question which you just mentioned about the 135% sort of debt ratio for US, I have no doubts to my mind that this is going to be a problem, because today US is to face whether they should bring down the fiscal deficit from 9% plus number last year to below that, or let the debt ratios rise. And I think markets will be very sensitive, even though US has exorbitant privilege about the dollars, because if they sort of try to inflate the debt away, there could be also macro stability problems. So it's a very vexed problem that the US has. The bigger problem is even China. China is going to hit 100% debt to GDP ratio in the coming 2 years. And I think that is something which the markets would really rip it apart. And that basically, I think Samiran did mention, these are not short-term issues. So a little bit of it is not going to solve that problem. I think the ripple effects of China could even hit us, because EM are often treated as a pack. So we have to be very wary of how these are to be deflated.
Yes, sir. Go ahead.
You want some interesting news? What happens in November if Donald Trump wins? You most likely will get a tax cut, which may blow the fiscal further. You may get an import tariff across the board, which will mean high US inflation, which means monetary may have to be tighter. And if all of us just said that EMs have to follow to some extent US monetary policy, right? Think about those impacts. So I think we are, what is the Chinese proverb? We live in interesting times. It's going to be another interesting year till November, first week of November.
Let me
Thank
give
you.
an interesting trivia also that the last time when this happened was post-World War II. US debt went up from 40% to 105% and then came down to 50% within 10 years. So it's not that US has not done it in the past. And we can go into how they did it, but that example is also there.
So we are out of time. I wanted to give
Can
all
I
my
just-
panelists.
sorry.
Of course. Sonal, one sec. I wanted to give all my panelists their 90 seconds, but these guys have already taken it. So, Sonal, please.
No, I think there's been a lot of discussion around China and EM. I would say that, more and more we are hearing from investors in terms of EM ex China. So I think people are taking a more differentiated view. And if, if we had known that China would be as slow as it has been in the last 24 months and the kind of property sector issues it's seeing, I think we would all be very surprised with how strong growth has been in rest of Asia despite those spillovers. So I think the other countries have some growth buffers. Investors are differentiating. They are asking for EMX China products. And I do think India is benefiting as a result of that.
I mean, the MSCI weightage for India, I'm sure everybody would have, know, 6% to 18% in how many months? It's about 2 years. That's where we have come. I mean, China is still at 24%, but in the MSCI weightage for Asia, India is at 18% today. So we have time for one last question if there is one. Yes, please. The lady at the back. Yes, ma'am. We will get a mic to you. No, mic works. You have to long press the. I learned that yesterday.
So one question on the liquidity situation. So right now the liquidity is in deficit, and some of the participants have been saying that RBI is kind of micromanaging the liquidity. So how do we, see the trajectory going forward? And if we see some easing, can we say that it is the start of the easing cycle by RBI?
So yeah, this is, as Professor Ashima Goyal was saying to an earlier question, this is out of syllabus, but you can take it. Certainly out of syllabus for this session, but please.
Yeah, I think one thing that we do think is that in terms of the sequencing of policy reversal, it will start with liquidity before we talk about any kind of interest rate cuts. Therefore, the focus for us going forward has to be on the kind of liquidity support measures come through. But within that, I think it's important to differentiate between frictional and the more durable components of liquidity. Right now, what one should expect is sort of more frictional measures to address the liquidity. I think one thing we have not seen and which would help would be more longer dated VRRs for a larger quantum so that there is greater comfort around banking system liquidity. And if we get to a situation where liquidity is too ample, we can always do a VRRR and mop it up. But I think right now we need to see more longer dated VRRs and of larger quantum to at least address the frictional issue so that the weighted call rate actually does get closer to the repo rate. And as we enter FY25, depending on how the macros play out, I think we will probably need to use either domestic or foreign asset expansion to create more durable money supply in the system. But I do think liquidity is the first thing to monitor.
Thank you, Sonal. We are absolutely out of time. Thank you, gentlemen and lady. Thank you so much.
Thank you. May I request Professor Subhashish Ray to felicitate the speakers, please? We'll take a short break for 15 minutes. A short break for 15 minutes. Yeah. Yeah. I request everyone to be back here in 15 minutes, please.
Hello, my chick. Hello. इसके लिए को hello, my chick. Hello, my chick. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hello, my chick. Chick.
On macroeconomic and financial market implications of India's inclusion in the bond index. Our panelists are Mr. Vikas Sheikh, Head Index Research Asia, JP Morgan, Dr. Sajid Chinoy, who was part of our panel earlier, Mr. Jayesh Mehta, former MD and Country Treasurer, Bank of America, and the session will be moderated by Dr. Mridul Sagar.
Thank you. We had almost 4 years of pilometrics where we were sort of wondering whether there will be a bond index inclusion or not. And so finally we arrived at the destination, and thank you. I mean, it's a momentous moment for India. I know the problem is we don't have enough knowledge about what this bond index inclusion would do. And we're thankful that you came here. And so I would request you to first take us through the brass tacks of what the bond index inclusion is. Not inclusion, but what is the bond index first, and what is its composition. And we'll then come to what the inclusion does, and we'll open up for discussion around that, the macro financial implications. But JP Morgan is not the only one, and probably we will soon have an announcement by Bloomberg Barclays. And I think the FTSE one might take a fairly long time. I don't expect that to happen that fast. But I think these two bond index inclusions have the big issue of how much would crowd in. What has been the history around these? So we want to know from you. So over to you for the next 10, 15 minutes.
Right. Hello. Good afternoon. Thank you very much for having me here, Dr. Sagar. At the risk of insulting... No? Hello. Hi. At the risk of stating the obvious, Dr. Sagar, you mentioned indices and bond indices. Up until last year, many people, well, even within the firm at JP Morgan, were surprised that JP Morgan has a flourishing index business. And over the last year or so, we've had several inquiries, several meetings, several discussions on the topic. So we do have a bond index group here. Think of us like the less exciting version of Sensex and Nifty, right? So bond indices, basically fixed income benchmarks for the bond instruments. We are largely known for our presence in the emerging markets, specialization in emerging markets. Over the last several years, there have been a few high-profile engagements with central banks around the world. The last big market before we included India was China a few years ago, just around the onset of pandemic. And on this slide here, you see it's a trend that we notice in the world around in terms of how flows are being managed, how assets are being managed. Assets are increasingly being managed benchmark to indices. Flows are increasingly turning passive. And if you see the trend line over there, over the last several years, the number of countries that find their presence in our benchmark indices has been steadily rising. Some of the hard currency indices, the dollar-denominated bond indices, as you can see, have had the number of countries go twice over the last 10 or so years, or thereabouts. We have indices covering across asset classes within fixed income, so corporates, quasi-sovereigns, sovereign, local currency bonds, dollar-denominated bonds, and thereabouts. I'm happy to stand up portfolio or a product brochure if at all anybody's interested. Now, what that does is, once you have an increasing number of participation coming across into these benchmarked indices, your active share into these markets goes down. Your tracking error as a result goes down. So nothing too fancy over there, something that you're obviously aware of. The brass tacks, as Dr. Sagar was saying, the index in question that we're talking about is the GBIM Global Bond Index. It's a fairly concentrated index, only about 20 or so countries in the benchmark for the moment. It has about $250 billion in assets tracking it. GBIEM Global Diversified is one of the variants of that index, and that has the largest following. About 90% of assets that are benchmarked to GBIEM track the GBIEM Global Diversified benchmark. The rules of the benchmark are listed out over there very, very briefly. Your local currency sovereign bonds need to be a size of $1 billion or more. They need to have a specific maturity. We need to have pricing, so ample liquidity and so on. The index inclusion is not a unilateral process. We just don't decide suddenly that a country can become a part of an index, an instrument can become a part of the index. It is a very much engaging process. We reach out to clients. A lot of times clients will reach out to us saying, this country seems to be ready, we can trade these markets, why is this not a part of your benchmark? Ideally, that would be a great situation to be in. Oftentimes, some clients will come to us and ask about a particular market. Sometimes central banks would want to engage us about inclusion into these markets. So over the last several years, we have been talking to RBI about potential inclusion, what steps they could take, what are client concerns, and so on. So this very, very briefly highlights the steps that we take in terms of client engagement and the stakeholder engagement. We, every year around the summer, we reach out to clients with a proposed consultation. These could be markets that are on the radar. For example, India, that was announced last year. Before that, we had China, we had Egypt. Right now, since last year, we've also added discussions on taken back for the next iteration of these. In terms of markets, whether or not this market, India as a market was ready for inclusion, as we know, it's one of the largest markets globally and become a part of the benchmark. It's just a question of when, not if. India would definitely be a part of the bond indices, right? It's just they needed to take care of certain hurdles, certain problems that clients have. Once again, with respect to the nature of the instruments that we have in the Indian market, mostly longer dated bonds, longer dated securities. India has one of the longest dated maturing bonds in the market, and it will be similarly reflected in the benchmark as well. So the duration of the index is likely to go a little bit higher once Indian bonds start to make their representation into the index. Consultations with clients over the last couple of years, the numbers Thank you. The confidence rate that we have from the clients has been in the high 60s. So the year before, I think it was 60% or thereabouts. Last year, that went up to closer to 3 out of 4 investors saying, yes, India should be a part of the benchmark. Overall, that kind of gives us we know India is going to hit a weight of about 10% in the index once the inclusion is, or the phasing in is complete. We also have a smaller local currency regional benchmark index called JADE, which will have 20% of representation from Indian bonds. JADE is relatively a very, very small index. AUM tracking it is only about 20 billion or thereabouts. Some of the indices listed there, as Dr. Sagar was highlighting earlier as well, Bloomberg Barclays are doing their own consultation, and FTSE WGB, which have a more rigid ratings criteria in terms of inclusion to their benchmark indices. So that may be a little distance away, I suppose. What has changed in recent years? Some of these developments, basically, the first major step that came through for this inclusion was when RBI decided to introduce fully accessible route bonds. So previously, as we know, the bonds had quotas. FAR bonds did away with the quota, so foreign investors could be fully invested in these bonds. Then settlement cycles being made more flexible, custodians basically being allowed to post margins on behalf of their clients. A lot of this basically has facilitated clients to have greater confidence into the market, into this region, and therefore the inclusion comes through. These are some of the countries that have become a part of the index over the last several years. You'll notice Egypt that was included a few years ago and then had to be removed recently owing to limited liquidity in the FX market. We have, once again, as I was saying earlier, there are no spur-of-the-moment decisions. There are no unilateral decisions with respect to inclusion or exclusion. The one exceptional case that you'll notice on this slide is when Russia was excluded after they invaded Ukraine. Even that included a series of discussions with clients, even if they happened over a period of a few weeks. And following that, it was decided to exclude Russia from the index entirely. The flows are not limited to once India gets included into the JP Morgan indices. We already have a few benchmark indices that some ETFs are already tracking. So there are these two ETFs you see on the screen there, one from LGIM, one from DB, that are benchmarked to the FAR bond, a customized version of our index, which is basically the FAR bond index. These list could change, obviously, as the inclusion day nears. About 25 or so instruments at the moment.
How many of these are also in the FAR list?
These are all FAR bonds.
These are all FAR bonds.
Yes. So we are not including any non-FAR instruments, once again, owing to the fully replicability aspect of it.
So there are 36 securities under the FAR. So, and you have?
We are not looking at the longest dated securities, and for a bond to be eligible for inclusion, we would like to have a bond to have at least 30 months of maturity, remaining maturity, when it is first included. By the time India is fully baked in, that would be 10 months from June, so March or thereabouts, June, February, March next year thereabouts. From that point of time, 30 months maturity remaining makes only 25 or so bonds eligible for inclusion. Have some of the weights being readjusted to accommodate for the 10% that India will eventually end up taking. So some of these weights will move. We haven't had a chance to update the numbers for Egypt in here. As I said, Egypt has gone down to 0. Philippines has gone down to 0, but that was already taken care of. The important numbers here, potential inflows, the question that we have been getting incessantly since late last year. As I said, about 240, 250 billion in assets tracks the whole GBI family. At the time of this publication, it was about 240 billion thereabouts. 10% of that is around $23.6 billion. If an investor is fully benchmarked and fully replicating the benchmark, this is what you would expect. If an investor is only replicating, let's say, 60 to 80% of the benchmark, that's the flow. So those are the potential scenarios that you could look at in terms of the expected flows.
Sure. At this stage, I shouldn't have, but just too tempted and to have this clarity. Sure. So one is, these are entirely passive fund flows. So how much of active fund flows may also veer around these numbers?
A very good question. There's no direct answer to that, unfortunately. So when we go and speak to a client, let's say you are a client and I ask you, you use GBIEM, what is your benchmark? What is your AUM to this benchmark? And you said 10 billion. I use 10 billion as my reference number. I speak to 10 other clients and they give me their number, and that sums up to this $250 or so billion. Several of these, about 85–90% of these clients are active managers. So they will always have an overweight or an underweight, depending on your positioning in the market. So the more investors that are overweight India, you would expect greater flows. The more investors that go underweight India, you would expect lesser flows relative to this number.
Yeah, so how much fluctuation do we expect going overweight and underweight? I don't think they go too much overweight or underweight. So any clue on those?
I'll just say. Can you hear me? I'll just say, so the couple of misconceptions. So Milul's exactly right that at some level, because index money is more passive, you will always get some percent of that 10. Now, the reason why this money is deemed to be a little bit more stable is in the good times, to minimize tracking errors with an index, in a bad time, you'd go from 10 to 8 or 6 as an example. Countries not in the index. So in general, what you find is that the standard deviation of countries in the index is still volatility. Trying to be active, the first or second slide that Vikar showed, you also...
So,
nobody would have, well, you wouldn't expect people to have a 10% overweight position compared to rest of the markets in the country. it wouldn't be surprising to know that you already hold India as be a small fraction basically of it. So will be adjusted as the inclusion starts getting baked in. A good chunk of it is still to flow in.
And to Vikar's point, Lata, this is exactly the point. It's getting covered by the slide. If you look at the last 10 inclusions, the actual money that flowed in on average was much less than the 100%. It was somewhere between 30 to 60% on average. Why? Because some people were already in that market, right? Some of it is an active money, and some front ran that money. So this is very fungible. But the fact that you get less reflects that people anticipating that are already in that market.
But this chart is very volatile. I mean, from country to country, it has been like...
And I think, Midul, that's the key point here. That there's, because these things are so different, it's very hard to have a standard rule that upon inclusion of an index, you get this much amount of money, because there are 5 moving pieces. How much of this money, how much of the AUM is actually tracking the index? What will the catalytic flows be there? How much of those investors are already in that market? Do they attribute overweight, underweight? There are many moving pieces.
So
and I think
would
that's a short
it be fair
point.
to say that if 10% weight, we shouldn't just assume...
I think the mechanical
23.6
calculation that 10% of 250 billion is very simplistic.
Very
as the last 10 index inclusions show.
Okay, Jayesh wanted to come in. Yeah.
I wish I had that crystal ball, Lata. I don't know, but it's also a function of the different market regimes. You see, this basically has spread out over the last 10 years or so. Our own strategists estimate it to be somewhere in the region of 60 to 80% of the anticipated flows. So that's a number you could... 80% of the estimated flows. So 62%.
I would answer that. So basically, we've been pushing for it for long, and all the time we have been hearing the story. The delta is very low because 10 is your index. So normally underweight you go to 8, overweight you go to 12, right? And therefore the delta, the volatility would be around 4, 5, 6%. It will never go to 0. But what people miss out is earlier, like whenever it's a good time. Say the fund manager is not really tracking this index. You're sitting somewhere in US, right? And if you put a non-index bet, and if it goes wrong, you would be really questioned internally. When it is part of index, right, and you have a fairly good view. So it is like, $25 billion is what it is tracking, but in a good situation, guys who are not tracking this index would also come in. So it could really, it's not 10% going to overweight, going to 12%. When it is good times, it can actually go to 23%. So the swing is 23 to 8, 6, 7, right? So the swing could be really wide. So that's where one has to be a little bit careful, because it's been always said that the swing would be maybe 4 to 5% once it's an index. As Sajid said, it will never go to 0, but then it never really goes up to 10 also, because it's non-index bet. So normally people, if you really look at the debt investors right now, either they are currency traders or they are arbitrageurs who are actually investing in Indian debt.
Last 2 slides then.
Yeah, let him continue.
Sorry. Just finishing up then. So these are basically realized numbers. These are from the government websites, NSDL, and so on. The FPI holdings have risen since the announcement, as you can see. You've seen the cumulative net FPI investment has been positive. So net negative over the last several years. Last year, the only year where it has been net positive in a way. New FPI accounts being registered, again a positive there over the last few years. So net a positive outcome here. This obviously leads to the conclusion that you would expect the non-resident holdings in these bonds to go up. How high they go up, however high they go up, India is still one of the lesser owned markets in terms of foreign participation if you look at it. So still very low relatively. That's about it, I think, with respect to our presentation.
Thank you for this very excellent presentation. So not that I'm that bothered, because I think one can manage whatever capital flows are come, but I leave that perception to you, Sajid. But before that, assume that you get one more bond index inclusion, Barclays and Bloomberg, into say another 2-3 months. Then what would be the flows for the next fiscal? Like, what would that add?
So even though, Mridul, it's hard to say with the exact numbers, I think there are some broader points one can make, that if you look at the balance of payments next year, next fiscal year, we're looking at a massive problem of plenty, right? Even with crude being between 75 and 80, there's a geopolitical risk premium right now. Let's say that settles down. India's current account deficit next year is going to be 1.2, 1.3% of GDP, 50, 60 billion. Despite the fact that FDI flows have slowed, you're still getting about 25, 30 billion. If you make conservative estimates on what Vickard says will come on debt and you get another index, you're looking at conservatively 35 to 40 billion dollars. The third point that we don't fully appreciate is interest-sensitive flows. So the interest rate differential between India and the US, which used to be 5%, has now gone down to 1%. Our policy rates are, the US is 5.5, we're 650, we're 675. In the next 18 months, when the US cut, they're going to cut at least 200, 250 basis points, given where their starting points are. For exactly the reasons you mentioned in the previous session, the RBI is going to cut much less. So you will see the interest rate differential widen in India's favor. And already we've begun to see that will mean a refinancing of domestic money with foreign money. So we had the last 2 years where ECBs and trade credits that were dollar borrowed got financed domestically, and that process will reverse as the interest rate differential widens. And then if you get, a perception of a strong election result, you get more equity flows. My short point is, each element of the BOP, right, equity flows, debt flows, interest-sensitive flows, are likely to push the BOP into a large surplus. The question is, what does this mean? China got almost $250 billion of bond flows in the pandemic, and the CNY dollar rate did nothing. My sense is that given past behavior, the central bank will absorb all of these flows. I think we have to always make the distinction. India's reserves, unlike the rest of Asia, are not earned reserves through current account surpluses. They are borrowed reserves in terms of current account capital flows. So for every dollar the RBI has, there's a corresponding liability in the economy which can unwind. So my sense is that the impact on the rupee will be minimal. And the last thing I'll say is, the question then is what happens on bond prices. Jayesh is the expert, but one has to look at the balance sheet here, because if the RBI is buying dollars and buying it forward, there's no increase on rupee liquidity, and net demand for bonds will go up. But what if you're buying spot and generating rupee liquidity beyond which you normally create money? Then there may well be a situation where you have to sterilize through OMO sales, hypothetically, and so the impact on the bond market is mitigated or offset because foreigners are buying and the central bank is selling. So you've seen some bond indices where the impact is much less than thought, because this is simply a switch on the central bank's balance sheet away from NDA, net domestic assets, to net foreign assets. So I think there are many moving parts here that we'll have to carefully consider as the short point.
Thank you. So your take on exchange rate appreciation, if any, or you're saying everything would be absorbed?
My sense is it will all be absorbed. We've seen the RBI target a relatively flat, broad, real effective exchange rate over the last 4 or 5 years. And Mridul, there, as an economist, I am sympathetic to that view. I think to the extent that we want to become an export powerhouse, manufacturing, right, services, at a time when the CNY may well weaken if China continues to disappoint, and every corporate that I speak to complains about Chinese dumping. Why does that this money, though passive in theory, could be active in practice? You want to buy these dollars when they come in, sell them when they go out, and prevent trend appreciation of the exchange rate from the standpoint of improving the economy's competitiveness.
So the exchange rate is in equilibrium now in your view? Or?
You know my view on this. If you look at the current account deficit ex oil and gold, the underlying surplus has been declining for much of the last decade. Now, there are many reasons for that decline, but I'm of the view that the rupee is by no means cheap. And therefore, it's very hard to engineer trend depreciation of the real effective exchange rate when you've got massive BOP surpluses. So at the best you can do is prevent appreciation. The last thing I'll say is what's interesting is when the dollar strengthens, the rupee always outperforms because the RBI is selling dollars, and we tend to appreciate vis-a-vis other EMs. But if the dollar is weakening and other EM currencies bounce back, the RBI is buying its dollars back and the rupee tends to depreciate. So if you're looking at dollar weakness, if over the next 12, 18 months as the Fed is cutting, this is a good chance for India on a trade-weighted basis to depreciate and gain some competitiveness.
Thank you. I think we are running out of time, but I think we have settled the exchange rate issue. If you allow us, the interest rate issue. And Jayesh, basically, what's your view? The budget, for the first time, seeing gross and net market borrowing fall, and that would have already a salutary effect on the yields. And now with the bond index inclusion flows, you would crowd in even more and the yields would probably go down. Are we moving into a lower interest rate regime structurally, or you think this is just a small cycle?
So a couple of things have happened, right? So we have been waiting for bond index quite a long time. But in the same time, when we finally got it included, I always had a theory that our borrowing program always required the fourth buyer. You had banks, you had insurance companies, you had provident fund, pension fund, but there was still a gap. That fourth buyer normally would have been FPI for FX arbitrage or something, or RBI will have to do the purchases. That's how the borrowing used to get over. Last 2-3 years, the local demand from pension, provident fund, insurance has grown so high that the local demand is completely absorbing the supply. Even if we had higher supply last 2 years, it was really absorbed pretty well. And even in this year, you know, the market was expecting the same number, but they were worried about if there is something more, they would do it, but which has not happened. So the market was very happy about it, that there's nothing more which has happened. As far as index inclusion was announced before the budget, so that's already there. What foreign flows, a lot of them you are seeing, some of them, a lot of them is actually for currency play. While right now the macroeconomic looks very good. Of course, I do agree with Sajid that there will be RBI at every concern. So maybe, you know, on the appreciation side, you will have a big wall or a big speed breaker from RBI at maybe even 50, 82 levels, and it will not really, all the flows, they will be absorbing it. But what we are seeing, the current flows is basically not the index tracker, is the hedge funds flows, which is actually, you know, bullish rupee, because rupee is not depreciating, but bullish rupee. And the best way to play long INR is to buy a bond. That's the best way to actually play that. So while we think that some of them would be buying for index, but majority of them, we can see the flows where it is actually 75% of them are actually buying for the currency. And that's a good story. So while, of course, I did say that on a cautious note that delta is more, it is risky, but next 3, 4, 5 years, the way trajectory for India is, India is in a good shape, both macro-wise. We had, of course, equity flows coming in and off a little bit less. I think even on FDI, I'm not too worried, because when we are seeing numbers, we are comparing numbers. But if you really look at the current FDI, even if it is lower number, it's much better in terms of quality. Because if you look at previous 2-3 years, the buying of the FDI which was coming were buying out companies, tech companies, fintech, unicorns and stuff like that. That would come chunky, $500 million, $300 million buying in some company. When you have manufacturing inflows coming in, somebody's putting up a plant of $2 billion, the net equity capital is going to bring is only $600 million. And that also spread over 2-3 years. So if you really look at it, the size-wise, this is lower, but the quality-wise, this is much better than the FDI flows which we got earlier. So from that perspective also, it is really is the moment what we are seeing, and that's what we are seeing the reflection in all Beyonce, which we are seeing in the Indian market and Indian stuff. So I think overall people are bullish. So from that and one of the reasons why people are taking this aggressive bet on currency also, that you have kind of a put, like come June, the index guys anyway going to come in, and at least RBI is not going to let it depreciate. There is no way about it. In fact, they will have to manage how to not let it appreciate a lot. So that's, from that perspective, people are kind of put options there, and that's where people are right now building up position. Even if you look at the interest rate per se, we have been in the range 7-10 and stuff like that, of course, after the budget announcement. I think trajectory-wise, we are going up to 680, even without a rate cut. It can, euphemism can go below that also. But I do agree, this kind of flow, we will have to see. RBI has to give some supply, otherwise we may actually go below repo rate. So from that perspective, it's not only the currency side of it, but also from a supply side of it. And of course, we don't know. But we do believe that RBI will give some supply. So it's the same thing, basically buying the dollars, and therefore liquidity being pumped in, and therefore you need to give some bonds in the market. And that would kind of, not have irrationality in terms of where the policy rate is and where 10-year is, right? So from that perspective, I would say, but yes, optimistic on the bond interest rate. We are looking at, I'm not too optimistic, by the way, on the US interest rate cuts. World is talking about, it's like series of cuts, like people are now talking about 6 cuts. We had previous panel, 24, we are talking about 5 cuts, right? So from that perspective, I think maybe 1 cut, 2 cut, but not a series of cuts. I don't really look at US rate cuts coming dramatically. For us, I think, yes, right now it looks like RBI will wait till US cuts it. But if we have more softening on the inflation, if we have little bit weakness, if little bit weakness shows on the growth side, definitely we can, definitely with so much wider real rate, we can actually afford to cut it before US cut. But looks like it will go in parallel.
Thank you, thank you. And I think it's coming from someone who has over 3 decades of experience with the Indian bond market. So we have to give some credence. So below 680 is likely, and also if there are cuts, then we go below 650 for sure. So that's very interesting. So this sort of testifies that we are heading to a low interest rate regime. I think I'll end the panel here because we are already behind the clock. So we will wait and see how much the IGB market gets deepened out of this. But I'm sure there will be some good impact. Thank you.
Ladies and gentlemen, we'll now move on to the next session. Our guest of honor for the next session is Mr. K.V. Kamath. Mr. Kamath is the chairman of Geo Financial Services and the former chief of the new development bank of BRICS countries. Previously, he also served as the chairman of Infosys Limited and as the non-executive chairman of ICICI Bank. Mr. Kamath also served as ICICI Bank's founder and managing director and CEO from 1996 until his retirement in 2009. He was awarded the Padma Bhushan, one of India's highest civilian honors, in 2008 for his contribution to the growth of the banking sector. I invite Mr. Kamath and the delegates of IIM Kozhikode and NSE for the inaugural ceremony of the Urupika Center for Excellence. We'll have the... We'll have a bell ringing ceremony, and then we'll have a short video of Urupika, please. Yeah, we'll have a bell ringing set. Yeah. Yes.
There is a numismatic history about the Urupika coin. It was an old Smoothri coin, Smoothri's kingdom in Calicut, which now is called Kozhikode. It was known as Urupika, and the modern rupee has sort of some lineage and history from which it grew. So that's what it was all about. Thank you.
Thank you. Our next session is a fireside chat between Mr. K.V. Kamath and Dr. Lata Venkatesh on futures of digital finance.
We spoke a lot of legacy issues, and now this is a journey into the future. The aha moment in digital finance came for me a few days back when a young person, one of my nieces actually, who works in a bank, I asked her, how much of AI do you have? And she said that I don't write letters to clients. I just go to the tool writes, and then I have to just check it. I have to put a tick to see whether it's well written. So AI was here. That was an aha moment for me, because I still write it painfully every time we invite a guest or curate a panel, a seminar. But can we start there, Mr. Kamath? What is the state of digital finance, in the sense how much of AI is already there? Selection of loans, selection of customers, or even something as mundane as writing of letters and reminders and chatbot. How much has AI already arrived?
Actually, let me put that in context. You need to understand what is the rate of change to understand how much is there and what is happening. So this is a few years back, and probably the pace has increased. Some 4 or 5 years back, I was talking to my old friend Vishal Sikka as to what pace is AI growing at. and he said the price performance is doubling every 3.4 months. Now please compound it. You will what is it? It's about 10x a year improvement in price performance, and this was a few years back. Fast forward today, I don't want to say it's now double that or whatever. I'm happy with 10x. So you can understand the rate of change that we will have to face if the price performance is increasing at that pace. So virtually anything that we are thinking of will be in a way mastered by AI in a much quicker time frame than what we think we are doing.
So if you can give us some perspective, what has already happened?
You know, as your niece said, entirely where there is a Gen AI type of activities, everything has been, in a way, is today can be mastered by AI. And don't be surprised, a lot of the regulators now use AI
yes.
To do a whole lot of analytics on various numbers. So I would think anything that was written is already done. Any number work which needs to be played with, you got an algorithm with now much more of embedded artificial intelligence things to do things. So I'm sure it's getting to where it writes code by itself. So all you can expect is the pace will increase.
Okay, so what happens in the real world? What kind of advantages does a digitally native NBFC have over a legacy NBFC?
Let's take a very simple example. You take a bank, let's take a bank which put in technology 25 years back. How much of change would have happened in the bank? I would think at best 25% of technology would be fit for purpose today. I'm taking this as a universal thing, not India alone. 25% has been replaced, the rest is where it was. Whereas the digitally native startup today in the fintech business is current. So, this is actually live question that I asked a bank about a year back, a year and a half back. So how long will you take to replace your app? And after looking around, the guy said 18 months. I asked the same question to a fintech who also had an equally good product. They said, how long, in the financial services business, of course, how long will you take to replace this? He said 6 weeks. So looking at that sort of challenge, you know where the future is. Unless banks and legacy institutions reinvent themselves.
But how does it look at the moment to you? Banking has been special at all times. When the mobile arrived or the cell phone technology arrived, it completely uprooted. I mean, there's no sign of MTNL. There is no sign of Alcatel. The legacy was completely uprooted. But in all countries, whether it's the JPMs and the Morgan Stanleys in the US or whether it is ICICI, HDFC Banks and SBI in India, the regulator protects, or for whatever reason, the status quo is protected. So do you think there is such a danger to legacy systems, or finance will be different?
Again, if you look at, let's take just a small piece of that for India, and that will indicate what is happening. Earlier on, if you look at, you had Ka and Sa were seen as the permanent bedrock of a bank. And they were permanent, so you could lend long out of that, which actually is counterintuitive because that could be the riskiest part if it were to move. But it never moved in India. So the regulator was right. You now look at car, there is virtually no car anymore because nobody keeps any overnight balance on one side. B, all the float that you had is vanished because with real-time settlement for everything, including the UPI part of it and the RTGS part of it, there is no float at all. So given this, the nature of business has changed, and that is forcing you to reinvent yourself. And now you have, again, look at deposit growth. This is driven by the saver. Either he is putting money into the bank or he is putting money into other instruments. And all this is being chipped away by technology. So I had the other day, I think I was just having a chat with the Honorable Minister Gadkari, and he said that my next InvIT, I want to make it retail oriented to the extent that I will pay interest monthly. So you have this possible only because of technology change, and you put an overlay of AI into that. I think the whole thing is changing at a dramatic pace.
Banking still caters to a whole, legacy population as well, older population. So can you really move into digital finance with the speed that you are saying, with the speed that technology is able to do, considering that you have to cater to perhaps the lowest common denominator? I'm sure everybody in their families would know that there is at least 25% of the family, or maybe even more, which are still FD dependent actually.
Yeah,
Not even mutual funds, FD dependent.
But that's changing pretty fast. It's changing pretty fast. You imagine that moment 4 years back when we had COVID and you couldn't go out. COVID, you said the next 2 weeks, 3 weeks you couldn't go out. Of course, then you couldn't go out for a long period of time. Just try to imagine how long it took you to actually start using that UPI app, and how long it took an older person in your home to start using that UPI app, and how long it took for that ecosystem to develop. It was virtually a few weeks to start. And then within a month or two, everybody was, not only the UPI app, I knew older people who started using Excel and started using Gmail, Sheets, because whoever was supplying you stuff said, please upload on this. And the housewife figured it out, and I'm talking of older person. So when you see merit, people change. And I had the same question going back, I can tell you, when we were rolling out the ATMs. And the people in the bank asked me, who's going to use an ATM? Nobody wants to come use an ATM. And within 6 months of installation, when you save 20 minutes of standing in line to take your cash out, and here you get it in the next minute, the migration with no effort at all. So people are much smarter than we think, but we have to acknowledge that and provide a solution which meets that test.
Okay. Well, do you think that we can go entirely digital, or do you think banking will always have to be, even for that matter NBFC, banking and financial sector, has to be digital, part physical, because you have to do due diligence perhaps with some feet on the ground, and more importantly for recovery?
I have actually a diametrically opposite view on diligence by feet on the ground.
Okay.
And that's where frauds happen. So I won't talk about frauds today, but I would think a large part of frauds happening is because of physical due diligence. You need to move it entirely to a tested and safe environment, real time, and that's what we'll look at. So for example, today, everybody asks for your Aadhaar card. Everybody asks for your phone number. Do you think that is safe? To me, that is probably the riskiest way. The right way is online verification of that without any at all. And today, it's moving there. For example, if you look at your DigiLocker, the transfer from Aadhaar is faceless. It is happening online and it's happening seamlessly. So I'm sure this is being thought of and worked out by the government and by various people, but at least we need to put a stop to all and sundry asking for your Aadhaar and this credentials.
And your phone number.
You go into a hotel and these are the two things that are asked for. Actually, I'm compromised. The moment I've given out these two, I'm compromised.
All right, that's true of diligence. But what about recovery? Do you think we can have something called a digital bank at all? Because recovery will have to be physical, isn't it?
Yeah, but even
especially bad recoveries.
Even recovery, if you see now, if you go out and talk to the digital people, they say that almost 90% of recoveries now at retail level is through legal process of basically writing to the customer that you owe us and get money back. There is no physical recovery that is happening. So everything is moving to now a different level. It's still not optimized, but I think it is getting there.
I don't think so, sir. Many of these are reporting actually 11% NPAs, which is the 10% that they're not able to recover.
No, yeah, but they're not able to recover and that's written off. So they are not going to a physical recovery mode, but they are writing it off.
Are you really saying that banking can move so completely digital that you don't need branches at all?
Next time you are talking to a bank CEO, ask him this question as to what percentage of recovery today is physical.
No, we are in an upcycle and so people are paying. But I don't think in a down cycle he will say that he won't have feet on the ground.
The culture is changed. The culture has changed.
No, the culture will culture will change for sure, but I'm just asking whether you can really have branchless NBFCs.
Yeah, branchless bank. See, what was the branch doing 25 years back? It was a full-fledged office, including your accounts were kept there. They are written by hand because you did not have any gadgets to play around.
All those have been digitized. I take your point on all that, but I'm still not very convinced about recovery.
The branch today is basically a sales point and a service point. If you can master that and put it online, why do you need it? Let's take a simple example. Do you look for a branch to have a query answered or something resolved with a Zomato or a Swiggy?
No.
If you can resolve every single thing there, including the chatbot, takes you to a level where almost everything is resolved. If there is something not resolved, then a human comes in. But I am happy to deal with the chatbot and get my things resolved rather than get to that human.
No, all that is a point I'm taking. What I'm not able to buy is that you will not need branches or physical presence of some kind for recovery of loans.
No, I think actually physical recovery is passive. Nobody is... I don't think if somebody is doing it, it can go beyond another year or so.
Okay.
This is not in the digital world. This is off.
Okay. Well, I will wait for that reality to dawn, but
yes.
I still see that as needed. For that matter, in India, even for the financial culture to spread, I guess physical presence is still needed up to a point.
Yeah, physical presence is needed where your digital platform is not complete and not thorough. Yes, then you cannot avoid phygital.
Okay. Which is the situation, I mean, we still have
At this point, 80-90% of the institutions probably are in that situation. They are not still, they can't provide you as flawless a service as Swiggy or a Zomato.
Okay, no, I would still think that, okay, Swiggy and Zomato are delivering something else here when you're giving liability or giving loans to a company, the situation is a little different from delivering food, which is an end product. A loan is, stands in a different situation. Okay, so let me come to the regulator, since you even touched on that point. How much do you think has RegTech and supervisory technology, RegTech and SupTech evolved? Do you think that has become, something that you don't have to visit the branch at all? That's completely evolved.
Who doesn't have to visit the branch?
The supervisor or the regulator?
No, I don't think the branch. I think it is probably gone off. I'm not in a bank anymore, so I do not know at the physical level what happened. But I would imagine at the branch level that went off quite some time back. But at the head office level, I'm sure there are visits. But my own view is that given the pace of change, and once the systems fall in place, that should also be done by remote.
Okay. Have you already seen signs that regulators are able to, now the RBI, for instance, has the Krill C, where defaults are anyway reported every Friday, and they have big data, they have enough data from banks on a weekly and fortnightly basis. So already I guess supervisory visits are not needed.
It's progressed pretty far, because even without a visit, there are, they will flag items which need action immediately.
Totally based on looking at digital data. Okay. Now let me come to the other aspects of digital finance. How do you see decentralized finance evolving? It got a bit of a heart attack when the cryptocurrencies problem emerged, when Bitcoin problems emerged. But do you think that DeFi or decentralized finance has a big future in terms of trading and investment?
In any case, I'm not a big fan of crypto or this one. I think the underlying technology behind it has merit, and that will find its own course, unless something else comes which overtakes that. But the currency itself, I have no faith, because I think people have said enough about it, and I respect very much what the governor has said about it, and that's exactly my view.
Okay, so let's then come to cross-border flows itself. Do you see that? I mean, we just saw UPI being inaugurated in Nepal and in Sri Lanka. Are you expecting that we are going to see a lot of cross-border flows digitally and through systems like UPI? Or do you think it will still be dollar-based and not move away from the dollar?
See, again, if you look at the history, and I'm not going into the history of what has happened with a currency or another currency, but frankly, if you look at a cross-border transaction, there was no other way to settle but using a hard currency and using a particular platform. The SWIFT was your platform and a hard currency was the dollar. And we did not have anything else, nor did anybody else have anything else. So now with the UPI type technologies being developed, more than one countries, and we taking it out to other countries, there is a means by which we can settle A. And now, flip side is, do you have a currency with which you can settle? I think that is to be understood and probably calibrated a little more, because you need two counterparties who are willing to settle in that currency. But the payment rails, I think, are already in place. So you are almost getting there. But I'm sure you'll find counterparties will be willing to settle with our own currency.
No, at the moment, UPI across countries is doing exactly what card payments have been doing across countries. You tap a card, instead you will use UPI in those countries that have accepted or have the interface with the UPI platform. I want to move to the next question, actually. Do you see central bank digital currencies evolving? Do you see...
I want to answer that, maybe clarify what I said and what you said
about
on card.
UPI payment.
It's not just card. You now have a payment rail.
Yes.
You have a payment rail which can go from bank to bank. From not a bank in India to a bank in India, but a bank in India to any bank.
Yes.
So earlier on, the only way you could do that was through the SWIFT exchange, through the various routings that were there. So I would guess that there is a whole lot of evolution in terms of what has happened, and that's what I was talking about. Yeah. So the South now has an ability to put those rails in for transaction, but the currency has to be determined. Yes. Which currency? Sorry, your next question was?
That was what? I take your point that when I do a UPI transaction between a person here and a person in Singapore, a person here and a person in Sri Lanka, it is still dollar denominated. It would be very much like a card transaction. Now I'm asking you the next step. Do you see central bank digital currencies replacing dollar?
Central bank digital currencies will first be used domestically. And I think it's a little time before they would replace a hard currency.
Okay, but is that something you see as imminent?
If it'll ease settlements.
That would be a game changer.
It'll ease settlements, but you still need the counterparty to accept your currency. The moment that happens, yes. But we need to get to a strength where, to a position where our rupee has that strength and stability, which allows it to be used as a settlement currency by the counterparty.
Okay. Now to the what has blown on our face in terms of the negatives of, well, I don't want to call it digital finance, but it was the first major digital payment company, Paytm. What we find is that the legacy regulations, compliances are not as good in this, at least in this case, the regulator tells us that there were probably mule accounts, there were probably accounts which did not at least subscribe to the regulator standards of KYC. Do you see that as a big problem with digital finance, the problem that arose with Paytm?
Yeah, again, I don't want to talk about a company or an institution. But if you look at a larger issue here, and if I take the universe of digital startups, I've always observed that the platforms they are created is good. But whether there are bugs in the way they act and operate, I am not able to call. And their expectations of market value was again out of sync. So they have created something good. In the sandbox it has worked very well and so on. But in executing it, to try to aim at that pot of gold, what mistakes you are doing, I think only regulators in the fintech business, regulators can point out. And that is something that we will need to see as we go along. Because in trying to aim at that big payday as it were, whether you have taken any shortcuts.
There were two steps from the regulator almost back to back. The first one happened on Paytm, and then there was this commercial credit cards against which the Reserve Bank has moved. It appears that in both cases the Reserve Bank is worried about probably mule accounts or probably accounts about which KYC has not been done. So more generally, I'm asking you that will this be a kind of an obstacle or a hindrance, a speed breaker in the path of digitalization?
I would call it certainly a tightening up of the process, because somewhere along this line is also fraud. So if you talk to digital companies today, I was talking to somebody in Pune, a large player in this business, and they said our worry now is not credit risk, our worry now is fraud risk. So under the umbrella of fraud, a whole lot of things are encompassed. It's not the classical fraud that we knew, that is in connivance with the bank. Now third parties are defrauding the system and playing around with it. And now in one of the analyst reports I found, not related to the subject that you talked about, but in some other context of a credit card company, they used two phrases which are very interesting. They said rental payments and tuitions are being used as the gaming the system using that. So if anybody is interested, please go in and figure out what are rental payments and what is tuition payments. So you'll figure out what is happening. So at every step there is a need to be cautious, and the regulator is cautious. All this, and I would believe that this particular stopping that particular payment platform was because it was being in a way misused for these sort of payments. So,
since you're so close to the event and you know these things well, do you think this has disheartened the fintech community in any fashion?
In the sense that an innovator doesn't like to have checks and balances. So here I think it's very correct that you have checks and balances. You should have understood that and complied with that. And I'm sure that community will quickly learn. They don't want to give up the good that they have done.
Okay. What is your sense, therefore, about fintechs? I'm throwing all these problems at you merely to ask you whether the legacy systems are going to be overwhelmed by this huge fintech developments, technology developments that we hear. Yeah. But what we see actually is both regulator and legacy systems actually prevailing, or at least stopping the progress.
Yeah, it is not the legacy systems that have prevailed. It is a legacy company could very easily use new platforms and not be subject to. This is behavioral issues here, and behavioral issues have to be addressed, and then I think you will be okay. It is not the legacy which is the problem.
So you don't think
the
events of the last 1 month will slow down the pace of
not at all.
Fintechs or payment systems?
Look at the approach that the central bank has taken. Very sound approach, putting everything into a sandbox, testing it, making sure, double testing it, and then releasing it. Now you have somebody then gaming it to do things.
It's just that one of the most blue-eyed boys of digital finance suddenly didn't come down crashing, but was seriously brought down and tied down by the regulator.
I would think we are talking of a larger thing, the entire digital life. I think everybody needs to play by the rules that the regulator sets. Okay. Then you should have no problems.
Now, the big aha moment for us was in digitalization was Paytm, and after that UPI, back to back. What do you see as the next big aha moment in digital finance?
See, my view is that the next real big moment will be when banks embrace the digital journey to the fullest, which would mean that all their existing platforms are replaced with more nimble, more agile, more fit for purpose, which will serve their customer of today and tomorrow. And I don't see that they have an option but to do that. Question is it 1 year, 2 years, or 3 years? Beyond that, I think it's challenging to stay with your old legacy systems.
What do you see as red flags in this? I mean, cyber or hacking. What can be a big red flag?
What is the young people that mentioned to me? They are no longer worried about credit risk. They are worried about fraud risk. Okay. Along with that, cyber security. So these would be the top two risks anybody will have to bear, not just banks or anybody in business will have to look at these as the number one, I would say number one risk.
Okay. So now 5 years down the line, can you tell us how an NBFC will look? How will a bank look in India?
Yeah, my hope is that they look, the very thin staff, and a very thick overlay of technology, institutions which virtually run with technology rather than with the people.
Okay, so fewer employees, that's not sounding very good, but the rest of it is...
But Lata, look at it this way, this we have seen, it is not that we have not seen. See, when we started looking at branches, there were about 30, 40 people in a branch. Then it thinned down to about 15 people in a branch, and people moved to a back office. I'm talking of circa 2001, 2002. And maybe we were the pioneers in moving the back offices. Yes. And we thought at that point of time that we will need a very large back office in the 4 zones in India. And we set up one in Hyderabad, 2.5 lakh square feet, to seat 25,000 people at one go. And we said similar one in the west in Ahmedabad and the north and the east. We set up the Hyderabad one. By then we went straight through. We didn't need that space at all, because that's being used as a training and other things, I think, but not as a back office. So that went off. The whole equation went off. So it's getting leaner and leaner and leaner already as we see, because you have to look at the size of the bank then and the size of the bank now, and probably the size has increased 10x and the staffing has probably increased 1 or 2x. Okay. So you're already seeing that, and you weave in AI the pace that it is changing and other technologies that are changing at the same pace. It won't be zero staff, but it will be a very lean staff compared to the size of the book.
Okay, that's not very encouraging from a country that is going to harvest its demographic dividend, but nevertheless, as you point out, that's the way things are headed.
Yeah, but it's not just banking. There will be other jobs which will come up. The very act of creation, the very act that there is a digital economy, that's where the jobs are.
Thank you very much, Mr. Kamath. That's very encouraging to think that digital finance is on a super plane, and we are going to see dramatic shifts in the way banking is done and in the way non-bank finance companies will be held.
Thank you.
Can you tell us anything about how geofinance will look? I know you told me to keep that question away.
No, that is for the CEO to answer. I am transgressing on his prerogative. Thank you.
Thank you, sir. Do we have any question in the audience? There's a question.
It's really pleasure to have Kundapur Vishwanath Kamath talking, a fireside chat with Dr. Lata. What Dr. Kamath spoke about his heart, because I come from a district from Karnataka, which is known as the cradle of banking. 30% of nationalized bank took birth in this particular district, which Kamath sir too come from, and he revolutionized the entire banking sector. And I think this August gathering must stand up and give a standing ovation to Kamath sir. Please stand up. Sir, you rightly said that recovery is really done 98% without the people. It is practical, Lataji. You go to Hyderabad. There's a company which has very linear staff, and they have done 98% recovery at NBFC. I am also part of NBFC for the last 18 years. I run 19 non-government organization which does impossible job with the blessing of Kamath sir. So what I'm saying that sir is a revolutionary. So we need to follow him. Thank you.
Sir, I was wondering. I knew that you were from somewhere near about where I was born, because you actually took my dad's name. Thank you.
There's a question.
Hello. Hi, my name is Alpana. Good evening. Beautiful talk. So I have two questions. One is on the, you spoke about the layer getting thinner on the stuff, and technology will take the role. So on the blockchain side, what are your views on how exactly it will go ahead? And at Geofinance, on the governance side, what are the initiatives and how exactly do you see the future? Thank you.
Yeah, actually, the blockchain, I think, is something that we will watch very carefully going forward. Except, as I said, could there be something which overtakes blockchain at significantly lower cost, as it were? So that could be. Geo, I won't talk about. As I said, it's the CEO's prerogative. Thank you.
Good evening, sir. It's a pleasure to see you and speak to you. My name is Gopen Gupta. I'm an entrepreneur, and I should say that banking and finance is the backbone of an economy, of any country. My main point is, in a country like India, compared to China, you can see that in tier 3-4 cities, towns, smaller cities, towns, and even rural areas, you don't have banking penetrating. So do we hope that digital finance should be, where 70-80% of the people, they have so much of huge money in cash. So they should be very productive in driving the change, and they should be accelerating India. And I believe there is wherein the change lies. Thank you, sir.
I 100% agree with you, because that part is, again, almost virtually impossible to put branches into that part of India. There will be still, what, 300,000-400,000 villages where you may not be able to put in. So it is digital which will overcome this challenge. You're right.
Thank you, sir.
Okay, so we have come to the end of today's wonderful conference. I invite Dr. Sagar to come on stage and felicitate Mr. Kamath and Dr. Lata. So a quick vote of thanks.
So I'm not going to hold anyone back, but I have to give this vote of thanks. So here it is. Ladies and gentlemen, as we draw the curtains on this enlightening and insightful conference, I know everybody will agree with me with this. It is my privilege and honor to extend a heartfelt vote of thanks to each and every one of you who has contributed to the success of this event. First and foremost, I extend my deepest gratitude to our distinguished speakers, panelists, and presenters whose expertise and insights have illuminated the complex issues and at the intersection of global finance. Your thought-provoking presentations, engaging discussions have enriched our understanding and inspired us to delve deeper into the challenges and opportunities that lie ahead. I would also like to express my sincere appreciation to the IIM Kozhikode faculty, especially to Dr. Mridul Sagar, for meticulous planning, tireless efforts and unwavering dedication in bringing this conference to fruition. We are very privileged to host Urupika's inaugural conference here at NSE. We look forward to hosting more conferences with IIM Kozhikode. I'm also very grateful to the cooperation we received from our colleagues at NSE, particularly the EPR group, yeah. Your commitment to excellence and attention to detail have ensured every aspect of this event has been executed flawlessly. I thank our Managing Director, Shri Ashish Chauhan, for his support and guidance. Last, but certainly not the least, my heartfelt thanks to each one of you, our participants and attendees, here and online, for their active engagement, thoughtful contributions, and enthusiastic participation throughout the conference. Once again, thank you everyone. Thank you.
So we have high tea. I request everybody to join us, please.